Please welcome the founder and host of DC Fintech Week, Chris Brummer.
Ladies and gentlemen, it's farm time! Guys, this is the 8th year, which is kind of unbelievable, of DC Fintech Week. We started off in this little tiny basement area of Georgetown, and now we've grown into a large, really, I guess, multinational event. Thank you so much for being here. We're going to have some conversations throughout the next 2 days that are being streamed around the world with our major media partners, as well as really a very unique combination of leaders from across government, from across the private sector, our thought leaders, central banks, diplomats, you name them. And the thing that makes it most special are you guys, because the Washington, D.C. audience is very different, different kinds of people, different kinds of opinions, but the people who go to this conference have one thing in common: they're pretty nerdy. But that does allow for people to have some very unique conversations with each other and to engage each other in a level and in a way that we think nobody else in the world gets to do. So thank you so very much. I just want to introduce now and bring on our very, very first panel. I want to thank Fannie Mae. This is an amazing, amazing setup that they have for us. I want to thank AWS. I want to thank the Washington Post. I'll be thanking lots of people in the course of today. But again, first I want to welcome back to DC Fintech Week the acting comptroller of the currency, Mike Su, and also Young-Sung Shin, also a repeat, who is the economist for the Bank for International Settlements, also our regulatory co-host, who has done enormous amount of work in helping us to pull this off, and also Erica Mueller from Politico. So let's jump right into it. You may have heard there are some things about banks and banking and fintech going on. I think this is an extremely appropriate way to start off the conference. So with that, let's get things started. Ladies and gentlemen, it's farm time! Come on!
Good morning. Thank you so much for being here with us. My name is Eleanor Mueller. I cover congressional economic policy at Politico. So honored to be moderating this panel this morning with Acting Comptroller of the Currency, Mike Su, and the Bank of International Settlements Head of Research, Young-Sung Shin. Thank you so much for being here with us so early in the morning on a Tuesday. I want to start off this morning by talking about the fintech middleman Synapse, as you may well know, collapsed earlier this year, leaving tens of thousands of customers without access to their own money. The FDIC last month took a first step at addressing some of the systemic gaps that contributed to the collapse. But Mike, my question for you is, do you think regulators should do more?
So first of all, thanks so much for having us here. It's a real honor. It's a pleasure to be back here. The Synapse bankruptcy, I think, really has highlighted two things that we as regulators and as the general public really need to focus on. The first is that banking is no longer done by just banks. And it really highlights that the provision of banking services now includes not just banks, but you've got fintechs, you've got these middleware platforms. There are others that are in this, effectively a supply chain that provides that service. And some of the players in that supply chain are not well regulated. And I think this is something that we all are grappling with. The second is that there is a regulatory gap that we have here in the US that we're going to need to really address and confront. And that is, for banks, we have a regulatory system, chartering, supervision, regulation, which is fairly well developed and mature and understood. And for the synapses and the fintechs of the world, it's basically done at the state level as money transmitters, as money services businesses. And that regime was developed a long time ago for something much simpler. And so we've got, compared to other jurisdictions, and Hyun can speak to this, we have a gap. We do not have a federal payment, e-money payments regime charter that other countries have, which is really would be better fit for purpose today. And Undersecretary Nellie Lang recently gave a speech about this, highlighting the need for, hey, there's certain attributes here that if we had a proper regulatory regime around, we could improve innovation, improve safety, improve how this chain works for everyday Americans.
Awesome. Do you think that there are any lessons to be learned globally around how the U.S. should address the kinds of gaps that led to this collapse?
I think I'll leave that to the U.S. authorities, actually. But I think there are some, general lessons about, how to design the system. We feel that the singleness of money is really important. Singleness means whether you pay through your phone app, whether you pay through a bank transfer, or whether you pay through cash. A dollar is a dollar. And what that means is we have a very good unit of account in the economy. That sort of sets the benchmark. It anchors everything. And the economists would point out that money is a social convention that is the best coordination device that one can have. It knits all the activities together in a way that we can plan, without any kind of risks that the counterparty would give us something which is uncertain. And so the way that we design this, I think it goes really down very deep into how we design the actual monetary system itself. And as Mike said, banking itself is now done by non-banks, the particular services. But one thing that is really done best by banks is money. I mean, they are basically the guardians of the monetary system in that sense, working with the central bank. But it's the type of money that most people would use on a day-to-day basis. But the point is that singleness is preserved because when you pay someone who banks with another bank, that settlement happens through the central bank's balance sheet. So in effect, what I'm doing when I'm paying someone that banks with another bank is I'm paying with central bank money. And that's how we preserve singleness. And this is the way that we've been hardwiring a lot of our projects. And we can talk about that later. But we feel this is really, really important.
Can I just build off of that really quickly? At the core of all of this is trust. And I think that this is what Hyun was talking about, the singleness of money, the entire infrastructure and architecture that we've built up around central banking and banking has been oriented around how do we maximize trust. And with all these evolutions in technology, there is a lot of very interesting innovations and benefits, which I think should be heralded and should be embraced. At the same time, we need to make sure that we've got a strong foundation for ensuring that there's trust in those systems, especially when things break. And I think what we're seeing now, as you saw with Synapse, is that architecture is not quite there yet. And so that we need to work on. And it doesn't mean shoving everything into the banking system. I think there is a way to develop an ecosystem where these pieces do fit together to enable that trust, but it can't just be assumed. That does take some design and some discussion to get that right.
All right. Well, Nellie Lang said recently that there should maybe be a separate payments regulator in the U.S. I mean, do you agree with her? And if so, do you have any thoughts on how that might be structured?
I would start first with principles. What are the principles by which such a charter and a regime should operate? Again, to maximize that trust while enabling that innovation and those benefits. And then after that, I think in general, it's a good idea to, what do we want? How do we want to do it? And then who should do it? And I think if you approach those questions in that order, that's the best way to do it. Because otherwise, answering the who question can start to pollute the what and the how. And I think it's good from first principles to say, what do we want and why do we need it? How should we go about doing that? And we can decide who should be the ultimate regulator.
Got it. Anything to add on this idea of?
No, I think Mike expressed it very well.
There you go.
Yeah.
Well, then I'd like to turn next to BIS's Project Agora, which was launched recently to explore tokenized money both at banks and central banks. Can you share with us, what you've learned so far about the benefits of tokenization generally?
Well, it's still early days.
Yeah.
So Agora was launched in April. We've just completed the onboarding of the private sector institutions. It's a partnership between the central banks, who are going to provide the ultimate unit of account and the settlement asset, and 40+ private sector institutions who are going to be doing most of the customer-facing activities. And we've already had a couple of meetings. There is a lot of energy. Perhaps we can take a step back and just discuss what tokenization actually is. So in the abstract, if we walk back from its crypto origins, tokenization is simply a way of injecting some programmable functions into digital representations of both money and assets. So what that means is you can program in specific triggers for transactions to take place. So in the jargon, you can make contingent performance of actions possible. In other words, you can make a payment contingent on the transfer of an asset, for example. So when you're buying a large value item, you want to make sure that you're going to actually get the item if you pay, and vice versa. The seller would like to get paid if you're going to hand over the money. So if you can make it such that one leg of that transaction takes place, if and only if the other leg happens, then that's something that could really benefit from programmability. We know that this is a very basic function, and there are many other ways of getting this so-called delivery versus payment. But the idea is, are there other things we could do with programmability? And I think compliance is certainly one of them. That could really make the payment system and the financial system more generally, much more efficient.
If I can build off of that, maybe.
Go ahead.
The one thing that Hyun had mentioned, tokenization. Tokenization is like kind of a hot buzzword right now, and I think, as I'll refer back to Professor Brummer's opening, for the nerds in the house, which I count myself as one of them, it's good to be precise. And with tokenization, it is not synonymous with crypto blockchain. You can tokenize deposits or assets without any blockchain. It's not necessary. And I think this is important because the purpose of tokenization, as Hyun was mentioning, was you basically are flattening a process. You're simplifying a process that people don't understand typically has lots and lots of steps to it and lots of middlemen. So when you buy a security, when you transfer money, it seems like it just happens. It doesn't just happen. There's actually a lot of steps and a lot of players there. And with tokenization, you can simplify that. That's good. There's fewer middlemen. I think one thing that's interesting is in the crypto blockchain space, some of the tokenization that's being discussed introduces more middlemen. It makes it more complicated. And I think it's good to just have a North Star on this. Like, what problem are we trying to solve? We want simpler settlement, more straightforward, more final settlement with less risk, less handoffs, less middlemen. And that is what can bring all of these benefits of programmability. We have to be careful if there are schemes and approaches that just complicate it. That usually ends badly. So I think it's just one of those, it's good for us as practitioners, regulators, those who are in the field, like, let's unpack this and not just take it sight unseen. Like, tokenization is great. In some forms, it has enormous potential. And at the OCC, we held a symposium on this last year. And really dug into, like, what are the legal foundations? What are the risk management foundations? If you get those foundations right, great. We set the guardrails, and then we as regulators, we get out of the way and let innovators innovate. The problem is, without those guardrails, you just mix a lot of things together. And I think we've seen, particularly in the crypto space, bad actors can just take that in a direction that ruins it for everybody else. And I think that that's something that we have a shared interest in avoiding.
And let me just add, it's not just about improving what we're doing already, but it's also about harnessing tokenization and the programmability to do things that are currently not being done. And I think that's the really exciting frontier.
Follow-ups for both of you, but for you, I mean, have you found with the project, obviously you said it's in early stages, but are there benefits at this point that you've discovered with a central bank digital currency that you cannot get from a tokenized deposit?
Well, actually, the whole system runs on tokenized deposits. So what we want to do is to make sure that we preserve the best in the current system, and that is the singleness of money. And when you pay someone from your bank, your bank doesn't acquire a claim on my bank. That's very different from a stable coin.
Right.
If I pay you with a stable coin, you have, as well as your blue dollars, you have a red dollar there as well, because someone's paid you in red dollars. We don't have that in the current system. When I pay you, you just find that your bank balance has increased. And that's because in our current system, the settlement takes place through the central bank. And the central bank pays your bank so that your bank could credit your account like that. And that's a tokenized deposit, which is a very different animal from a stable coin. And we think that that's really a foundational feature of something which will preserve the singleness of money. And what's particularly difficult these days is all the frictions that happen when you make a cross-border payment. So what's called a correspondent banking payment. You have to go through several legs through the commercial banking system, often in other jurisdictions. And the settlement there often happens on the commercial bank balance sheet. And this is where all the frictions to do with KYC, anti-money laundering, those kinds of regulations are there for good reason, and we have to keep them. But it can really impose a lot of burdens on the individual banks along the chain, and there's quite a lot of duplication as well. And this is the kind of thing that is just tailor-made for something which is programmable. If you can make that programmable, you can use the platform resources in a way that can make that adjustment take place in one go. That would really free up a lot of the constraints that are actually currently holding back the correspondent banking system. And this is really something that's really about the real economy, not simply about convenience of payments.
Yeah. For you, I mean, you mentioned this speech last year on tokenization, which I was reading yesterday afternoon. Are there things you think Congress should be doing right now to establish that legal foundation that you say is missing potentially?
For Congress to do? Well, so certainly, it depends. And I think it depends on how specific Congress wants to get involved in either the tokenized deposit space, which I don't think congressional involvement is required. That we can do with kind of existing authorities, existing infrastructure, versus stablecoins. And as Hyun pointed out, these are two different things. Tokenized deposits versus stablecoins, they often get discussed in venues like this kind of together, but they do function differently and they involve different issues. For stablecoins, a regulatory regime that, again, enables that trust and ensures a level playing field, Congress does need to act in order to set the parameters for that. And I think that's been well discussed. And so there's no need to go there. But into the tokenized deposit space, that is, I think we can use all the existing rules and frameworks we have now. We just need to focus them. And we need to basically get in the lab, get our hands dirty, and innovate with it. And that, I think, is what Project Agora is about, is to bring together those parties to say, OK, roll up our sleeves. What is it going to take to operationalize this? Yeah. And that, I do have to give one of the benefits of all these developments in the blockchain space. It has prompted more innovation in what I would call kind of the traditional finance space. In a good way. It really has forced a lot more thinking about what needs to be done in essentially to keep up, but to provide these benefits using existing infrastructure for trust. And it has forced quite a few conversations on inclusion. Because I think that part of the pitch for crypto, DeFi, et cetera, has been it's more inclusive, quote unquote. I put that in quotes because it's not necessarily more inclusive. But it has forced the traditional banking system to say, well, we need to do that too, and that's good. That is a good thing, because I think some of the criticisms of traditional finance of not being inclusive have legs, right? Those are not made-up arguments. I think if you talk to underrepresented groups, vulnerable groups, they have not had good experiences with the traditional finance system in terms of access. And that's something that we all need to be working on to make sure it's fair for everybody.
I think that's a fitting segue into our next topic, which is artificial intelligence. I cover mostly Congress, and many lawmakers have told me they want to focus on artificial intelligence and financial services next year. I guess my question is, first for Mike, how are you weighing the risks and the benefits of AI in this sector?
This is a very great, important question right now. So I think of AI as, it can be used as a tool, it can be used as a weapon. And so it's good to unpack it for each of those. So as a tool, banks can use AI to improve processes, to improve underwriting, inclusion, et cetera. So there's a whole set of use cases which are interesting. Now, there are risks with that. And if you're not careful about how AI is used, it could result in more unfairness. It could lock in discriminatory biases, et cetera. So there's a lot of conversation about AI ethics, AI safety, discrimination, fair lending, et cetera. How do we incorporate all of that into AI development? The good news is banks have been doing machine learning for some time now. So it's not entirely new for banks and regulators. So there's a foundation to build off of in order to ensure that uses of AI, Gen AI, et cetera, are safe. And the good news is banks so far, knock on wood, I'm not sure what material this is.
It's not wood.
Banks are doing that AI adoption as a tool appropriately. That's something that we're obviously watching and monitoring very carefully. Then you've got the problem of AI as a weapon. And here, I'm actually much more concerned about this, is that bad guys can use AI to commit fraud, to do scams, cyber attacks. Like, it has really lowered the barrier of entry to bad acts against the financial system. And so ensuring that we've got safeguards and we've got attention to that is in some ways more pressing today, because as everyone knows, fraud is up, cyber attacks are up, and some of this is being, I think, going to be, and it has been and will be enabled by AI, that we have to get those defenses right in order to safeguard trust in the system.
Jan, do you have any thoughts on
Absolutely.
how?
Alan, can I just give a plug to the BIS Annual Economic Report this year? We have a whole chapter on this. And as Mike says, AI is a tool that's been out there actually for some time. It's just that large language models have really sort of brought that to the center of the news. But it's a tool for imposing structure on unstructured data. And language is a particular form of that, where you put some mathematical structure and then you're trying to guess the next word in the sentence, etc. But that aim of finding patterns in unstructured data, I think that's absolutely key for all the banking applications, actually most of the financial sector applications. And machine learning has been used for compliance for many years now, actually. And it's a much more efficient way of sifting through the data and coming up with particular transactions that you want to flag, for example. But as Mike says, there are also the less benign uses of AI. There are sort of versions of old tricks, but now much convincing, like phishing emails. You can just tailor the phishing email to the person that's receiving it. But there's also new types of attacks, like data poisoning attacks, where you just mess with the underlying data that the large language model actually works with, and then you can get it to divulge all kinds of sensitive information, and then you can really sort of commit quite sophisticated forms of fraud. So this is something that we need from the official sector to be right on top of, and I think this is where we need to dig into the underlying technology a lot more.
And one thing that we're really going to have to unpack more as we go forward is who's accountable for what. And I think with AI, especially with these large language models, these Gen AI models, the accountability question is very much a live one, because no one wants the accountability, right? Like the developers of the LLM will point to someone else, just like, look, we're just putting a tool out there. We're not telling people how to use it. And there's all these different players. And so the question is, if something goes wrong, if people get hurt, who is accountable for correcting that, for rectifying that, and for preventing it in the future? That hasn't been completely worked out. And I think that is a space where we are really going to have to have some real engagement with banks, the industry, others, because very few banks are going to be able to do AI all on their own. They're going to have to rely on others, third parties, fourth parties, others. And we just have to be very clear about, where does my responsibility end? Where does your responsibility begin? So that folks can hold folks accountable and the right safeguards can be incentivized and put into place.
Got it. Well, I have about twice as many questions for both of you as we were able to get to. But I want to end on one closing question that I'll ask you both. And that question is, what keeps you up at night doing the work that you do? And Mike, we can start with you.
So I worry about everything. It's kind of in the job description. So I worry about a lot of things. But one of the things I think it has gotten a little bit more attention recently is, and it's related to what I was talking about, banking services being part of a supply chain. There's increasing concentration and reliance on cloud providers. And this kind of maps to the AI discussion. And that reliance is often not direct. It's not necessarily that banks, financial services rely directly on cloud providers. But as we have this ecosystem of more and more players, where data is more and more important to everything that gets done, just the profile of these cloud providers as important constituents, participants, providers in that space increases. And if you trace it, if it's not a third party, often the third party relies on them as a fourth party or a fifth party. It raises a lot of questions about what are our expectations for resilience, for recovery, et cetera. And that's something that we have this cloud executive steering group that Treasury put together. I happen to co-chair that with Director Chopra, Bill Denchev from PNC. So there's been efforts to work with the private sector to say, okay, what are those right resilience safety standards? And how do we work through that as we want to build, again, a system that is trusted? That's the North Star is like, is this system trusted? And part of that is making sure that there's clarity about who's responsible for what.
Jan.
Thanks for going first, because I had a chance to think about this. Maybe I can go back to Agora actually. So it's a very ambitious project. We have 7 central banks, plus the BIS, and then we have 40 plus private sector institutions. And you can imagine that's a very large group to coordinate and to try and sort of move in lockstep. And I guess one thing that has kept us very busy, although it hasn't quite kept us awake at night, is make sure that all the pieces are in place and we're making progress at the right pace in a direction that everyone can actually agree on. So far, it's been remarkably smooth. I think the vision is something that everyone can really buy into because they recognize the problems and they can see that this could be a very important step towards a solution. But there are many moving pieces, and even small sort of nuances, can really magnify in that large setting.
All right. Well, thank you so much, Mike. Thank you, Hyun. Thank you all of you for being here with us. That is our time. Yeah, that's it.
Thank you. Thanks so much, Alex.
Thanks.
Hello, welcome. Good morning, everyone. Welcome to our panel on how technology is redesigning bank fintech partnerships. My name is Yana Miles. I'm SVP Global Public Policy and Government Affairs at BNY, formerly BNY Mellon. I'm going to introduce this panel, and then we'll dive straight into questions. So I'll start to my far left, Livia Beniski, and she is the Chief External Affairs Officer for Banking Circle. We have Alex Ikri, Chief Legal Officer for Unit, Joanne Barefoot, CEO, Alliance for Innovative Regulation, or AIR, and last but not least, Delicia Han, Senior Director for Digital Marketplace at Consumer Reports. Round of applause for this panel. Thank you for being here. So I think as we're hearing, this morning and beyond, we're at a critical turning point for innovation in financial services. We see that consumers and banking institutions as a whole are working with products and services that didn't exist just 10, 20 years ago, or certainly not in its current forms. Joanne, we'll start with you. As banks and fintechs are increasingly collaborating, what are evolving models that you've observed that are allowing them to better work together? And what benefits are you seeing in these partnerships for consumers and the banking institution?
Great. It's wonderful to be here, and especially this morning since the 1033 rule just came out and these topics are so timely. I think if we were to think back on the evolution of fintech, at the early stage of it, there was a lot of talk about the fintechs were going to disrupt the banks and replace them and the banks would be obsolete and dinosaurs. Obviously that has not happened. Although some of it has happened. But what has happened instead is that banks and fintechs have emerged to need each other. And I think for we originally saw one model where there were fintechs that needed a bank, and we had a group of banks that were partnering with them as a specialty. But I think what has really changed more recently is a growing realization that banks, particularly smaller banks, need the fintech too. And the community bank model, United States, as everyone here knows, probably is unique in having 4,000 banks and 5,000 credit unions, so 9,000 depository institutions. And I'll just try to be controversial maybe and say I think there's a lot of concern that the smaller bank model will not be viable going forward unless banks can do two things. Number one, develop a new business model, and these bank fintech partnerships are an opportunity to do that. A lot of the traditional business model has been eroded. And then secondly, they have to get good technology, don't they? They have to be competitive on technology. They're not going to invent it for themselves. They're not going to get everything they need from their core provider. So they're going to have to be facile in partnering. So we've seen everything from banking as a service, so-called. I don't love that term, but banks specializing in this field, to all kinds of variations on partnering and vendor models, and also reg tech services that are really important, and a big challenge around how to deal with the emerging risks in those relationships, because they are real. There's no doubt, even for fans of banks and fintechs working together, there's no question that when you have very small banks trying to work with fintech partners that, I know we're going to talk more about this as we go, but fintech partners that may, massively be larger than the fintech is, the little bank may or may not have the controls in place. So we're in this together, I think, trying to figure out how to ameliorate those risks and keep things working.
And just question for the panel generally. You talked about this. What are we seeing in terms of the actual kind of everyday consumer impact?
Yeah, I'll take this one. I would just say first, I echo a lot of what Joanne said. I think you can think of over the last 5 to 10 years as really, in some sense, an experimentation in how banks can work with third-party partners to innovate, to be able to reach new communities of users. And I think it's starting to see different kinds of models emerge. In terms of benefits, I got into the industry with a focus on social impact and CDFIs, community development financial institutions. And when I think about the value to customers today, I think not just now about can they access banking services, but really can they access high quality banking services in convenient ways and get the context behind their money to be able to make the kinds of financial decisions they need to make in their everyday lives. And I do think as we get more variety and as we get more context added into the financial experience for customers, a lot of those benefits can be realized in partnership between banks and technology companies.
Thank you, really helpful. And Joanne, you did touch on the risk end. So Livia, I've got a question for you in regards to how the technology is actually empowering the bank fintech partnerships. And what are you seeing in terms of how technology is empowering banks to detect and manage and mitigate the inherent risks that we are seeing with bank fintech partnerships?
Thank you. So my background has always been in cross-border payments, and particularly in correspondent banking. I was part of the team that built the due diligence process around correspondent bankings at Citibank during the consent order, during the heightened de-risks. And I know that the issue of bank fintech partnerships might feel quite new, but at its core, this issue remains very, very similar from my perspective with my background. So if I put that hat on from running AML, in correspondent banking, which then became banking money service businesses, in Europe as well, kind of authorized payment institutions, electronic money institutions, we have these different licenses in Europe. The issue there is that risk between the two, that lack of trust between the two. So the reason we saw that de-risking is ultimately the correspondent bank is enacting transactions, I'm telling you things you already know, enacting transactions on behalf of consumers and corporates that they didn't onboard. So we put in place a very large program, which meant that we would do compliance to compliance calls. We would go and look at their sanction screening tools. We would do a deep dive analysis on their transaction monitoring. We would get all of the policies for their KYC. We would read them. We essentially went in and did a third-party audit, and we would get comfortable enough that the controls were in place. What that still does, that's still a very subjective analysis, though, I will say. I think you can have great policies. You can talk a very good game. I know I've been on the other side of it, and I can talk a very good game when I want to. And that doesn't mean that it's necessarily all in place, unfortunately. But it can be quite subjective. And where I see technology coming into its own right now, and companies that I think are particularly interesting are things like Sardine or Cable, and other companies that are enabling fintechs to show in real data terms what is actually lying underneath that customer base, where their risks sit, where their controls are being breached, what's the proportion of high-risk customers, what kinds of transactions are they doing, where are TM limits being breached, et cetera. And these kind of data points can actually be fed through to your partner bank in real time. I think it's great technology. I still think you need the people on the other side that are prepared to sit there and do that analysis, and you need the expertise. There's also a slight danger that we end up excluding even more legitimate payment institutions and fintechs because there is a ramp up, right? Inevitably, there's a ramp up, and we can't expect everybody to be great when they first open. Some of the best fintechs and payment firms will be subject to huge fraudulent waves in their first few weeks. Sometimes it's weakness, sometimes it's just everybody knows where to target. So we need to be careful with its application, and we need to make sure that the nuances and the people on the other side of that are expertise enough to do the proper analysis to work with those fintechs and work with those payments. That human relationship is still very important. But pieces of technology that can enable the payment provider, be it the correspondent bank or equivalent, mostly the bank, to see what's actually going on under the hood in objective terms, I think could really transform that relationship. And if you are maintaining your controls and you have a strong platform, then that should protect you from possible de-risking, for example.
That's really helpful. I know that, as these services, as they, as they get bigger and as they're more used, we have to talk about the risk and how we deal with it. And, with risk comes the eye of the regulators. So we are seeing now, and we saw at 5 a.m. this morning, that the regulators are turning their eye to these services and these products and how they're managed. And, we've seen in the past with the 2008 crisis and beyond, there's, I think, naturally, an eye towards looking at something that's new and how it's going to work and how we need to be prepared for it. So, Delicia, from your perspective at Consumer Reports, with all the regulations that are coming up, the RFIs coming down, the additional guidance and the questions coming from our regulators, how do you see these developments impacting, the consumer's ability to navigate the system and benefit from it?
Yeah, sure. So I'll start with the consumer experience first, because that's where we come at these various technologies, primarily through looking at the standalone apps, what do they do, what are the policies, what are the practices, and then going through the user flows and onboardings to see what happens from a consumer perspective. And so while you see great differentiation, streamline everything, facilitating faster and more convenient and secure movement of money, I think where, recent regulatory proposals come in, they're trying to address the gaps. And some of the gaps that we see kind of categorically is confusion between where the fintech starts and the partner bank and who holds responsibility. We saw that most recently with Synapse. And technology, unfortunately, hasn't solved for that. It has provided new revenue streams and new conveniences, even added security. But if your underlying funds are secure based on being located in an app, we've got bigger problems. Consumers do. So in terms of proposals on the market, regulatory proposals that we are paying attention to, I think there are three critical gaps. As I mentioned, consumer confusion, re-deposits. We are paying close attention to the FDIC's branding rule. We think that's important. We saw this a couple of years ago when we first examined P2P apps, and folks thought and even responded to us, say, well, why is that even important? I think a couple of years later, we now know the importance of being able to recover your funds or account reconciliation. We have seen that play out. So this is very important. And we think the proposal potentially could go further. Additionally, we're paying attention to, that, again, going back to that gap, inconsistent oversight of the consumer protections that come with use of these fintech provided services, as well as oversight of the bank partner relationship. And so, the CFPB's larger participant rule is something that we've been paying attention to and have commented on, and think is super meaningful and will translate to the consumer experience. Many standalone apps, Venmo, Cash App, et cetera, will now receive direct supervision, and perhaps that this can translate into some of the transparency issues that we have identified, some of the places where consumers get stuck, such as dispute resolution. Similarly, looking at the Fed's novel activity supervision program. These partnerships, though important, because they completely support Joanne's perspective in providing access and, frankly, making technologies more accessible to more vulnerable consumers, they need closer oversight, and that is one of the gaps. And then, of course, today we have, looking forward to reading it, the CFPB's final rule on data privacy. That is crucial. We've done 4 examinations, evaluations of fintech apps to date, and in each and every one of those, consumers' ability to access their data, control their data, pull it back, make requests, get direct information, it has not kept up with the pace of technology and the facilities that are available to actually meaningful control this data. So really looking forward to looking more closely at the final rule and seeing what we can expect to come for consumers in terms of competition and ability to move if they want to.
That's great. I'm sure many people in this room are ready to dive into that, and I'm sure there's lots of emails going around. And to this point about regulatory movements, because we're in this space now where we see that there are states like California, New York, and others that are have moved forward with their privacy rules or other pieces. We see that the CFPB is in the past 5 years has ramped up using authorities, some called dormant authorities on non-bank supervision. What would the panel say, just building on Delicia's great comments on, what you'd recommend or what you'd like to, further see out of institutions like the Bureau? We do see that the Fed has worked their NASP program. We know the OCC is moving, and we just heard from the comptroller today. What would you say, probably needs to be further examined in terms of keeping up with the non-bank presence?
I think, if I could comment, I think I've hopefully understood the question correctly. So the organization I work for has a state charter in Connecticut. And the combination of the dual banking system and the ability of the states to legislate for themselves and regulate for themselves. Love the US, your system's great. This is really complicated if you're not coming from the US. I think you have so much opportunity here, and you guys have done amazing things coming from outside the US, the dual banking system, and the states not necessarily always agreeing with one another. Am I being very British? Not always agreeing with one another on standards has made it tricky.
To put it nicely.
I'm really trying to engage with that market. And I think, an example for us being we're a Tier 3 applicant for Fed Master. We're very hopeful, and there's a beautiful system in place with the dual banking system where we could go and get our state charter from Connecticut, an uninsured banking charter, innovative banking charter, and still hopefully get access to the Fed system. And I know that there was discussions, Nellie Lang spoke, was it last week before, around a nationwide fintech payments charter, moving in that direction where there is a little bit more uniformity around what you can expect in different states. So even as an uninsured bank with an innovative charter in the innovative banking charter in Connecticut, there's no reciprocity, for example, in California. So things like that, I think, for some of our fintech partners, but also for people in a similar situation to us, it would be really interesting to see how this progresses. And I think that the fintech payment firms are behind a lot of this push in the US. That's the impression that I'm getting, to bring about a little bit more of that uniformity and a little bit more of a level playing field across the board, which I think will really enable the modernization of payments and finance in the US. But I will say I'm saying that as a newbie and an outsider who's just coming in. So apologies if I've said anything inappropriate.
That's fine.
I would add that the space does need more clarity. I'm very sympathetic to the regulators. I'm a former deputy controller of the currency. I'm sure we have a lot of regulators in the room. They have a really hard job here. They have to get it right. They have to be deliberative and careful. But there's a crying need for more understanding by people of goodwill in the industry, both the banks and the fintech firms, trying to figure out what is it exactly that we should do. Are we beginning to emerge some models or best practices or requirements and standards? I would like to say my organization, AIR, is going to put on a tech sprint on this topic in the first quarter, end of February next year, and try to bring all the participants to the table and look at where the gaps are, especially in the information that's needed to manage the risk. And we know we've got certain types of risks. We've got risks to the bank. We've got risks to the customer's funds. We've got risks to the customer's data. We've got BSA, AML risks, and so on. What are the data that are needed to manage those risks, and who should be monitoring them? The great thing about fintech firms is that they're tech firms, and they are able to produce data. And we should just figure out what's the data that's needed, who should be looking at it, what's expected in terms of good management standards, and clarify that. And then also, I hate to say this to the regulators, but I think they're going to have to work on trying to figure out how to be agile, and in the sense of put something out that people can follow, and if you need to refine it later, refine it later. But it's going to be a moving target for a long time in everything about technology. And I think we need a regulatory model that can keep evolving. Not easy.
Exactly. That's someone else's job, not mine. I'm just here to comment on what they do. So we're talking about looking forward. I think this is a good point in this conversation. So Alex, I'm gonna pick on you. You've been a little quiet. So how looking towards the future, what type of policy decisions today, either in existence or in your very intelligent mind, would you like to talk about in terms of what can really shape in a good way, like shape the future for not only consumers, but the banking institution as a whole?
Yeah, absolutely. Thank you. Yeah, I think before answering the question, I would just kind of point out where we are today, taking a step back. If you look at, just the number of large banks in the country has continued to grow for the last 20 years. We've seen a continued steady decline in the community banking space in terms of the number of community banks. If you look at the data on GDP growth relative to bank asset growth, what you see is a stunning correlation between the GDP growth in the post-internet era and the growth in large bank asset size. And I think we really have a choice in that we're at a very pivotal moment in the U.S. financial services industry, where we, in a sense, have somewhat of a choice about the extent to which we enable, encourage, and help smaller and mid-sized banks be able to evolve to meet the needs that customers increasingly have and the preferences that they're displaying around how and what they consume in terms of financial services. I do think, just in the interest of being provocative, like Joanne, I do think that we are at a moment where if we don't take steps to modernize our approach to the regulation and supervision of banks and the companies that they work with, that we may be left in 10, 15, 20 years with a banking industry that does not really have very many smaller digital banks. And I think like that may be an outcome that we're okay with. It may be one we're not okay with. But like if you look at the trend lines, like that's the direction in any way, that's the direction I see it going. If we don't take steps along the lines that we've been talking about today to kind of rethink our approach to how we regulate and supervise banks in the country. And so like there's definitely the risk management is a critically important topic. There's a lot of effort that's going into it. It's very, very welcome. I do think there's this hidden risk that we're just not focused on very much, which is the risk of status quo and inaction. And I do think like in the absence of allowing banks to continue to evolve, to meet those customers' needs, we're gonna end up in a situation where it'll be mostly the largest banks that are able to serve customers digitally. There will of course be exceptions, but it'll be mostly the larger and mid-sized and larger banks that are able to serve them.
Well, I think there's a day coming up in a couple of weeks that'll set the tone on who makes decisions next, but we won't go there today. I'm going to take moderator's choice. We have a couple minutes left in honor of my favorite season of the year, which is spooky season. I'm going to give everybody a magic wand. And in just a couple of minutes per person in the panel, if you could wave your magic wand right now, what would the financial system look like for bank fintech partnerships? I'll start with you, Delicia.
Sure. I mean, building off of what Alex said, I think we're approaching a point where if regulators don't have the ability to really sort of look forward, set standards, and create the space to really think about how fast technology is moving and keep a pace with it, that in and of itself is a systemic vulnerability. And so we all need to work together to figure that out. We've been seeing that. 2 years ago, we looked at payment apps. 2 years later, they're very different. Some of the things that we were asking for then are now in place. So that magic wand would look like, if we waved it, would involve deep partnerships across sectors to really leverage the technology to facilitate consumer protection. It is unacceptable in this moment that we are able to have money move in real time, right? But the consumer can't reconcile or find or ensure their money is secure in as real time. And how can these partnerships across sectors help to facilitate that?
Great. Joanne?
If I had a magic wand, I would want to have two things happen. One is I would want to see the whole financial system and the regulatory system shift to high transparency through data and AI. What we're doing with risk management is we're looking for risk, and it's hard to find it because it's hidden in all these different pools of information that we can't put together, we can't access. We can fix that. We can get to the point where the regulators and the industry too can get the information that we need, and we could also level the playing field from a regulatory standpoint between the banks and the fintechs if we got everybody doing a digital regulatory reporting type of approach that was efficient and effective. Secondly, I would equip the consumer with an AI agent, AI assistant.
Way to drop the AI in 3 minutes to go.
And I would let her or him use the AI to help manage our financial lives, choose products, notice when something's got tricky terms and hidden fees, manage day to day, but also help you save, and all the things that people find hard about our financial lives. And I would optimize those. I would require that AIs of this kind be optimized to be solely focused on the consumer's best interest.
Oh, we need so much time today. Alex, and a couple minutes left for both of you.
I'll be quick. I agree with a lot of Joanne said, and it's hard to go after Joanne on these points. But I think, for me, it would be a diverse and vibrant banking system where banks have access to the technology that they need to be able to compete with one another and where the banks that ultimately, and the players in the space that ultimately win are those that have the best customer service and the best quality of execution, and aren't kind of hamstrung by access to outdated technology that doesn't enable them to have the kind of transparency that's needed to help promote consumer protection and regulatory oversight. So that'll be great.
I think that's a great vision. I'm totally with you on that vision. If I had a magic wand to create the financial industry that we want, and if I was to wave a magic wand, I think one way of getting there would be to do what we can to remove the panic. So if we have a kind of regulatory response or a public response to something, we were jokingly saying outside, we're talking about something a bit different, which is, again, kind of already achieved in the EU and is going to be new here. But I jokingly said, and I've said this at a conference before, it got far more likes than anything I actually said on the content, but we need to do a bit of a kind of Taylor Swift, and you just need to calm down a minute. And sometimes we panic and we look at we see new technology or we see a new entrant and we think, oh my God, it's brand new and we don't know what to do and it's a huge risk. Actually, if you look at the actual risk of what's going on, the nature of the relationship, the services being offered, very little is that new in terms of the dynamic and the risk that we've seen before. We can take it back to correspondent banking, we can take it back to intermediaries, and if we just remove the panic a minute, look at the actual risk, you'll probably find that we've got the technology and the regulation already in place for 70, 80%, might even being conservative. New technology coming along does bring risks, it also brings a huge amount of possibility, to Joanne's point. So if we could just back off, oh my gosh, this is new, take a breath and say, okay, where is the risk new? Who are the new players? And how can we leverage what we already have to just fill that additional delta? We may actually find we can go to market a lot quicker, we can deal with regulatory issues a lot quicker, because that initial panic, regulation will always take time, lawmaking will always take time, but that initial panic just introduces months of lag into the system, and we could be moving along a lot quicker whilst being very aware and mindful of the risk that is in place. 20 years in AML, I'm all for managing risk, but we just need to do it quicker.
Well, thank you. I'm getting the hook. This was a great discussion. Went by too fast, but please give another round of applause to this panel. This is a great discussion.
Good morning, DC Fintech. It's great to be here. We're super excited. We are here to talk about the new anatomy of blockchain-based services, or should I say the coming of age of an industry that has been going through the hardships and prejudices of an ugly duckling or the Beauty and the Beast. So hopefully, finally, are we now here ready to see it come of age and come into its full beauty and potential. So there's definitely a positive buzz, I think, in the space that we have been seeing. The new features and innovations of the blockchain-based services are definitely challenging the way of how financial systems work, I think. And we're seeing traditional players or the grown-ups in the room paying attention, listening, finally. And we're seeing regulators and also international organizations such as the BIS who are coming in and listening to the ideas and getting engaged. So finally, questions evolving such as disintermediation, tokenization, interoperability, questions of identity or privacy solutions are being discussed and no longer just kind of pushed away as new technology, as we've just heard. Regulatory certainty is growing in certain places, probably a little bit faster than in others, but we'll get to that. And hopefully, finally, now we see a a place where innovative business ideas can grow and evolve. So here, to discuss this with me and to shine a spotlight on the beautiful technology that is blockchain, and to discuss how modern and transparent applications can be built on that, are Shaylee Adinolfi, Head of Business Development at Trust Machine and former Head of Business Development at MetaMask, sorry, and Director of Strategic Sales for Consensus. Patrick Merck, CEO of Surus and Principal at Plural VC. Johnny Ranch, Web3 and FinTech entrepreneur and former CFO of Tradable. And finally, Simon Taylor, the Head of Content and Strategy at Sardine, founder of FinTech Brain Food, host of the wonderful Tokenized podcast that I have been binging happily throughout the summer, and the former head of crypto R&D at Barclays. So let me start with a very open question. Johnny, you've spearheaded quite a few blockchain-based projects, I think, in your time. And in your next quest, what are you most excited about in this space? And what's the next killer app you're going to build?
Well, I think just like everybody in this room, I'm probably just trying to hang out with Chris Brummer a little bit more to start. No, I think the big theme that I really like is the user experience in blockchain getting a lot better. At Tradable, we built software for asset management platforms where they could deploy their strategy on chain efficiently, securely, and without adding any additional compliance risk to the workflow. And we abstracted away the on-chain experience for them. I think we're going to see a lot more of that. I also think, since I was on this stage last year, BlackRock released BUIDL, their money market fund product, which through various distribution channels is really cool. Now almost anybody in the world has access to that money market fund product. Transactions have also gotten a lot cheaper on Ethereum. So that as a user experience is already very notable. And what I'm in particular researching is digitally native yield and yield products, kind of like what the staking yield did for Ethereum, creating a risk-free rate. Like, how do we move off of the risk-free rate on things like Ethereum? So that's one area that I'm researching. And how do we do it in a way that, again, a consumer, your end user, can interact with without having to use like a paper wallet or having to send funds through DeFi in a way that's really, really scary.
Wow, that's, definitely interesting. Yield and liquidity going together. So two of the big questions that are there. Shaylee, maybe coming to you. Trust Machines builds, and I quote, wants to build the largest ecosystem of Bitcoin applications to maximize the value of the Bitcoin network. So can you tell us a little bit where you see those opportunities? Now in particular, it is Bitcoin that is adding the value here.
Yeah, so in the past 2 years, the Bitcoin kind of maxi culture has changed, and a lot of builders are coming to the space to build layer 2 solutions for scalability, for programmability, for payments, and there are over 100 layer 2s on Bitcoin today, and some of them have been around for 10 years in the making and are going through protocol upgrades to get to that really scalable level. And so right now, we are seeing an emergence of consumer-facing applications for decentralized finance emerge in the Bitcoin space, which is great. The things that you saw in Ethereum and Solana are coming to Bitcoin. And the reason why is because Bitcoin is over $1 trillion in market cap, and builders want to unlock that capital and let it flourish within decentralized finance. The institutions are already here in the Bitcoin space, but now I think retail is coming, and they're not all gonna go through custodial solutions. We're seeing growth in the self-custody space. I worked at MetaMask, which is one of the largest self-custodial wallets globally, and Trust Machines has a wallet called Lether, which is a self-custody solution for Bitcoin and Bitcoin layer 2s. So we support things like ordinals, runes, stacks. These are all layer 2s. Stacks is a layer 2 with already 3 billion market cap and a flourishing ecosystem that's growing. And so we're very excited about this work that we're doing.
Thank you. That's super interesting. And good to see that Bitcoin is moving a little bit away of the store of value that it's been for so long. So also coming of age. Excellent. Patrick, Sure's has set itself the mission of accelerating and improving the on-chain financial ecosystem through intermediation and tokenization. How are you going?
Yeah. So for us, our mission is to have any asset available to anybody, anytime, anywhere, right? Now that's a pretty ambitious goal, and like there are obviously, a lot of challenges in getting there from here to there. But the way we're going to do that is through tokenization. I'm sure Simon will have a lot to say about that as well. And so while I've spent most of my career on the side of, decentralized distributed systems and self-custody and things like that, in this venture, our goal is to actually take real assets that are found, I don't want to say real world assets because I don't know what a fake world asset is, but real assets that we know, everyday assets that aren't natively on chain, and move them on chain. And so we're using both our platform, and we are in the process of chartering a trust bank to be able to hold those assets and publish them on chain. The biggest challenge that I've found in real world assets, or real assets, however we want to call them, and tokenization generally, is that the structures behind them are opaque and fragmented. There aren't any regulated financial institutions that are really, really supporting this right now. And there's a lack of liquidity. And those things are all interwoven. And so we're trying to unlock all three of those things at the same time. And in particular, coming up with clear, transparent legal structures so that when you buy a token, you know exactly what you're getting. Mm-hmm. And there's a segregation of duties between the parties so that the issuer and the custodian aren't the same person.
Yeah, you're certainly solving for a lot of things at the same time. That's impressive.
Well, you got to be ambitious. You can't raise money not being ambitious.
Away,
Yeah, exactly.
Good. So on the digital native asset side, we've heard a lot. Simon, maybe coming amongst others, also a little bit from the traditional role of or the crossroads between technology and traditional financial services. Traditional players have been confronted with new technology again and again and again. How are they dealing, or how has their dealing with blockchain evolved over the past 12 months?
Well, there's no longer one guy inside the bank agitating, saying, hey, we should do this. Now it's actually serious things with serious budgets. The Bank of International Settlements has done some incredible work on tokenization. Shout out to those guys, as have many other of their global peers. And I think the subject has really moved forward. On stage just before us was Livia Benesti, and she was too modest to probably tell everybody, but Banking Circle is one of the first banks in the world to hold a stablecoin, to issue its own stablecoin under the MiCA regulation. This is a transformation in what we can do with payments. So before I was in the crypto guy at Barclays, I worked in payments. I was delivering SEPA, Target 2, I was faster payments upgrades. I was living the dream, let me tell you. And before that, it was the card networks. Payments get stuck. Payments don't work over the weekend. Payments have office hours. They're not 24/7. They're not global. They're not instant. And there are some reasons why we might want to slow them down. Scams, hacks, fraud. That's why I work for Sardine. That's what we prevent. We do a very good job of it. You should check us out. However, if we're going to get to that dream, I don't think it's just going to be new issuers that come to market and back it with a narrow banking structure. So Tether, who are going to be speaking later, mostly hold treasuries in the back end. Circle, mostly hold treasuries. Depository trusts, fantastic way to tokenize things. Clear regulation, very high trust. We understand what that is. A financial institution like a bank, very high level of trust. I am excited because I think stablecoins are the first taxi off the rank where consumers and businesses genuinely get access to a US dollar rail that is global 24/7, instant and programmable. And just yesterday, the news broke that Stripe has acquired a company called Bridge. We will look back on that in 10 years as one of the most significant moments in financial services ever. Yes, I'm excited.
Good. I can feel it. And in terms of, so we have the traditional players really getting excited, focusing on payments, and then we have the digital natives looking to maybe also like building outside of that mindset of payments work like this. These are
the silos have gone, right? What's interesting about...
How do we...
So what's interesting is you're already seeing things being built with where BIDL is real-time exchangeable for stablecoins, and you're sort of getting that instant 24/7 liquidity between USDC and a money market fund. So if you want to move in and out of them, you can do that. And I think it's that remixing that's getting exciting. Johnny, I don't know.
I think you'll start to see like BIDL and yield coins being accepted just in the same way as stable coins too.
Yes.
So if you're always having money at work because you're holding an underlying yield token, and let's say you want to invest in a fund strategy, or basically like your transacting account and your savings account might look a lot like the same thing to optimize your yield. And that's going to get remixed a lot too.
Which, for corporate treasurers, sounds familiar, but it's not for everybody else.
So in decentralized finance, what we're excited about in the Bitcoin space is that not one of the major stables is on a Bitcoin layer 2 yet. Okay, so that's, but there are like 8 or 9 building across the layer 2s. So, but they will come. They are in the process. The bridges are being built. The swaps are happening now. The decentralized exchanges are there. So this whole ecosystem is growing, and the cool thing is that we're actually building a protocol that is a Bitcoin liquidity protocol where you can borrow against your Bitcoin and keep all your transactions on chain, so you can swap for stables, and
it's like one of the biggest pain points that the maxis cite is they don't want to sell Bitcoin.
Exactly.
But they want to be able to transact still.
So that's going to be, we're just getting started. It's weird to say that after, over 15 years of Bitcoin, we're just getting started, but literally we're at the beginning.
It actually makes a lot of sense to me that it would take that long. I mean, I would hope that it wouldn't, but it doesn't surprise me. The analogy I often used was when fiber was rolled out across the country in the late 90s. You had WorldCom and Global Crossing, and they all went bust, right, in the dot-com bubble. But you needed that dot-com bubble. You needed all that waste of money and infrastructure building to lay the foundation for, fast forward a few years. And that used to be called dark fiber because nobody would use it. It was just like laid fallow across the Atlantic or even across the country. And then Google comes in and buys up a lot of it, and so do AT&T and Verizon, et cetera. And then once you get to data centers like AWS, all of a sudden that fiber gets lit up, and you found a use for all that infrastructure that was being built 15 years ago. Maybe it wasn't quite 15, but you get the idea. And I think that's what's happening in the blockchain space. And I think we're right at that moment right now, not at the moment of laying the fiber, but at the moment of lighting up the fiber.
And I think a lot of folks look at the traditional financial institutions and say, when will they be there? Well, there's billions and trillions of dollars that they're trading in various POCs and in notional value across things like the Canton network today, but nobody talks about it. The TradFi is there, it's live. The Onyx network from JP Morgan has been around for several years now, tokenizing all kinds of assets. That has been around.
Trillions too.
Yes, it is in the trillions. But what's really started to happen now is this sort of crossover, where the traditional financial institutions are using the new rails and feeling like they can do so in an appropriate and safe and sound manner. And that's slower starting, but you've also got financial institutions that were born as part of this digital native boom that are every bit as credible and regulated as anybody else in the industry that I would have come from. The Coinbases of the world, and there are many others, and now the Fireblockses of the world, and there are many others, the Anchorages of the world, and there are many others, are now starting to really partner with TradFi financial institutions. So the idea that this space is unregulated or unsafe is frankly untrue. There is still a Wild West. It's still there. You can go see weird stuff in crypto if you want, and there will always be a weird frontier. But if you ignore that and focus on where business is to be done, there's a lot to be done.
Also, like back to stables, like stable coins, I think uniquely would have prevented the Synapse Fi thing from happening.
Yeah.
So I think there are applications of the tech that actually work way better than the more traditional ways that people kind of cling to. And
Yeah, I was going to say, sorry to jump in, but
please.
Last I checked, all these experiments that BIS and the banks and everyone's doing are on permissioned chains, right? Still that custody. But imagine if they were to do it on public rails. I mean, it's going to be a long time. But what JP Onyx is
it's
still
Ethereum-based.
But it's not, it's a permissioned.
Correct, but the flip is, so Societas Generales sort of token, EuroCV, is available on Solana, it's available on Ethereum, and when there's an L2 for Bitcoin, I'm sure they would, when there are more stables there, they'll join that too. It's liquidity begets liquidity, and that's sort of starting to warm up. And there's a cold start problem with liquidity, but it's also a runaway freight train. Once it gets moving, it really gets moving, because what does liquidity want? It wants 24/7 global and instant. And if you can build that and you can do that in a regulated way, and you are one of the earlier movers, then market share is cheap when markets are small. So this is a great time to be building.
So it sounds like the teenager is slowly growing up. The mums and dads are talking to him. We're having like a proper conversation and moving things forward together. Let's address the elephant in the room. Where are the superintendents of the school, namely the regulators, sitting with this? How are your experiences in building? What are the requests? I mean, we're seeing, the BIS is doing fantastic things. Regulators globally are engaged. We're seeing a lot of sandbox initiatives that, they're pretty big sandboxes. How is that? Is that slowly coming and trickling down, or what would be a wish list of the teenager in terms of regulations? Where would you like to be able to get the tattoos? What are your?
I view the lack of regulation and sort of a clear set of guidelines on regulation just as disadvantaging us in the U.S. And we are seeing great projects move offshore for that reason, because Dubai has a framework for DAOs, so does Switzerland. Singapore has been very proactive in providing guidance on how DeFi can operate there. And I think we'll catch up, but we're going to have to play catch up. So I think the biggest risk is that however long that takes, we just lose talent, we lose innovation.
Zodia Markets by Standard Chartered is custodying crypto. BNY and State Street and many others do, but typically it's out of Hong Kong or Singapore. Yeah. Why? Because there's a regulatory framework. So that capital is sitting offshore. The institutions may be names you recognize, but the value and the economic activity is not accruing in the United States.
Even BIDL's an offshore project.
So do you want to push this activity offshore? Do you want for it to continually disappear outside of your regulatory purview? Or do you want to start to finally unfreeze that? I am optimistic we will get there. Whichever way the election plays out, and I'm not going to go down that road, I do think that we will start to see final movement. We got very close very recently on passing some legislation. I think we know what the answers are on regulation. I think there's been a lot of good work done by supervisors to start to understand what the risks are over the last 4 or 5 years through Global Digital Finance, one of my non-profit hats that I wear. I see that conversation amongst the technical staff being at a really high level. So I don't think it's that people don't understand, it's just not quite hard to get things over the line sometimes. And in the private sector, we have to help do that. We have to solve the material risks as best we can and be thoughtful about that engagement. I remember early in my job at Barclays, somebody said to me, there's no upside to a meeting with a regulator because the best case is you walk out and you still got your job. And the more time passes, the more I realize how wrong that was. I actually think the opposite is true. There is no downside to more long-term, thoughtful, proactive engagement. And the more we can do that as an industry, I think the more we'll succeed. So I'm hopeful we'll get there.
So every year I come here and I speak and I say the same thing, which is that it's a two-way street, right? It goes both ways. For the industry, getting engaged and like actually stating clearly and actually building responsible practices that you can point to and demonstrate that these things work and that we have thought of the risk and we are mitigating the risk in this appropriate way, or we've identified a risk and there isn't a technical solution and so we need a regulatory solution. Come to the table and help us. On the other hand, from the regulatory side in the US, I'll quote my good friend Gary, who used to tell me, Gary Gensler, who used to tell me, first you ignore it, then you integrate it, then you regulate it, right? But it feels like in the US we skipped over that integrate step and went straight from ignore it to regulate it. And there's a lot of lessons to be learned in trying to integrate these systems into the existing regulatory framework first. And I don't mean like round peg in a circular hole, right? But like, I mean like when the SEC refuses to let a token registration go through, right? Like when they won't publish guidelines for how to do that, that's not really integrating it into the current regulatory framework, and that becomes a challenge for everybody. And then you end up in the position we've been where it's just everybody gets angry and like things happen, right? But I would also say that, you know, I've been in the space as a lawyer for longer than I'd like to admit. I think we're on 13 or 14 years now, right? And for the entire duration of that time, if somebody asked me what securities laws are going to look like a year from now, I would say exactly as they've looked like for the last 80 years, right? Like nothing's going to change. It's still going to be the same framework. And I used to advise clients the same. This is the first time where if I have to project out a year from now, I actually don't know what securities law framework is going to apply in the US anymore to this space. I think it's totally up in the air, and I agree with you that it doesn't matter how the election goes. In either case, we're going to see a sea change.
That sounds very promising for
well, it could be promising or not, right? I mean, actually, promising to whom, you know?
As we're moving toward graduation. Yeah. Shaylee, maybe just a couple of thoughts. What do you think? How is this, is the market structure really, are we really at this forefront of the dawn of a new era of blockchain right now?
I don't know. Maybe. Like the crypto industry has certainly put a lot of money into this election cycle, and like regulation by enforcement has been awful to watch. Mm-hmm. It feels hostile. So I'm not the lawyer in the room, and I will speak my mind. It is not a fun environment to operate in. And thankfully, we operate in a very like self-custodial, decentralized environment. But there are some decentralized applications that are integrated with our wallet that are not available. They have clear, like, you know, check boxes that you are not a U.S. citizen. You know, they're just not available. And we've seen a lot of companies in the ecosystem set up shop abroad, like you all mentioned. So even when we're marketing, we don't know. Could we say the word yield in this specific instant? Could we not? Is that going to look bad? It's really not a good time, to take things to market, because there is a gray area. It's not, it's just, it's not a good feeling.
It's like a bad landlord sort of thing. Like, you never know when the fee's coming. They're changing the day the rent's coming, and you don't know where the gotcha's coming from. And that's not the start of a productive conversation.
Yeah, it feels like there's been some reverberations, for the bad kid in the room. And
Well,
we're all feeling it.
not the bad kid in the room. The crypto darlings of the world, Uniswap, Consensus, Coinbase, they've all been OpenSea. They have done their best, I would say, to comply. They have had these conversations for 5-6 years. I've been a part of these conversations. It's not okay to roll by enforcement. That's.
No, very well said. I think there's still a lot of energy that needs to be let out, and that we can move forward with in hopefully bringing this blockchain fairy tale and the coming of age to a happy ending. It looks like hopefully that we'll be having completely different conversations, hopefully already in 12 months' time on this stage. So any last words before we're kicked off with lovely music?
Well, aside from go subscribe to the Tokenized podcast if you want to hear more, I think the only thing I would leave you with is if you know anybody that's still suffering under the illusion of it's all FTX and Terra Luna and it's all going to go away eventually, that is the most misguided view in the world. And that actually this stuff is not going away. If anything, it's getting more credible, it's getting grown up, it's getting a job, it's getting serious. It's time for anybody who is not already serious to do exactly the same thing and engage with it.
Yeah, and go for it. Go for it. I was just going to say, and it's getting a lot easier to use. Like the idea of having a browser wallet as an extension, that's going to seem crazy to us. I mean, when Patrick and I first met, we had paper wallets, which anybody know what that is? I hope not. But it's gotten a lot better. It's going to get a lot better. And as the regulation is kind of intertwined with that experience, it'll just make it easier to build wealth.
It'll just feel like moving money, but better.
Correct.
So I would just say, and I've been saying it again for, I don't want to say how many years, but I'm a simple guy. I like just simple rubrics. And for me in this space, it's regulation follows trust, right? If I have to trust you with something, you probably are regulated, and if you aren't, you probably should be regulated. And so when we build these new systems, we should keep that in the back of our head. Either build something that's totally disintermediated, totally decentralized and self-custody, where you don't have to trust anybody but yourself, or if you're going to build something where trust is required, at those points where trust is required, you should find the regulation that suits you, and you should wrap your arms around it and have those proactive conversations so that you can do the business you want to do and offer the services you want to offer that there's demand for.
Good. Okay, our time is up. We're just getting warmed up, but I think Chris has some words for us. Thank you very much for listening to us.
As everyone, we're going to take a quick break. One of the great things about this conference is that they are not shy, and that we get everyone from across the industry and perspective, as well as the regulators, together in one roof. Which brings me up to just 10 quick minute breaks for everyone to go and get refreshed. We'll be back with a blockbuster sort of morning finale with the technology and the future of jobs for AI. I know a lot of people are very interested in this. Representative French Hill, a conversation on inclusion in housing, and the CEO of Tether. So you'll want to see a lot of news-making conversations. Okay, I'll see you in 10 minutes. We're going to jump right into our next panel on technology and the future of jobs. It is obvious that technology is both an enabling and disruptive force, and I have some of the best people in the world to, frankly, have this conversation and teach me a thing or two. So I want to welcome Karen Kimbrough, the Chief Economist of LinkedIn, Yazid Al-Nafshan, the Deputy Governor for FinTech for the Saudi Central Bank, Mark Palem, the Chief Economist of Fannie Mae, and Kate Jensen, the Head of Revenue for Anthropic. I wanted to welcome you all to the stage. Thanks. So when gearing up for a conversation on AI, it's always interesting. It's also interesting to know who is thinking about AI. And so, Mark, I want to start with you in the middle first, particularly as the chief economist for Fannie Mae. Why and how and in what way do you care as an economist about AI?
So I care for many reasons, but the first ones are, from the macro perspective, productivity gains is the key to growth, and growth solves a lot of social problems and fiscal problems. Number two, as a housing economist and a mortgage economist, I'm really interested to see how our lenders are adopting these technologies. And as I meet with lenders and we survey them, it's pretty breathtaking in terms of how many of them are trying them, the areas they're trying them, and the success they're having in adopting them. And then the third thing is, of course, I care about labor markets and what the impact is on labor markets.
Just as a follow-up, so when you talk to people, I mean, as an economist, I usually think of a CTO talking about AI, right? But as an economist talking about AI, how does that actually sort of work?
So it works very naturally because economists, we're very interested in technology. Inventions are awesome. We love to go online, play with new tools like everybody else. But what we really want to know is how is it being adopted in a commercial environment in a mature industry, right? And finance is a mature, highly regulated, capital-intensive industry. And it's just, you want to talk to people about how is it being integrated in the existing processes to improve quality and efficiency.
Okay, so Yazid, let's actually take it from there, right? When you look at AI, how do you sort of either predict or what are you assessing in terms of the business models or functions within financial services that are most likely to be disrupted? And for that matter, what does even disruption mean?
Thank you so much. First of all, good morning, everyone, and thank you for the invite. It's been an interesting week in DC, very busy. So when we talk about AI and the applications of AI within the financial services, it is not something new, right? The financial services, given its highly regulated sector, very data dependent, and because in an intermediary role, we have our different player incorporated AI in different aspects. Think of hedge funds and passive funds when it comes to fixed income, especially given the complexity of constructing a passive income portfolio. Think of high-frequency trading, for better or for worse. They've utilized different forms of AI and data science and machine learning back in the years. So do we expect a disruption within those fields? It is very difficult to know. However, we understand that even when it comes to banking, there has been a disruption in the past with the internet and mobile banking and online banking and trading and all of it, which reduced the need to have branches, to have tellers, even though we still have them, because there is this financial inclusion aspect where access to artificial intelligence, access to mobile and smartphone is not available for everyone. Technology literacy is not available for everyone. So this has to be bear in mind. But when I look at a bank, which in our case, that's where the most of the work and data hosting and all of it takes place, you would expect that from a back office point of view, a lot of the processes will be automated and driven by AI. And the employees will focus more on overseeing the applications of these models, at least for the time being, because the level of development is rapid, right? It's neck-breaking. I mean, bear in mind that ChatGPT was only launched less than 2 years ago, and we're at 4.0. So, and it still has its own problems, of course, but at the policy or decision-making support tool, it is important. But also, even in middle office activities, whether you're a bank or an investment bank or any regulated industry, or any regulated, highly regulated industry, any entity within the financial services industry, which is highly regulated. You can imagine they use the combination of SupTech, RegTech solutions with AI and LLMs. It will enhance the overall competitiveness. But also an important question, and I'll keep it short, an important question that we need to consider to measure the disruption is how will it be regulated? We've seen in the past how algorithms, so Web 2.0 was left unregulated, and initially people thought it's a net positive. It encouraged democratized discussions and all access to information, and then it turns out not so much, right? We didn't have clearly policymakers across the globe, I don't mean any specific country, across the globe don't understand how algorithm works. No one really attempted to regulate it, and it ended up being used against the consumer. And in my opinion, at least my personal opinion, not my institution, it's a net negative on society. So with AI, you cannot afford to make these mistakes because the way the models are built, they're highly prone to mistakes, highly prone to biases against a specific segment of the society. It doesn't incorporate socioeconomic considerations that policymakers, governments should take in place, and doesn't really think, doesn't have the human thinking on how should you take care of the population. Just focuses on the maybe efficiency side, which is good, but it's not what we do as maybe policymaker and central banks. So I'll stop here and give it back to you.
No, I mean, what I was also taking even from that explanation is again, kind of circles back to what does disruption mean? Where I'm hearing about government and regulation as both a response to disruption, but also itself perhaps being a disruptive force and catalyzing different kinds of changes, and that is going to certainly be a matter of a lot of attention. Karen, I mean, like, you're at LinkedIn, so you're seeing, I'm sure, all kinds of fresh data in terms of what skills employers may be looking for, particularly as they're adapting to some of the changes that Yazid is mentioning. What are you seeing on the ground?
Yeah, sure. Thanks again for having me. So what I would say is, one, at LinkedIn, there's 1 billion members worldwide. So we are seeing a lot of data, 5 million updates per second on the platform. We can see what skills people have, where they went to school, what they studied, whether they're getting promoted. And we can also see what employers are looking for. They're posting jobs. What are the skills? What are the roles? What new roles are they looking for? So this is what I wanted to share with you. So one is there's a huge imbalance of supply and demand in AI skills. Currently, even on our platform, less than 0.5% of all the talent of the 1 billion people is actually what we call AI talent. And then two, we think about AI skills in 2 dimensions. One is AI expertise. This is, I built a large language model, I cleaned the data, I'm training the data, blah, blah, blah. The other is I work as a marketing manager and I'm creating content and I'm using an AI application to help me create content faster, better, and maybe do some stuff I don't feel like doing. So I can spend more time being creative and strategic. So those are 2 different dimensions of AI skills. Now you asked a question, what are we seeing? Well, one is increasingly there are a lot of employers looking for AI skills in the tech space, no surprise, the last year and a half. Maybe 80% growth in roles specifically looking for AI engineer, MLE. So we're seeing an 80% growth in job postings looking for AI talent. That's really that expertise talent. We are seeing, that's in the tech sector. Outside the tech sector, there's also a really rapid growth, but not as rapid, say 30%. So one thing is you're seeing this like diffusion across sectors of employers looking for talent. That is definitely the case. They don't have enough talent. They're starting to shop in their own closet and try to upskill a software engineer into a machine learning engineer, which is very doable. And then what we're also seeing on the other side is a lot of folks who are in roles that maybe aren't technical, but recognize they need AI literacy to succeed in their role. And so what's been interesting is to see this really quick uptake of what I would call non-technical talent that is upskilling rapidly in AI exposure. So some of the fastest growing folks who are trying to acquire AI skills, like the literacy skills, are in like content creation, marketing, sales, because they know these are the tools that are going to make them more productive more efficient. They know that's what's going to make them competitive in a labor market that is quite competitive right now for them. So I'll stop there.
Well, shifting from content creation, I guess.
And I didn't answer your question about what jobs, but you can come back to me if you want.
No. We can be.
Did my spiel?
A couple more seconds. Yeah.
Okay, 2 seconds. So one is we're definitely seeing a fast growth in AI engineer. A lot of heads of AI. That role has tripled in the last 5 years. Heads of AI. So a lot of AI specific roles, but a lot of roles increasingly that are actually just looking for AI skills, but are not AI roles. So we always say, there was a head of internet role maybe at one point, but there's no head of internet role now. There's just roles that expect you to know how to use the internet. So.
Okay, well, I'm going to go then take a quick step back because when you're talking about content creation and marketing and, content creation, I was going to make the joke, well, we create lots of things in Washington, D.C., like rules and the like, maybe not exactly the same kind of marketing. So, Kate, given the fact that we are here in Washington, D.C., where obviously many people here in the audience and watching are affiliated with government and government employees, I guess, what does AI even mean for the government and the nature of government work?
It means so much. And already on this panel in the last 8 minutes, we've mentioned underwriting, we've mentioned coding, we've mentioned sales and marketing. I'll just ask, how many of you are using AI day to day in your jobs? So already it's transforming most of our lives. And where I see the most exciting implementations of AI is actually when you're building products around it. When you're actually building products around your customers. And for the government, your customers are often the citizens of the United States. And so how can you create better policies, better programs, better user experiences to engage with all of the different things that folks are using in the government? And I think there's just so much potential there. But you're already seeing the start. Every one of you mostly raised your hands today. And using AI as part of your jobs will make all of us a whole lot more efficient.
Well, efficiency is, a term that, has I guess, pros and cons. I always sort of joke, well, what's the value of inefficiency? But certainly, when you think about the disruptive force of the technology, it's forcing people to upskill. It's forcing people to really contemplate or to even redefine what their jobs are and what their role in an organization should be or could be. When you think about both, again, jobs and the nature of work, how are you thinking about AI there? And again, some of those earlier adopters, certainly I see over at Georgetown, there are different demographics in terms of ages and points at which people are adopting things. And how do you get middle management and others to use those tools in a safe way?
Change management is so much of what we do at Anthropic. So for those of you who aren't familiar with Anthropic, we have the Claude family of models. And primarily, up until very recently, we've been an API-based business. So companies that are looking to build and develop technologies on top of LLMs. We recently just released Claude for Enterprise, which allows you to just get started and try something right away. And it's been amazing to see how having something just off the shelf to be able to use makes it much easier to change manage organizations as they're shifting into this new world of this technology. You mentioned that there are all sorts of new jobs being created. A year ago, everyone was scrambling for prompt engineers. That's still an incredibly important role, but as the models continue to get better, the need for really, really scientific prompt engineers is becoming less and less. I think the same is true for these massive centralized AI functions. Very, very helpful. But as more companies are building their products actually around the LLMs and around the technology, you're actually seeing a shift where product leaders and product managers really need to be all in on AI themselves, not just rely on a central organization. You're nodding, I'm guessing this is aligned with what you're seeing in the market too. But how will things change? I actually think this is one of the most exciting technological shifts because the technology itself can help us all to get better at the new world. I find myself using Claude every day to figure out how to use Claude better and more effectively in my own job. And And that's a whole new thing. People could use the internet to figure out how to work more effectively on the internet, but it wasn't necessarily the internet training us to do that. And this is where the technology, I think, is extra powerful and can accelerate the shift.
So, if I may, I absolutely agree with Kate. It is exciting. We've seen a level of investment in technology we haven't seen ever, I think, in the last 2 years. However, we have to be mindful that, number one, this sample group is slightly biased toward people who are tech savvy. When you take a step back and look at it from a global scale, we have around 2.5 billion people who do not have access to internet. So, and even if you look at the IMF, colleagues at the IMF are here, Marianne. So if you look at the IMF, they estimated that advanced economies have around 60–70% of the jobs can be supplemented by AI, but you look at the emerging market, it's 30–40%. So there is the divergence between emerging market and advanced economies. We need to take this into consideration. In addition, at least in the context of financial services, where I work, Saudi, by the way, we fall in literally 50% in the middle between advanced and emerging. But you need to be mindful of the demographics. So financial services tend to be sensitive. Not everyone will be comfortable with dealing with an AI. Just like not everyone is comfortable dealing with an app. They want to go to branches. So there is an emphasis on just understanding the landscape where we're operating at and the opportunities to build on, hence my cautious approach to it.
I think you're absolutely right. And actually, this is the founding reason for Anthropic. We were actually founded on the idea that you need to be able to build this technology in a way that you can trust it, where you can understand what's actually happening and actually have some guardrails around it for safety.
So, I mean, Mark, you're an economist, but that makes you sort of half an evolutionary step up from us lawyers. So, I mean, so if you're going to like put on you enjoyed that. So, if you're going to look at some of the possible regulatory responses or approaches, I mean, what comes to mind given the fact that you're sort of in between, looking obviously at a highly regulated financial services world, but you're also looking at the economics?
Sure. So a bunch of things on that topic. One of them is the two places that matter from the regulatory perspective are Brussels and the US. So you see very different approaches that are going to happen. The EU, which is kind of dominated by the intellectual influence of France, always does a top-down. Let's try to conceptualize what the risks are. The emphasis is around protecting jobs and protecting current competitors. In the US, it's dramatically different. We have the common law. You see every part of the common law, whether it's contracts, torts, copyrights. In copyrights, it's a big issue. And then we have sector-specific regulation, right? So I think in the US, it's just a generalized technology, AI. It supplements other technologies in the workplace. And we're going to go by cases, individual fact patterns, try to figure out the trade-offs, right? In finance, fair lending is a very big deal. That's not necessarily a big deal in automotive, right? So every sector is going to have to do it, and we'll work our way through it. And I just want to add one thing on the employee side. On the surveys that we've done of consumers, since I have gray hair, I have to insert this. On the surveys we've done of consumers, we've seen that older Americans actually adopt technology. Sometimes it takes a little bit longer, but if you look at the adoption of the internet or refis, boy, it's adopted across the curve. So it can take longer, but once people get comfortable with the technologies, they want omni-platform. They want to be able to call a call center. They want to be able to go online. They want to be able to chat. They want to, they want the full selection, but they adopt them.
Yeah, we have the same. I was going to jump in and say we see the same thing. We have a lot of access to data. LinkedIn is part of Microsoft, so we can see how people are adopting technology generally. And it's actually not the case that only young people want to absorb AI. There are a lot of, I think it's more of a mindset. And what we're seeing is older users are adopting at the same rate as younger users. It's really the mindset of I'm willing to play around, explore, make mistakes, get frustrated, and try again. And then the other thing I wanted to mention, just in terms of the concept of adoption and diffusion, we definitely see in our data differences in industries that are adopting AI. Some are moving much more quickly, so clearly finance and what we call professional services, like consulting and accounting, and lawyers are also adopting AI more quickly than what you might say is, believe it or not, actually manufacturing, which is doing AI, but AI, not generative AI. So we see a big range I don't know why I'm the one creating feedback. I'll try to avoid you guys. So we see a big range in terms of which industries. It's all that data. It's just resonating. We see a big range in terms of what industries are adopting the fastest. And I would say that education is one that's been really interesting because they're very quickly moving in that space, but there's a lot of disruption.
So we only have about 2 minutes, but I want to go really quickly through, with each of you. What is not being talked about when it comes to AI that should be talked about? I guess we'll start with Anthropic.
I think what's not being talked about as broadly as it could be talked about is just how prevalent it is. 6 months ago, if I had asked that question, very few people would have raised their hands actually using the technology day to day. And it's really transforming all of our roles. We talk about how there are certain sectors that are adopting it more quickly, but you really do see this technology really everywhere you look now, and it's so exciting. So I would love to just even talk more about it. It feels like we're overwhelmed with the AI news all the time, but talk more about how it's impacting each individual on a day-to-day basis as much as it is.
So it's not peak AI yet.
I don't think so. No, I'm very long AI, obviously.
All right.
Okay. So I guess I would want people to think about the elephant in the room is this going to destroy jobs? And yes, of course, there's going to be jobs that are eliminated. But if you look at agriculture, you look at manufacturing, the U.S. percentage of the workers who work in agriculture is very small. It's like 5% or less. 100 years ago, it was way higher. Those workers are highly compensated now relative to their peers in the developing world. Why? Because they have access to technology and capital. The same thing is true in manufacturing. Giving the American worker more technology, more capital to work with, protects their wages and frees up people to take care of other human needs.
For me, having the appropriate, being ready in terms of having the appropriate social safety nets, in case of these developments are very difficult to measure, but also in terms of an overall risks of using AI, we're overhyped, we're excited about the possibility, endless use cases, right, for AI, especially in finance with all of the data. However, but it also can create endless risks, right? Shatters the confidence in the financial sector and the economy, right? Bad players can use it against you, and maybe we remember we've talked about it. If we have quantum computing with LLMs, all standard cryptographies can be broken. So all of these risks have to be taken into considerations. In addition, determining liability for any error caused by the AI. I know that you're
pointing at me.
No. We use LinkedIn, by the way.
Seconds.
We use LinkedIn all the time for training.
Representative Hill. Yes.
Okay, very quickly. I would say the thing, everyone always asks me what are the new jobs emerging, but actually the big story is how all the jobs are transforming, where all of our jobs are changing. How we spend our time is going to look very different in 10 years than now.
Well, that was remarkable.
Very efficient.
All right, great. All right, well, our time is up. So that was a great, very interesting conversation. So as I sort of help you guys off stage for the moment. All right. I am extremely happy to welcome my fellow Arkansan, yes, faithful Razorbacks, Pig Suey, French Hill to the stage and to join us on screen. Representative Hill, thanks so much for taking the time for us.
Professor, great to be with you. Go Hogs.
Go Hogs. Go Hogs. All right. It runs deep. It runs deep. Okay, so I guess I'll start off with the conversation on obviously fintech and the model of the sort of fintech bank partnerships. It's been a matter of discussion here at the conference quite a bit, as you might imagine. What's your view on sort of the model of a fintech bank partnership and obviously some of the proposals coming out of our banking agencies, in particular the FDIC?
Chris, thanks for having me. Well, first of all, I think clear, concise, transparent guidance and rules are important that are equally applied across the agencies. I don't think we see that. We have the August memo from last summer from the Federal Reserve on fintech-related items that encouraging banks to go get essentially pre-approval before they do something. And then we've had the FDIC's recent guidance, and we've had recent enforcement actions, including a bank here in Arkansas. As a result of all that, the House Financial Services Committee, the Digital Asset Subcommittee that I chair, had a roundtable with regulators, excuse me, regulators and participants, banks and fintechs, and talked about the state of affairs of fintech bank partnerships. And generally, it's pretty good, but I don't think we have the clarity that we should have. And I think the agencies have lost a step in the Biden administration from the Trump administration by, for example, the FDIC doing away with its sandbox approach. And I think that's been unhelpful. I think the FDIC's recent pronouncement, some of the rules that they came forward with as an advanced notice of rulemaking are a little premature. We can talk about those maybe in more detail. And finally, I would say what's clear is that both banks and their fintech partners, and particularly if there's any middleware provider in the mix, need to make sure that they have a clear and ironclad contract about who's doing what. If you look at those recent enforcement actions, you found that some pretty obvious approaches to traditional banking and bank record keeping were not being met to a high standard. And I find that surprising because it comes naturally to banks to do that. That's why banks, as banking as a service providers, can be very effective partners. But you've got to have everyone involved in that partnership very knowledgeable about what the obligations under federal law and federal regulation are in protecting consumers and delivering a high quality consumer experience. The roundtable was very helpful to me about what was going well, what could do better. And I think we have the regulations that we need. What we need is clear, uniform, effective guidance that all the regulators are using. And I think both boards of directors and fintech owners and operators need to make sure we have clear contractual obligations about what people's responsibilities are.
What I really appreciated with that answer, and I think it's always worth the highlighting, is clarity as both literally it's a means of complying with rules, and having clarity is really the route for making sure that people know what their obligations are. This is a little bit of a quick drill since you are at really the forefront of so many conversations on the Hill. I mean, you mentioned digital assets, which we had an earlier conversation on here, and people sort of delivered their opinions and their thoughts on the state of crypto regulation. But what do you see happening, at least in the lame duck session of Congress, since again, you're so influential and so pivotal? What do you see the conversation, what do you see happening when it comes to digital assets?
It's such an interesting time, and it's a very pivotal time. In the House, we've been working on the framework for digital assets, and particularly how to structure a dollar-backed stablecoin now. And in that conversation, really for several years, we made great legislative strides in this 118th Congress on that in the House, including strong bipartisan support of our regulatory framework bill for how to treat digital assets from a custodian, exchange, broker, dealer, secondary market, innovator, coder, whether something should be considered a security or a commodity. We really outlined a fit-for-purpose structure. And Chairman McHenry, Patrick McHenry of North Carolina, and Ranking Member Waters have done an effective job finding, I think, a broad consensus on what a dollar-backed stablecoin legislation looks like. So I'm pleased about that. What we now need to see is, in the lame duck, what's in the realm of possibility. And as you know, in all lame duck sessions, they take the they take the direction from who wins the top of the ticket. So that will, I think, govern a bit of what we're dealing with. And I can game it out several different ways, but I'm still optimistic that FIT 21, which is the regulatory framework bill, and the stablecoin bill, have possible consideration in the lame duck. A lot of it is contingent on, are we going to do an ag bill or not? Because as you know, in the Senate, Fit 21 is germane to the Ag Committee. And so that's an interesting issue. The Senate has asked for a financial services title in the National Defense Authorization Bill. So that's an interesting opportunity for Chairman McHenry to consider the possibility of a financial services priority attached to the NDAA. So know that we in the House are looking for opportunities to take action there. And if we are not successful, then it'll be a top priority going into the 119th Congress. Privacy, stable coins, and the Fit 21 regulatory framework.
Well, you just read my mind. You know, like when you think about those priorities, regardless as to the election, obviously that will have a big direction, and the House will have to be responsive to the election. But when you think about your personal priorities and your centrality on what happens in the House Financial Services Committee, those are what you're looking forward to dealing with, regardless as to obviously how the election plays out.
But we need clarity and transparency, simplicity, and a common sense of direction in the digital asset space, the privacy space, because if we're going to move from an analog future to a truly a digital future, and even more specifically a digital future that's going to include lots of applications written on a blockchain, which will reduce some levels of intermediation in the financial sector, we must have these basic building blocks aligned. They need to have a federal view. They need to have, in my view, bipartisan consensus, and we need to get on with it because we're losing innovators, coders, and in some cases, significant venture capital opportunities to jurisdictions outside the U.S., which don't have our economic system, don't have our rule of law, don't have our broad leadership in global capital markets to begin with. So I want to make sure that it is a priority, and if we're not successful this fall before the Christmas season commences, that we're able to make it a top priority for the beginning of the next Congress.
I know that we're about out of time, but I'd be remiss, especially since we've had this new news coming out from the CFPB on 1033. I don't know if you've had enough time to really review sort of what that package looks like, but do you have any initial impressions?
Well, look, it's a part of my theme of moving from an analog to a digital future. So data ownership by consumers is important. Consumers owning their own data will lead to creativity being unique to their own node and not having data aggregated and sold only to the biggest tech companies. So this is a step in the right direction. It's a small step in the most basic consumer finance products. I want to see how it goes. I've never been a fan of screen scraping, so to take a step beyond that to make sure we use API connections is important. But it's a step in the right direction. I want to study the details and see what I think the competitive activities of it are and study the phase-in period. But we've waited 14 years to see somebody's idea of a draft 1033 proposal, so I look forward to looking at it.
Well, Representative Hill, thank you so much. It was just so gracious of you to participate in this conference. I'll be rooting with you on the Razorbacks this season, but honestly, it was just fantastic to get your perspective. Thank you.
Great to be with you, Chris. Thanks for the time, and I hope you all have a terrific meeting. You've got a great set of speakers.
Thank you. Bye-bye, sir. Okay. So with that, I want to welcome Steve Holden on stage. As I said, we have an action-packed set of conversations, this one on technology, housing, and beyond. Please.
Ladies and gentlemen, it's time.
Great. Well, hi, everybody. My name is Steve Holden. I lead the analytics team here at Fannie Mae for the single-family business. And today we're going to talk about financial inclusion. And I have a star-studded panel here. And I'm going to have each of my fellow panelists introduce themselves And maybe give us a quick soundbite around how you think about financial inclusion in the rapidly evolving digital age. Lisa, we'll start with you.
Thanks, Steve. Hi, everybody. My name is Lisa Rice. I'm the president and CEO of the National Fair Housing Alliance. We're a national civil rights agency and the only civil rights agency solely dedicated to eliminating all forms of discrimination in the housing and financial markets. And financial inclusion means to me that all of the systems in our mainstream sector work properly and accurately and fairly, particularly for marginalized communities.
Thanks for having me. Felipe Millon, I'm with OpenAI, and I lead our government go-to-market business. You asked a little bit about financial inclusion, so maybe to share on a personal level, I'm a first-generation immigrant. I was born in Colombia and moved to Miami when I was 2 years old. And I very vividly remember as a 14, 15-year-old going with my dad to a car dealership to try to negotiate a lease and having to translate documents for him. And so the idea of financial inclusion is very important, especially when it comes to translation and equitable access to be able to understand the important financial documents we're using.
That's a great anecdote. Adrian.
Yeah, my name is Adrian Armas. I'm a chief economist of the Central Bank of Peru since 2005, where I have spent most of my career. The case of Peru is a middle-income country with a very low level of financial inclusion because it's also an economy with high informality, and citizens, there is a distrust on financial institutions. So this digital revolution is a great opportunity for my country to improve on that regard.
Great. And Leah?
My name is Leah Price. I work for the Federal Housing Finance Agency. We oversee Fannie Mae, Freddie Mac, and the Federal Home Loan Banks. Before that, I worked for a fintech startup, and I worked here at Fannie Mae. And financial inclusion for me really is about leveling the playing field.
Great, thanks, Leah. Okay, we're going to start with Adrian, if that's okay. So Adrian, let's have an international perspective on this topic. So you mentioned that you're from the Central Reserve Bank of Peru as the chief economist. Tell us about some of the issues that Peruvians face when it comes to financial inclusion and what steps the central bank is taking to address some of those issues.
Yeah, thank you, Steve. There are two actions that are most common among the central bank community, and there is a third one which is unique to the Peruvian case. The two are, one, first is the interoperability regulation to force any institution to be interoperability. That's one. Two, also, the central bank has started to build a retail payment platform like the FedNow here or UP in India, or PIX in Brazil. We are also started with this project. That's common. Now, what is not common is our CBDC pilot. Why? Because, as I mentioned, there is a lot of distrust from people in Peru, but what they do trust is at the Central Bank of Peru. I don't know if you know, but Peru has the lowest inflation rate in Latin America, taking out countries with the dollar as a currency. So there is a trust so our experiment in the central bank is to see, in particular in rural areas, where at least 25% of citizens live there. You can think about the Andes Mountains, on the Amazon rainforest, people living in a very hard places as you could imagine. So our guess is, our experiment is to try with, if with the CBDC, they will start to using digital payment. And then probably other tools as well. The idea is to include these people in the financial system.
And the CBDC is the central bank digital currency?
Yeah, central bank digital, exactly.
Excellent, great. So thanks for that, Adrian. So we'll move on now to Lisa. And Lisa, let's bring a domestic lens to this. I know you've been looking at all sorts of financial systems as you think about your role as president and CEO of the National Fair Housing Alliance. What are you seeing in terms of the systems in the US from an inclusivity and a fairness perspective?
So Steve, what we have found, and we've been working on these issues since our inception almost 40 years ago, what we have found is that the systems and structures in the mainstream market are not working well for marginalized communities. So think automated underwriting systems, credit scoring systems, insurance scoring systems. We now have automated valuation models that perform abysmally when it comes to assessing the accurate value for properties that are located in predominantly Black and Latino communities and predominantly Native American communities. Tenant screening selection systems. The challenge is that we have had throughout the entire history of the US, right, we've had thousands of race-based laws and policies that have created these systems and structures of inequality. So think about the zoning policies that we put in place 50, 60 years ago to foment residential segregation. Well, we passed the Fair Housing Act, but we left those zoning policies in place. So these systems and structures are still in place. Zoning policies, the dual credit market, our biased appraisal system, racial profiling in the criminal justice system, and so forth and so on. These systems are still in place and they're still doing what they were designed to do. So our job is to both try to eliminate and deconstruct those systems and replace them with systems and structures that are fairer, but simultaneously, we have been doing a lot of work to compel legacy systems to be fairer. And we do that in a number of ways. So we have done a lot of work in compelling insurance scoring systems, for example, to be fairer in the aftermath of a bevy of insurance redlining cases that we brought. We worked with insurance carriers to augment their models to be fairer, and we did that by a number of ways. We changed the data sets. We changed weighting of the different variables. We changed variables in the model. It took a lot of tinkering to do, but we were able to compel those systems to be fairer and more accurate. We've done a lot of work with helping entities to clean up their data sets. We've done a lot of work with entities to help them expand the universe of data that they're using in their models. So for example, using information like rental housing payment information, using bank transaction data and the like to broaden the universe of the data sets, ensure that there's more representation, particularly of marginalized consumers, being represented in the data, being seen in the data. Because if you're not seen in the data, the resulting system is not going to accurately assess you. And then most recently, we have been using we've been researching a process called distribution matching, in which we can compel AI systems, we believe, to be fairer. For underwriting systems, we're seeing a 15% reduction in disparities, and in pricing systems, up to a 20% reduction in disparities.
Wow, that's really impressive. And I can tell you, oftentimes, focusing on the data is where a lot of the issues reside, and so chasing down those data-based issues and resolving them is important to making progress. So that's really, really interesting, Lisa. Thank you. Let's go over to Felipe now. Felipe, you're at OpenAI, and I know that generative AI is sort of the new topic du jour. What opportunities do you see generative AI as a technology can make in terms of addressing issues around inclusivity?
Yeah, thank you, Steve. I'm clearly an extreme believer in the power of this technology. To a certain extent, I voted in the most powerful way, which was with my feet. I had a phenomenal career at Amazon and loved the organization, but felt so strongly about the power of this technology that made the jump to OpenAI to be even closer to it. I think, I mentioned at the start, one of the things about financial inclusion in my personal story was, again, growing up as a child with an immigrant family and being able to translate for them. So I do think there is so much power in this democratization of intelligence. And two things I'll point out. That first one is translation. So these generative AI models are incredible at translation, being able to speak translate from one language to another and understand. And so whether it be the real-time voice mode we launched, if you have not played around with it, highly suggest to play around with the voice mode. It is an incredible real-time translator or interpreter. But being able to take an important document, like going back to the example of my father leasing a car, and I can take a English language contract upload that into a tool like ChatGPT or others, and have that translated into Spanish at the appropriate level for me, or what are the important points, or what are the things I need to understand. So that ability to take financial documents and financial literacy and be able to translate that back to someone, not only a translation in terms of language, but also in terms of kind of content and reading level and familiarity, which leads to another way that I think these models are going to be incredibly important, which is the personalization of education. And really this ability to use generative AI to adapt your learning style to the thing that you need to learn at the right level. So if I am a PhD economist talking about an economic topic, I might want to see the content at a different level if I'm trying to learn it. But if I am not a PhD economist and maybe only have an undergraduate experience or only high school level understanding of economics, to be able to have a model adjust kind of content to my level, I think is a very powerful topic. So I do think we're seeing a lot of adoption of generative AI in universities. It's going to be one of the places I think that is most radically impacted in how we teach and how we learn. We have to do it in a right, responsible way where tools like ChatGPT aren't used for cheating and kind of just writing an essay for you, but instead helping you personalize your education, I think is really powerful. So those are the couple of things that I'm really excited about.
That's great. And I think the applications for financial literacy in this country are quite profound. In some of the examples you just gave, I think there's really some impressive opportunities. I did see recently the chat feature, the voice chat feature of OpenAI's tools, and the latency, it's just incredible. You're having a conversation in real time. The responsiveness is extraordinary. So yeah, I see a lot of really interesting applications of that technology.
Not specifically financial inclusion, but one of the things I do, so I'm on the road a lot, meeting with different organizations, and sometimes I don't have background about these organizations. So what I do is I turn on voice mode in my car over Bluetooth and have a whole conversation. Hey, tell me about this organization. Tell me about what they do. Tell me about what maybe things related to AI they've done, and understanding more about that. So when I go and meet with someone, I'm much more informed about their organizations, their priorities, their history.
Yeah, very cool. Leah, so let's talk about FHFA and the recent generative AI tech sprint that was conducted. I spent 3.5 days at your headquarters. It was a really impressive session. You all enabled a conversation amongst our whole industry, frankly, around this topic of generative AI. Can you share with our audience today that event?
Yeah, so let me tell you about our tech sprint. In general, a tech sprint could be hosted by any kind of organization. So companies hold them, governments hold them. It's kind of like a hackathon. And the way FHFA structures tech sprints, we just had our second annual tech sprint, is we set up a 4-day event where we bring together teams of people from the industry. So this year there were a lot of lenders, there were some big tech companies, there were mortgage tech vendors. We brought together 12 teams, and over the course of 3 days, they came up with ideas. And on the 4th day, they pitched the ideas to a panel of judges, very much like Shark Tank. It's a good show. You can see the show on YouTube. FHFA has a YouTube channel, so just search for Demo Day YouTube, and you'll find it. So we had 12 different ideas that were pitched. And what's really interesting listening to Felipe is that the ideas that came up were really about financial inclusion, very much focused around that. One of them that I was going to mention today was about borrowers with limited English proficiency. So it's fascinating that here we are in the mortgage industry at a federal regulator, to hear somebody at OpenAI say that that's what they're most excited about, what this technology can do. It really means that we are pretty much on the same page about what some of the capabilities could be and what some of the benefits are. Another example I want to give of how this industry, and it's not just FHFA thinking about it, it's not Fannie and Freddie, but it's how mortgage lenders are thinking about it, was an idea that would make use of the multimodal capability of AI. This one's really interesting. So Americans with Disabilities Act and properties, in order to ensure that properties are more compliant with ADA, one team proposed an idea where a property owner could take pictures of a room or of an entrance and send it to the model. The model would give some kind of compliance score and then even come up with renderings and new images of what an owner would need to do to the property to make it more compliant. This makes things better for Americans with disabilities. It makes things better for the property owners. There are all kinds of opportunities with this new technology. So we're a regulator, obviously, so we need to be thinking about the risks and what kinds of control measures need to be put in place. So not only did each team at this event need to come up with use cases and benefits, but they also had to talk about the risks. And there are novel risks with this new technology. I'll tell you, every single team mentioned hallucination and accuracy as the #1 risk. And what's great is that at least that's consistent. At least all of the players in the industry, outside of the industry, big tech, other regulators, other countries are thinking about the same types of risks that are out there. So it feels like there is a rising tide and there's a lot of interest, and I hope that continues.
Yeah, I love those examples. And when I think about the limited English proficiency example, for anyone who's been through a mortgage closing and has gone through the myriad of documentations, imagine doing that if English is not your first language. I mean, it's just an extraordinarily complicated and involved process. And I also believe that generative AI can really help provide clarity to the borrower about what's really happening in those transactions. That it is arguably the most important financial transaction that one might engage in their lifetime.
Yeah, and I'll also say what was interesting was that there's a lot of fear around generative AI and the harm that it can cause, but every single team gravitated towards working on this technology for risk management and compliance. And so out in the media, the hype really isn't about, oh, how can this cool technology help risk manage? It's all about how it can cause mass destruction. So I'm excited about that.
Very great.
If I can add one thing, Steve, on that. I mean, I think the point about the fear around AI, I think one of the things I suggest to the audience is to think about this in a very risk-based approach. And so if I take two kind of extreme examples of using generative AI, if I am saying, I'm thinking about a mortgage, here's my mortgage documents, should I sign this paperwork? That's actually probably a risky decision. You should probably have some legal advice. You should probably understand the financial decision. I, as an AI provider, would not advise you to just take whatever comes out of ChatGPT and say, yep, it said I'm okay, let me sign it. However, if I am taking my cafeteria menu as an organization and translating that into other languages, maybe I want to make it more inclusive, and so I want to translate it into Spanish or Portuguese, I'm okay if you take that and you just take this trade output and not double check it and go call up some third party to verify. So understanding a risk-based approach, I think, is the right way to think about using these tools. You as an individual, as your organization, are going to be the right ones to understand the risk of each outcome. And so again, think about that cafeteria menu versus signing a contract, and it's very different. And overall, what I would suggest is, a quote I love to share is, unfortunately, we do not get fit by reading about working out. You have to go to the gym. And so in the AI world, going to the gym is using AI. So use AI, obviously I'm very biased. We have a tool we think is the best. There's others out there. Use something. Again, use it in a risk-based approach. Find those low-risk categories that you are perfectly okay if the AI tools are wrong. But we have to start using it. I think we talk a lot, especially in DC and others, about AI. Generally, there's AI events like this all the time. But I think there's no substitute for using AI and being at the frontier and seeing what this technology can do.
That's sage advice. Okay, we're going to do a lightning round here. We're just going to go down the line. We'll start with Lisa. And so my question for you is, as you look ahead, what are you most worried about? What are you most excited about? And what do we need to be doing to get this right?
Okay, well, I have to give two answers. I'm sorry, based on what Felipe just said. I'm very concerned about unconstrained models. But the answer that I wanted to give is I'm really, really concerned about the dearth of students in the United States who are graduating with STEM degrees. Extremely concerned about it, and believe we have to do a lot more to invest in math and sciences, particularly in our public educational institutions, starting at the kindergarten and pre-kindergarten levels. I'm extremely concerned about this. The number of STEM students graduating is declining.
I'll go to the optimistic side. So one of the things I'm most excited about is the underlying improvement of this generative AI technology. So we released about a month ago, a new series of models we call O1, which are a new reasoning line of models. And really, we think that is very fundamental in a step leap change in what these models will be able to do. And so understand as these models become more intelligent, they can now start doing things of like more agentic like behavior. Again, I still think we need to do it in the right responsible way, but really excited to see what comes from that.
Great. Adrian?
Yeah. Historically, technology has driven evolution of the financial system, so it's not new in that regard. But what history tells us is that we have to be careful about spillover effects, consequence, and how to keep a sound financial system. But technology is always very, very welcome.
Yeah. And Leah?
I'm not worried, but I am concerned that it's bad actors who will be playing with this technology more aggressively in a way that may not benefit any of us, any of humanity. I'm concerned that they will be ahead of those of us who have good intentions, and that those of us who have good intentions will end up being constrained because there's so much fear about what the bad guys are doing that everyone else gets shut down along with it. Like Felipe, I'm really excited that these models are getting better every single day and that this is a very competitive space and that we could end up living much better lives, have better life expectancy, disease could be cured, so I'm pretty excited.
Steve, how about yourself?
Well, I tend to be an optimist. This is a extremely disruptive technology, and I think there's going to be a lot of change. But I think on net, looking back, there's going to be some amazing opportunities for us as a society to make the world a better place. So that's my closing view on the topic. Thanks, Felipe, for asking. Well, listen, you've been more than generous with your time this morning and really interesting views and perspectives. So thank you to our panelists on our financial inclusion.
Well, we at DC Fintech Week, we like to have some headliners, and certainly we have one right now, a big one, with Paulo Arduino, the CEO of Tether, joining the conference. Paulo, are you there? You are
yes,
indeed
I'm there.
You're seen right now on a very large LED screen for Washington, D.C. So hello, and thanks for joining us.
Thank you for having me, Chris.
A pleasure. Certainly, Tether is interesting. I mean, like when you talk about Tether, it is a stable coin, and I think it's good to sort of begin the journey a little bit into, I guess, what you can describe as the sort of bull case and the bear case that policymakers are debating when it comes to Tether. So let's start with the bull case first, and then to the bear case to sort of help set the stakes for Washington, D.C., since we have so many policymakers and others here in the building. And then maybe we can sort of frame the conversation for the larger sort of crypto conversation taking place tomorrow. Okay, so starting off, I guess, with the bull case. I mean, Tether, you guys are a dominant, very large stablecoin, and we actually just finished a conversation just now on financial inclusion. So again, starting with the bull case, maybe you can talk a bit about the role Tether plays in the economy, in the global economy, and the role that you would like to see it play in the future.
Sure. First of all, thank you also to the audience for being here and listening to me. So Tether started around 10 years ago. Actually, we just celebrated our 10 years anniversary with a very simple use case, with a very simple idea. Let's put together blockchain, that was that amazing technology created by Bitcoin, and let's put it together with the most used currency in the world, that is the US dollar. For the first few years, the use case of Tether was helping the cryptocurrency trading settlement. So very simple, limited use case. But especially during the pandemic and after the pandemic, and the change of different geopolitical situation, and especially macroeconomical situation in emerging markets and developing countries, USDT has become the lifeline for hundreds of millions of people around the world, especially in emerging markets. So one important statistic is that 3 billion people in the world don't have access to bank account or basic financial services. They are not bad people. They are simple people. They are just poor people, too poor of being of interest of banks, because they generate on a yearly basis too few commissions. But with stablecoins and USDT, we gave them for the first time in their lives the ability to have access to payments, to start creating their first savings account directly on the smartphone, instead of having to collect money in cash form under the pillow. As of recent statistics, we see how USDT have been growing over the last few years to 330 million users just on chain, plus several tens of millions of users that are using USDT through centralized exchanges. And another important statistic is that on a quarterly by quarterly basis, we are growing very fast. We are adding around 30 million new wallets per quarter. So the reason for that is actually because we are providing an easy service, a service that everyone can use. And again, think about the people that live in Argentina, think the people that live in Turkey, right, or in Brazil, or in high inflation countries. We said about 3 billion people living in 3 billion people that don't have access to basic financial services. 5 billion people are living in high inflation countries. Those people are honestly sick and tired to have only access to their national currencies. And so they are looking for an alternative. And historically, that alternative has been the US dollar. Right? But in Argentina, if you live in Argentina, access to the US dollar is very, very hard, is harder and harder. And so people want to find a better way than trying to use the black market to access the US dollar cash. They want to use locally regulated exchanges to buy digital dollars using their pesos. So that is what Tether USDT is representing. It's like this digital dollar for, we are not selling USDT in the US. We don't onboard US customers. Because in the US, you have so many different counterparties and players. You have people on average have multiple bank accounts or debit cards, credit cards, PayPal, Venmo, Cash App, you name it. You have tens of ways to pay. But put yourself in the shoes of someone that doesn't have anything apart from their national currency, and they were never able to build a savings account and a future for their children, and maybe send their children to study abroad because they were never be able to accrue enough money in a stable currency, in a safer currency than their national currency. So that is what USDT is representing today. It's and to us is the most important thing to defend.
Yeah, let me just sort of jump on that, because some of those statistics are important, and obviously, I think when you think about Tether and the stance that people have, it really does depend, or it's informed a little bit as to where they are. I mean, you had mentioned the 30 million new accounts this quarter, but in the United States, and I think this is what you were sort of signaling towards. I mean, there's a tremendous importance of compliance, and U.S. regulators and law enforcement officials, they need to know that a payment is safe, whether or not for a large financial institution or for smaller actors, and to make sure that that instrument is not being used as a tool for criminality. Corporate transparency is a big issue. So is how the issuance of that instrument occurs, and especially in a global marketplace. So maybe starting with your AML and KYC, how does Tether make the case that it is not an instrument for evildoers?
That's a very good point, and I think this is a very timely, because look, stablecoins are very, very powerful, and actually they can give access very easily to payments to hundreds of millions of people, as we said. But not only for the government and for regulators and for law enforcement, the ecosystem safety is important. For Tether itself, And for all our users, the ecosystem safety is important, right? So we don't want to have few bad apples actually creating problems to hundreds of millions of people that really need the product and this new payment system for their lives, right? For their families. So as a CEO of Tether, for me, KYC and AML are very, very important. Compliance is very, very important. So in latest December, I became the CEO of Tether, and I wanted to reinforce that mission. That didn't start just last year, to be clear. Tether has always been a force of compliance. And I understand that publicly it never or didn't appear like that, at least in the US, right? I want to be open, I want to be transparent about that and about the issues. I think communication, transparency is truly important, and we are actually doubling down on that. So Tether, as also recently announced, works with more than 180 law enforcement agencies across more than 45 different countries. We onboarded the FBI, we onboarded US Secret Services to help them with their issuances. So when money is frozen, we can help them to get back the money and being able so that that money can be redistributed to the legitimate owners. There are not many financial institutions in the world that work with more than 180 law enforcement agencies. You know, again, we work with the Department of Justice of the United States. We have named and thanked for our help by the Department of Justice. Same thing with the FBI. We work with the Europol. We do sections of education with Europol. And that goes all around the world. We froze hundreds of millions of dollars on behalf of the US. We are working with the US to get this dollar back in case of, for example, tax or kickback sharing. We are working so that this money can return back to their legitimate owners. We have developed over the last 10 years incredible tools ourselves, because remember, blockchains are transparent. The beauty of blockchain technology is that everything will remain on chain. Nothing can be deleted. So whenever people will look at and law enforcement will look at blockchain, information stays there. And so this is actually quite helpful to do compliance at a much better and higher scale than any bank. Imagine if you're a law enforcement agency, you have to trace a wire across multiple jurisdictions, and you have to go through multiple hops and try to get courts in different jurisdictions to try to unveil the traces of that wire. With blockchain, it's all public. That's why we working also with partners like TR Labs and especially Chainalysis. We have adopted the Chainalysis ecosystem monitoring tool that helps us to be very surgical in the approach that we have in freezing funds. And not only we are waiting for law enforcement to tell us what to freeze and when to freeze it. Of course, as I said, the work with law enforcement is very important, but we are very, very proactive. So we start ourselves. We have an internal investigation team on top of the compliance onboarding team that are great. We have an internal investigation team that takes care of starting proactive investigations and monitoring.
Paul, I just want to jump in because I just want to make sure that your microphone is, we can hear you, it just sort of fluctuates a little bit. And I want to give both you and the AV team a moment just to make sure that everything is working okay. But just to sort of carry on in that conversation, I mean, AML KYC is one issue. Obviously, there are lots of different kinds of regulators. There are lots of different kinds of concerns when it comes to the integrity of payments. Another is obviously the reserves, the quality of reserves. The CFTC had fined Tether at one point in time. What can you tell us about the content of the reserves backing Tether and the transparency and auditability and the like for a Washington DC based audience?
So also that's a very important point for us. So and I hope my
it sounds great now. Yeah.
Okay, great. So risk management is very important. So over the last years, we have demonstrated the solidity of Tether, right? Openly in 2022, there was a lot of noise, especially in the entire cryptocurrency industry. Everyone remembers FTX and many others, Terra Luna, and the Tether was subject to enormous pressure. I think such pressure was quite unique to us, and is a type of pressure that almost no bank was able to survive. In May 2022, Tether was subject to $7 billion of redemption over 48 hours. That was more than 10% of our reserves. And we were subject within 25 days to $20 billion of redemptions That was 25% of our total market cap. So think about the standard banking industry where they can lend out, they do fractional reserve. Tether is over collateralized, is 104% collateralized. Standard banking can lend out up to 90% of their reserves and keep 10% in their balance sheet. That is the exact problem that happened with Silicon Valley Bank, Silvergate and Signature. Last year in 2023, one of our major competitors almost died because they have uninsured cash deposits in the Silicon Valley Bank, and that almost killed them. While Tether has more than in this moment, actually very around $100 billion in U.S. Treasury bills. If we are not a country, of course, but if we were a country, we were the 18th country in terms of how many U.S. T-bills we own. So. And that, of course, short-term USD deals, less than 90 days, because we want to make sure that at any point in time, we can redeem those assets and we can pay back any redemption with the deepest liquidity possible. So it's not any more hypothetical. We're subject to this type of pressure that, again, no bank in the world, even Washington Mutual in 2008, this year, New York Community Bank, all these banks failed because they didn't have proper risk management. And I think it's very important to showcase what Tether did and with the stress test that we had, again, not hypothetical, to demonstrate that our reserves are very solid. The problem is in keeping cash in a bank is that if the bank goes bankrupt, the cash will be part of the bankruptcy process. If we keep T-bills in a very safe custodian, but even if there are problems with the custodian, the T-bills are securities. They will be brought back to the legitimate owner. So that's what we did and what we do, and we have a great investment team to ensure that every single action, every single investment, every single detail, also macroeconomic detail, is taken into account to ensure that the 350 million users that are using USDT as a lifeline are actually safe in using our products.
Yeah, I think that one of the challenges is obviously to sort of figure out, well, what does the mechanism look like and how does it evolve over time? But one thing is for sure that you've noted, and I think it's one of those under-discussed questions, sort of let's call it the geoeconomics sort of question, is that there are T-bills that are backing Tether to a degree, and certainly I've heard sort of anecdotally that there are a lot of them. I think that many people here in Washington D.C. would be surprised. I've heard again anecdotally that there are actually more T-bills held by Tether than Germany. I don't know if that's entirely correct or not, but it gives a sense of the scale of Tether. What does that even mean for Tether to hold those kinds of reserves, and what does it mean in terms of the stakes for the U.S. government?
So we are very close to Germany. So we have more T-bills compared to UAE, compared to Australia and Spain. So we believe that U.S. treasuries are the safest asset that a company could hold in the balance sheet, right? So especially the short-term ones. I remember, again, the most important job of a stablecoin issuer is being able to liquidate the reserves and pay back everyone and pay every single redemption in a timely fashion. So that's why, given the rapid increase of Tether, in 4 years we went from $15 billion to 120 as of today. We have to use the best asset that we could have. Now, what does it mean for the US? I think it's a great question, right? If I think about the macroeconomic aspect of what is happening in the world, I remember China had around 30 billion or 2 trillion in US Treasuries holdings up to 2 or 3 years ago. And if you look at today, they have around 800 billion. And in that scenario, there is a kind of a single decision maker that decides to divest from US Treasuries in a short period of time. In fact, 2 trillion to 800 billion in just a few years. One of the features that not many realize about USDT and Tether is that think about every person that buys USDT in Argentina, in Turkey, in many countries, in Brazil and so on. For every time we get the money, we purchase a piece of the US debt. So now the decision to sell that piece of US debt is not anymore in the hands of a single person. So we will sell that piece of the US debt to repay a person that needs to cash out. So thinking that to the fact that we have around 350 million users and even more actually, so we have decentralized the decision-making of selling the US debt. So you will not find yourself in a situation where the US debt can be sold at once, but it's hundreds of millions of people that will not decide, of course, all at a single time to sell that chunk of US debt. So I think that it's very important for the US to start finding new buyers. And not only we are finding hundreds of millions of new buyers of US debt, just because through us, we can expose these emerging markets to the best currency in the world. And in that process, we are purchasing immense quantities of US debt.
Yeah, it is quite an interesting sort of geoeconomic, geopolitical question. I'm sure here people are going to sort of grapple through. Well, on the one hand, you're sort of exporting U.S. power to the extent to which you're relying on or purchasing the U.S. dollar. But then the question is to make sure when you decentralize that access, that indeed like that any catalyst to redemptions is sort of avoided, so that they can make certain kinds of predictions. Which gets to this question about, again, I guess to move a little bit more towards the in-between case. You'd started off talking about how many people had, from around the world used Tether. Clearly, there's some skepticism here, evolving. We'll see where and how that goes. But certainly, Tether is viewed pretty differently in different parts of the world. And I would guess Asia and LATAM maybe being the two areas. Why do you, getting back to your sort of bull case here, is there a value proposition that you're delivering that is an unmet need as opposed to, say, here again in the US? You'd gotten there a little bit, but I wanted to circle back to that.
Well, yes, I think the most important part is that when you create a technology, you have to think about not your personal needs only, right? Whenever you create a product, you have to think about who is the best user of that product, the technology. So in the US, you are, of course, every country has a problem, but in the US, you are having US is the most powerful country in the world, and so almost every other country is downhill from that. So you have to try to go outside the US and ask to every single person you meet, would you prefer to hold your national currency or would you prefer to hold the US dollar? Every one of them will tell you, I prefer to hold the US dollar, right? So whenever you create a product, you have to think about the product market fit, right? So why a company like Tether should compete in the US when you have already the best dollar rails, you have the best banking, you have the ton of payments apps. It's 25 years or more that you are building payment rails. And then on the other side, you have 5 billion people that don't have that luck. They don't have that access. When we think about financial inclusion, I think that is very, very important to also, financial inclusion shouldn't be a marketing pitch, right? Financial inclusion should be done properly. And I think that USDT and Tether are actually doing much more than almost any other company in the world to achieve that. Because think about the remittances case. We see remittances companies that until USDT didn't have any match, they didn't have any competition, they could charge from 10 to 26% to move money across two countries. If you think about the case of Philippines has, on a yearly basis, they receive $33 billion in remittances, right? And 10% is 30 billion. It's a lot of money. And that money should stay in the pockets of people that work really hard, far from their families, and they want that money to stay in the pockets of their families. So with USDT, you can actually completely almost reduce to zero the cost of transaction cross borders. So these are the things that Tether is doing very, very well.
I just want to jump in because, again, I'm trying to hopscotch a little bit around the world so that we can, get a full picture here in Washington. When you move then and compare that picture to, say, the EU, where, you saw recently the news of the EU delisting stablecoins for failure to comply with MiCA, which is the EU regulatory regime. Tether was at least implicitly sort of cited as a likely impacted stablecoin. I mean, is it then that the EU is not a high priority? Or maybe you can talk a little bit about that situation and what's happening.
Later. So first of all, the EU is a little bit like the US. So the EU is still coalition of fairly rich countries. So the percentage of unbanked is very, very tiny, right? Again, there are countries where the percentage is 90%, the EU might be around 5%. So you have to pick your own battles. But, I think that I've been quite vocal on the EU MiCA regulation because I am very in favor, and we as a company are very in favor of regulations, but regulation should help defend the customer. The issue with the MiCA regulation is this one. If you are a big stablecoin like USDT, you are required to keep 60% of your reserves in cash deposit. Cash deposits in Europe are insured up to 100,000 euros. In the US, I think that they are insured up to $250,000. Imagine that you are a stablecoin and you have 10 billion of euros of market cap. Then 60%, so I mean 6 billion euros, have to be kept in an insured cash deposit in European banks. Now, banks can lend out up to 90% of that 6 billion euros. So it means that 5.4 billion euros can be lent out to people that want to start a company, buy a house, buy a car, and so on. 600 million euros will be kept in the bank. Now, imagine someone wants to have a redemption 2 billion euros. They come to the stablecoin issuer, they ask for 2 billion, and the stablecoin issuer goes to the bank, and the bank has only 600 million. The bank goes bankrupt because they cannot meet the redemption, and the stablecoin issuer goes bankrupt. So when it comes to regulations that are actually improving the safety of the end user, I'm all in favor. I think that stablecoin issuer, as we are doing with USDT, I should be able to purchase the government debt. I want for USDT to purchase billions of US debt. And unfortunately, with the MiCA license, I cannot do that. And I don't want to put my 350 million users across the globe in danger because the MiCA regulation does not take into account the systemic risk that very same regulation could potentially create to the European banking system.
Well, you've already, I guess, sort of read my line. We only have, we're already out of time, but I will give you maybe a 30-second sort of wish list. I mean, if you were, we're in a political season. I don't know if you've noticed. There are some elections happening in the world. Is there anything then, given the way sort of Tether is evolving, is there anything then in the U.S. with regards to U.S. regulation that you would like to see? I mean, you've already mentioned what potentially you'd like to see over in the EU. What's your perspective on the US?
Well, I can tell you, look, there is no place like the US, right? So we tried to create multiple stable coins in different flavors, different currencies, but the reality is that the entire world is looking at the US. Look, I'm Italian, and actually today I was born in the 80s. Today I'm 40 years old, actually. It's my birthday, so it's a pleasure to be with you guys. And
nothing says your birthday. We're at DC Fintech Week. Great. Yeah.
Yes, and look, I mean, being born in the 80s and 90s, I watched the US being the prominent tech leader, right? You were always watching the movies, and the US has always been leading the technological development in every single field. And I think that, growing up, this is the first time in history that I see the US dropping the ball. And I think that whomever will win the elections, I think it's very, very important that crypto regulations, sensible crypto regulations, and stablecoin regulations will come to fruition in a way that will protect the end users, but also will help this incredible technology to foster and to become very, very much the lifeline for hundreds of millions of people that don't have the same luck and the same opportunities of people living in the US and Europe. So that is what that is my wish list for whoever will win the election. The US has, has huge importance in this dialogue. Every single regulator in the world will look in the US for the right regulation. So I hope that will come anytime soon.
Well, thank you so very, very much for your time and spending your birthday with us. Thanks for your time. And to everyone, let's give a hand. And also, we are now heading to our lunch break downstairs, so enjoy, and we'll start things back up in an hour. Thank you. All right, okay, everyone I hope is now fed, but you will not fall asleep because we have a great session right now and throughout the rest of the day. I am a law professor, so I gave Dominic Del Molino, who is the Vice President of Field Technology and Engineering over at AWS, a little bit of homework. And the homework assignment was to give us a bit of an update, not just so much in terms of what Gen AI is, but instead how much it's changed over the last year, and to give us a little bit of a demo and a presentation as to what exactly Gen AI is today. And we're going to hear about this pace of change. We'll be able to see about the pace of change. And then I've also asked Priscilla Almodovar, the CEO of Fannie Mae, to ask some questions, Socratic questions or something, of Dominic, and to give us an idea of sort of fleshing out the presentation and what it means for technology. So with that, I want to welcome Dominic to the stage.
Thank you so much. I'm going to try and make sure that you avoid that food coma. I know I had a nice lunch too, and yeah, we're going to make sure that we're going to keep this light, exciting, and interesting the whole time. As Chris mentioned, I have homework, or had homework, if you will, to put together not only this presentation, but a demo for you. And not to rest there, but then Priscilla's going to come up and make sure that I don't get to just walk off stage to thunderous applause because we did a great demo. She's going to really grill me with some great questions. I hope you'll find them interesting. So let's get started. I think we all know how innovation really can transform industries, right? There's been major technological innovations over the past 20, 30 years, and every time they come in, it's an amazing inflection point where now we're almost all set equal again. There's a brand new thing that we're all trying to scramble and learn about and how we can apply it within our industry. For me, like the last big one might have been mobile applications, or the search engines for the internet, or cloud computing where I don't even have to buy computers, I can get access to technology. So major innovation that can transform industries. And I think a lot of us are now confronted with this new wave of AI capability that we're calling generative AI. And quite frankly, last year we were all scrambling to learn about generative AI. And we had lots and lots of questions from our customers, just basics, right? What do you mean by generative AI? Is this something that's secure? I'm sharing information, sometimes even personal information, with something that sounds like a human. Is that going to be secure? I heard about this new capability I need to bring into my organization. Do I need to become a prompt engineer? What does that even mean? How do I train people? How do I evaluate if someone's a good prompt engineer? How do I choose from all these models that are out there? Right? You can see all the questions. These were the kind of things we were getting from customers. And it was just, everyone was starting their journey to understand how this transformative technology might be something they can apply to their business to take a step leap forward. But now, we've started to get some answers. We've started to get some clarity. We're starting to get information about what the regulatory environment might start to look like. Questions that we should be asking. and answers that other people have discovered. And now we know that we can get started. I heard on one of the earlier panels, the key element here is to engage with the technology, understand what it can do for your business, understand what it can do for your organization, and start to see where you can apply it. We're seeing customers go beyond proof of concepts. They're starting to go to production applications. They're starting to customize these models so that they're being purpose-built for specific use cases. They're doing things that they can deploy them, and then thinking about what does the throughput look like? How do I make sure that I can scale this solution outside of the lab and into thousands of users in my organization, and tens and hundreds of thousands of users if I'm going to be having that capability for use with the public or my end users, my customers. I now know when I want to select a model for which purpose. Maybe for speed, maybe for accuracy, maybe for thoroughness, maybe for broad capability, maybe for targeted information and deep expertise. I now though I need to manage risk. As the regulatory environment continues to evolve, and there are over 500 pending pieces of AI legislation across the United States at the state level, and we're seeing governments around the world grapple with what it means to think about regulating this technology. And what we found is it's kind of hard to predict where those are going to land. And so you need tools and capabilities to react to that. You have a foundation model or an AI capability, and you say, I want to protect against this threat, or I want to make sure that we accommodate and react to and respond to this piece of pending regulation. So you need guardrails and tools and capabilities to make sure that as you build applications using generative AI technology, that you have the capability to be able to respond to pending regulations. And then how do you measure success, manage this? How do you do the DevOps of generative AI? When do you decide when it's time to change a model, update its weights, update the tuning that you've done? How do you build the operational monitoring around something where you now have made it integrated into an application? And how do I move fast? You know, a lot of you are probably responding to boards who are saying, we got to implement and deploy generative AI. Why? Because we need to, because everyone tells us we have to. So how do you measure that actual ROI, that success? Do you have ways to do that? And we're seeing customers actually come up with, yes, look at the time savings, the productivity benefits, and the new capabilities we're able to offer to our end customers. So in 2024, we're seeing this go to production, going to implementation. Early days for sure, but in many ways extremely impressive. And the range and creativity of different kinds of applications I'm seeing from customers, it's astounding. It's really amazing. But you know, let's go beyond that a little bit. Let's talk about what some of these significant business values actually can be. There are new experiences you can create for your customers. There are ways you can make your own employees radically more productive. An AI assistant for your employee that can allow them to do things they could never do before, or do rote things much more quickly. Take vast amounts of data and information you may have available inside your organization in different formats, gather and extract insights from that. And then last, this area is the most amazing one for me, is how can you be creative, create new experiences, create new things, new content, and use this technology to provide that for your organization.
After you log into the portal, you'll see a list of applications that you can work on. Let's look at the quotation 1, 2, 3, 4, 5. The screen shows all files that you've uploaded previously for this application. The system automatically tries to identify the files which contain the applicant information and list of properties that they want to ensure. You can override it by selecting from the corresponding drop-down menu. Next, the system shows a side-by-side comparison of the extracted applicant details and where it comes from in the original PDF file. You can then validate the fields and correct the entries if needed. In the next step, the system extracts and displays the list of properties to ensure, including the address, postcode, and some to ensure. When click on a property, the screen will highlight where the extracted data come from. You can then verify the fields and modify them if you need to change anything. In this step, you can see the details of each of the properties. Let's take a look at the first property, which has a warning sign. The system automatically enriches and summarizes the property information from different data sources. In this example, it finds a potential roof leakage problem by using AI to analyze property photos. Another example shows how it uses AI to summarize the customer financial situation and claim history. In the final step, the page shows the premium and the coverage. You can review the clauses and make changes to the coverage and excess amount. Here you can see that a decrease of the maximum amount payable for the locks and keys clause reduces the premium.
One of the things I love about that demo is that it is multimodal. One of the things that's fascinating about it, if you could see through what it was doing, is it took printed forms with handwriting and extracted the handwriting data and got it into your system for you. It took PDF files and interpreted them and changed them into different formats. You'll notice all of the data that was shown was kind of in these like item and then these tabular bullets. And if you looked closely, it to tell you, well, this came from this file, and this came from this system, and this came from that system. And what it's doing is it's unionizing or unifying the content for you so you can work with it in a similar way. And then, of course, we do our multimodal thing where we're taking a look at imagery, potentially even video, to identify what's going on in that situation and then to understand how it affects what we're trying to pull together from a data perspective. So this is a system that's integrated with generative AI. It's not a generative AI chatbot. It's rather a business process and business flow that's saying, how do I use AI to enrich that flow through every step? And if you've been paying attention, even today, one of our partners, Anthropic, announced a new capability for generative AI that allows it to interpret what it sees on screen and allow you to instruct it how to edit and move the cursor around and interact with your application on screen. So we're really starting to accelerate this kind of capability. It's really amazing. In the demo, the person's going in and typing and making changes. In the future, you can essentially say, move to that field, edit this, and change it to that, and it'll follow your instructions. So super amazing what's possible there. But what's really key about this is that amazing amount of data that you might have and putting it to work. Using generative AI to transform data from one format to another so you can have a unifying experience for a particular business process and application. So your data really becomes now active data. All that data you may be sitting on, you've been gathering, it's in different formats, you've been trying to find ways to unify it. Generative AI makes that so much easier. So that data really becomes something now you can put to work. One of the questions we continue to get about generative AI is around its security. How do we really make sure that we've got the governance? How do we make sure that we've got the controls? How are we thinking about the output of generative AI from a legal perspective? How are we making sure that generative AI respects the privacy rules and regulations that we want to comply with? How do we manage the risk around these things? And these are great questions. And the good news is people like AWS are then thinking about this from the start, whether it's security baked into how we make it available or giving you guardrails so you can mitigate and adapt to the questions you're getting. We've really been consciously thinking about embedding that and putting that into practice. But really it comes down to innovating responsibly and understanding, yes, this is a great tool, great power capability, but how can you continue to use it in a way that is compliant with what you need to do from a responsibility, legal, and regulatory perspective? At AWS, we think of AI in multiple dimensions from a responsibility perspective, all the way from fairness to ensuring veracity and robustness of the output of the model. Some of these may overlap between explainability and transparency, but also there are key elements here around your ability to control what's put out by a model, to govern the data that goes in and what comes out, and then how do you maintain privacy and security, and be really clear and honest and open and transparent about the safety measures that you're taking to ensure that the data that comes out of these things is used responsibly in a responsible manner. These are evolving areas. All of them sometimes have a touch on either regulation or a touch on how you're going to define your policies around using this. These are questions we get from customers, and it's super cool to see where they are in navigating what their internal policies will be on their journey to implementing this technology for their benefit and for their applications. So one of the things we've talked about and we've learned kind of at a high level with customers is most importantly to engage your stakeholders, put people first. Generative AI has the possibility of interacting and actually in many ways feeling like yet another person in your organization. So it's super important as you expose your employees, your potential customers and users to interacting with the output of a generative AI model, that you engage them in that process. Have them be a stakeholder. Use focus groups for testing. Have an approach that allows you to understand who's going to interact with these models and understand the risks about the use cases that you're working on. Have an understanding of which use cases you want to have and what risks are associated with those use cases. We heard that in one of the earlier panels, the difference between like generative AI for a cafeteria menu and potentially applying for a loan. Iterate as much as you can, test, 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 and test. One of the things we see with customers is those who have a mature test and evaluation framework or an idea how they're going to evaluate the performance of a model really get further along in their ability to deploy models into production when they have a robust test and evaluation framework. What does the future hold? Well, I mentioned the Anthropic announcement from today, and we're really seeing some amazing things with the ability to automate the output of generative AI in a human-supervised way. We're seeing multimodal models that can adapt and work with voice, with text, with imagery, with video. It's amazing what you can do when you start to really get that fusion of data that we've all been hoping for. Understanding that you're going to probably use a different set of models, multiple models for different use cases. And understand that you're probably going to want to make sure that you're evolving and implementing policies and standards to really make sure you can take advantage. So, select the right use cases, empower your teams to innovate, and get started on those top use cases today. So with that, I think we're ready. Priscilla, if you want to come on up and make sure you can interrogate me and give me some good questions. I'm looking forward to it. Thank you. You're down there.
Ladies and gentlemen, it's farm time.
So easy. When you're in, first of all, thank you.
Yeah, sure.
Lots there, and we have learned a lot the last year.
Yeah.
But we've also learned there's cost. I appreciate the risk. You make it look easy. Can we dig down a little bit? How does the company pick the use cases that make the most sense, that are scalable? Because I know at Fannie Mae, we have many use cases, many ideas, but picking that right one.
Yeah, I think one of the first things we saw was the immediate reaction of many organizations was, oh my gosh, we have to ban use. We don't know, a lot of these first generative AI things are out on the internet. We're uncomfortable that our employees were putting information out there to these models outside of our control. So the early reaction was, shut it all down. And then what we started to see is organizations that were thinking about what they could possibly do brought generative AI inside the organization and allowed their organization to get experience. And here's what I found out. When you made it broadly acceptable for use internally, the use cases would come organically from places you wouldn't expect. When we made generative AI approved for use inside AWS, we got use cases coming out of legal, out of marketing, out of engineering, places that as an IT person, I was like, we need to look at an IT problem first. But we're actually getting really interesting use cases bubbling up from the org. And so that's where I really encourage people is make it broadly approved for use internally and allow people to experiment and propose use cases.
How do you prioritize those use cases?
Yeah, that's a good one. We found that basically what it was, sometimes it's early on we're at a phase where we're like, okay, how do we do something that maybe is low risk, has potential for high productivity, has a small enough user base that we can experiment and learn without huge amounts of people being exposed to something we may not fully understand yet. And so the first use cases were internally focused, productivity based, small user counts. How do we learn from that use case? That was kind of where you start, how you prioritize at first.
Yeah. So how would you describe companies that have lots of data, less data, are already migrated to the cloud? Do they have an advantage? Is everyone else left behind at this point? Is it too late if you're not far along in this cloud journey?
I mean, we've found that some of these models are so big and they work well when they have a lot of data that cloud's a natural place for that because you can scale both the compute and storage to accommodate the appetite potentially of a large model. So that was kind of the first place. But we also found, it's interesting, organizations with a huge amount of data, often as the first use case, we're saying, I need generative AI to help me distill this data, to help me not search it so much, but get insights from this big pile of data in response to kind of more unscripted questions. So in the past where you might have had very structured data warehouses and data analytics teams and data flows to get data into a format so we can get insight, we found companies and organizations with large amounts of data, usually unstructured in multiple formats, saying, can generative AI help us make sense of it? So early use cases were really kind of search and what we call retrieval augmented generation, or a generative AI that cites its sources early on. Organizations that didn't have a lot of data wanted to use generative AI in the creative aspect. They're saying, we need, I call it sourdough starter. Like ask the generative AI model to generate a starter kit or a starter template or something we could riff on. And so those organizations tended to use the more creative aspects, whereas ones with large amounts of data use the more analytic aspects.
Yeah, look, there's so much there. The earlier panels talked about data.
Yeah.
And one of the questions that I know our board is asking, many boards are asking, is who owns this data?
Yeah.
Who's responsible for this data and the privacy of it?
Yeah.
Can you just comment on that? Because even the regulators who were here earlier talked about accountability.
Sure.
And you mentioned unstructured data as well. That comes, generative AI unlocks that. But just talk about accountability, responsibility. Who owns it?
Yeah, it's a great question. I can tell you our position and what we recommend to clients and customers, which is, first of all, we have a high bar of saying your customers own their data. So the data environment starts out with data you already own. And then as you use generative AI to transform that data or to create new data, that data continues to be owned by you because you've instructed the model to do a thing with your data and create new data outputs. And so the key message here is you continue to A, own your data, and B, be responsible for the data that is coming out of a generative AI because you've been instructing it and putting guardrails and constraints potentially on generative AI as to what it can and cannot say. It's not a lot different from the constraints or review you might do with your own internal people who create data in your organization. You continue to own it, you have to review it, you have to understand its ramifications, whether or not you're going to publish it. You would apply those same well-known constraints and mechanisms and processes to data that's created or generated by generative AI.
So you said you were cool for me to ask what's really on my mind.
Yes, anything.
I've tried that answer with our board.
Yes.
And they come back with, but it sits on AWS's model, or you're relying on cloud providers. One of the regulators earlier talked about this unanswered question of reliance on certain providers, of which AWS is a big one.
Yeah.
How do you respond to
Yeah, the first
It's your model, your cloud.
Yeah, great question. Great.
And it's my data.
Yeah, so the first thing is, just like today, when you provision your environment on AWS, that's in the data plane, we have no access to that. That is your data, we have no access to it, it's encrypted with your keys, we don't have access to your keys. So your data today, as you put it on the cloud, is safe and secure because it's controlled by you. You have the ability to put it there, take it away, encrypt it the way you want, we can't see it. When you, at AWS, work with a model, what we do is give you a copy of the model in your environment. At that point, we have no access to the model anymore. So you will tune it, augment it, change it, fine-tune it with your data. We don't see that because we've given you a copy of the model, runs in your environment, it's yours to play with and do what you need to, do what you want with. So it's not our model at that point. We've given you a copy to work with. And so we feel like that is a way to make sure that we're continuing to maintain the integrity and privacy and security of the data in your environment. The model becomes part of your environment that you maintain control and have access to. Just like anything else, we're built on open source technologies. So we feel like if you want to pick up and move to another provider that provides similar open source technologies, we feel like we're building something in a way that's compatible with that. And so we feel like if you need to do that, you can. We just want to continue to provide the best experience and services so you don't feel like you need to.
Yeah, and the resiliency of your cloud and where this is kept?
Well, with over 30 regions around the world and in regions built with multiple data centers, I just finished a tour in Asia where I had to talk with governments there about our resilience and capability. And from the ground up, even at the region level, we use multiple data centers with multiple availability zones, multiple power sources, all of which just to make one region secure. And then we have customers who go for a higher level of resilience and they say, well, we want to deploy in multiple regions. So if we have a regional issue, we want to be able to move to another one. All of our regions run independently. So from a resilience perspective, we have like 3 times less events and impact hours, I think is how the way you measure it, than any other cloud provider. So we feel good about it. We won't rest until that's as small as possible. So it's something we're super interested in.
Look, it is amazing how this conversation keeps evolving.
Yeah.
Last year, there's all the hype. This year, there's like this practicality, this urgency to move fast, but do it in a safe and sound way. So thank you for that.
Yeah.
So earlier, there was a panel on the future workforce. And one of the panelists from LinkedIn made a comment that based on job postings they're seeing, their jobs, AI expertise jobs, but then there's also AI literacy jobs, I think is a job, the fluency of AI.
Yeah.
So how much of this do you think is going to change the workforce? Is there a skills gap? Can you talk about what those skills are, just generally, as we understand this technology better?
Yeah, it's a great question. Even in my own organization, so I have a project management team, and they help run some of our operational capabilities. And one day, I just started to show them some of the things I could do with generative AI. And it was a simple thing where I took an Excel spreadsheet, I dumped that into generative AI, and I asked questions about the data in the spreadsheet and got formatted answers in a way I could present in a document. And my program management team, their heads just exploded. They're like, oh my gosh, do you know how much time it takes us to convert from one format to another, to gather data, collate it, and make it presentable? And I said, well, here's some tools, go to it. They come back to me every week with, look what I did, look what I did, look what I did. And so this is that idea that it's impacting multiple kinds of jobs, that it's a creativity and productivity tool that sometimes I worry that it's bounded by what we can imagine. And so one of the interesting challenges I found is if you're of an age like me, you're used to searching the internet with like 5 words, right? What's the minimum amount of keywords I can get to get the right result back? And what's fascinating is with these generative AI models, it's actually the reverse. You want to provide a lot of context about what you're trying to do so you get a better result. And so we have to unlearn some IT behaviors or technical behaviors we've done in the past. And so in this case, I think some people who maybe come in with a fresh approach are going to have more advantage there. So it's funny, when you say skills gap, it's not only people who don't have skills, but those who have skills that we need to kind of maybe unlearn or relearn or modify and adapt.
Yeah, you talk about the production mindset. I think she talked about this mindset of, I guess, relearning.
Yeah.
Do you think it'll create new jobs as well?
I do. I think, the people who are able to really get the most out of the productivity benefit of using these models, you're going to see expertise in doing that. How do I get the most out of a model? I think you're going to see jobs in the model training and tuning space a lot too, where what we're seeing with customers is, I talked about use cases, we're actually starting to see customers choose different models for different use cases for whatever reason, whether it's speed, accuracy, cost, domain knowledge and expertise. Some of the really, really large models are starting to become very generic in their answering because they're trying to get ahead of potential regulation too. And so they're becoming very generic in their answers. And so we're seeing customers say, I want specific models, which means I'm going to need domain experts to train, supervise, and oversee the model itself. And so that's going to be a new role as well, I think.
Yeah. Look, I appreciate AWS's emphasis on responsible AI. That keeps evolving as well as to what that means. Are there some bright lines that we shouldn't cross to remain responsible?
I think this gets to the bright line for me is if today you have a process by which you use legal review or you have an internal process to review content, and you're thinking about using generative AI to create content in your organization, you must use those same procedures with that output. I have some customers who are like, well, I'm like, bring legal in. They're like, we bring in legal in early? Like, whoever asks for that. And I said, well, today when you produce content and you're going to publish it on your website, you likely have a process. It's got to go through legal review, plain language review, all this stuff. You cannot, in my opinion, say, oh, well, it's AI. We don't have to do that. So for me, the bright line is if today you have ways to protect your liability, ways to protect your security, ways to oversee and understand the quality of the data your organization produces, You have to use those same processes for generative AI. When you don't, you're really courting change.
Yeah, I totally agree. You know, one thing I would add to that, at Fannie Mae, we also have cross-disciplinary groups as well come in before we launch anything. So, look, it's year 2, I guess, sort of. The hype was last year. This year, we're all getting a little bit smarter. Still don't know a lot. So, really, thank you, Dominic, and thank you for all that AWS does for Fannie Mae, for our industries, for the financial services. We didn't even get into that, but thank you.
Yeah, my pleasure. Thank you so much.
Okay, let's give him a nice round of applause.
Thank you.
So I will welcome back our host, Chris Brummer.
Thank you, sir. Thank you.
All right, well, you know, I guess my first lesson was I'll just have Priscilla do this the entire time. That was a great interview, super interesting. I did want to also give an extra hand to both Fannie Mae and AWS because, you know, every year people are like, oh, Chris, how do you do all this? It's because there are so many people who put so much effort into making this event happen, and really both organizations have been instrumental, so thanks so much. Now, we've had the great conversation about the efficiency gains that are unlocked with AI, but we're also going to bear down a little bit on you know, the fact that with great power comes great responsibility, and into a conversation about geopolitics and really what does AI mean from a national security perspective. So with that, I want to dive into the geopolitics with AI, and I do want to, I guess, call to stage another great panel led by my colleague Douglas Arner from the University of Hong Kong.
Thanks for that, Chris, and big thanks to the whole DC Fintech Week team, as well as to Fannie Mae. This is a beautiful venue and all has been run, I think, really amazingly. Yeah, I think Chris has left me, as usual, with a great panel. I'm joined by Carol House. Carol is Special Advisor for Cybersecurity and critical infrastructure policy with the U.S. National Security Council. I've got Leonardo Gambracorta at the end. Leonardo is Head of Innovation and Digital Economy at the Bank for International Settlements. I've got Šimonas Krėpšta, one of the board members of the Bank of Lithuania, and Chris Knight, advisor to the Chief AI Officer for Governance and Policy of the U.S. Department of the Treasury. And you know, I think it's interesting if we think about the topic of this panel, geopolitics of AI. It's something that 2 years ago, AI was a bit of a niche topic. And we've definitely seen over the past couple of years with the advent of ChatGPT, the incredibly rapid take-up of generative AI, that this has become a dominant topic of these sorts of discussions, really in every context. But we've also seen something that is a bit of a wider context, which is that we're seeing around AI a range of concerns around security issues. That's certainly a big question. But we're also seeing a lot of issues from the standpoint of competitiveness. In other words, how can countries not only protect their security, but also maintain or enhance competitiveness? And we're seeing an increasing range of strategies around the world as countries try to figure out how to balance some of these risks of data and analytics technologies like AI, but at the same time, how to strengthen their own competitiveness going forward. And that's really what we're going to be focusing on this panel. And I think first, I just wanted to get a little bit of a picture of the threat landscape. All of us spend time thinking about the sorts of risks or problems that could emerge. From your standpoint, what are you each seeing as the biggest risk that keeps you up at night?
Right. I can kick it off. The National Security Council is good at focusing on threats and highlighting the scariest possible outcome and preparing for it and making sure that we're taking steps to mitigate that threat. So as Doug mentioned, like AI isn't new. Like we've been around. I've even built terrible machine learning models, but please don't look at my GitHub. It's not great. But AI has been around for a long time. Companies have been using it forever, or not forever, but for a long time. What was new was this democratized access and this broader paradigm shift towards democratization that we're also seeing in other emerging tech like blockchain. But where here that means democratized access to really incredible capabilities to drive like higher order economic developments, but also democratized access to a lot of illicit users. And interestingly for me, like I was a chemical officer back in the day in the U.S. Army. It's so funny, working in chem, working in countering financial crime at FinCEN, and then 3 tours at the White House and one on the Hill focusing on cyber. AI presents a really interesting threat use case for all 3 of those issues, focused on cybersecurity, chem, bio, rad, nuclear, defense, as well as in financial crime. Because now the same advanced protein models that you could use to support and accelerate vaccine discovery could also be used to accelerate the development of bioweapons. The same capabilities that you have in AI to be able to generate secure code that we all rely upon and is integrated in our critical infrastructure could also be used to massively develop and then scale malware. Those kinds of capabilities, or to be able to scale our ability to respond to emergencies, those capabilities could also be used illicitly by nation states to support surveillance and human rights abuses and unlawful and undesirable surveillance. So these threat issues are very near and dear certainly to my heart, but also to all of those working across the US government and at the White House, National Security Council, and our other components. So those are some of the key threats that we've been looking at. Certainly the pervasive access of deepfake capability to now scale a really sophisticated capability to circumvent almost every financial fraud control that we would focus on, even when I was at Treasury. If it's really easy or arbitrary to create a deepfake that will circumvent our authentication and verification ecosystem mechanisms, then that creates a real problem for us, especially when we already had problems with synthetic identity fraud in the financial system. Now that threat is only scaled further.
Yeah, and I think the speed of these changes is making it even more difficult. Leonardo, over to you.
Yes, and now I would like to contribute to the discussion with 2 areas of analysis we are conducting at the Bank for International Settlements that are apparently potential threats introduced by Gen AI. The first one is the fact that the AI supply chain is highly concentrated. This goes from the production of chips to training the data, cloud computing, and also the foundational models are in the hands of a few big tech company. This could introduce, of course, some geopolitical risk, but also a situation in which you have model herding, also behavior of agents that could be very, very similar. And the second, let's say, threat that is under analysis in terms of research is the fact that because of this AI supply chain that is highly concentrated, there is, on the production side, there is also a risk that the benefits will be concentrated in terms of growth and productivity in certain kind of areas. And then when you look at the demand side, and we consider the fact that Gen AI will produce increase in productivity that will be very different across sector of economic activity that have different cognitive tasks. These are different across economies. So this means that, for example, if the benefits are mostly in the financial sector, in healthcare, these are sectors that are mostly widespread in advanced economies. So this could produce increase in inequality in terms of output. So these are the 2 areas that we are currently investigating at the BIS, among the others, of course.
Yeah, thanks for that. I think that first point about supply chain concentration is one we want to come back to. And the other, this idea of the differential benefits and the possible impact that that will have. Simonas, from your standpoint at a central bank.
Well, happy to be here, first of all. And from the general note, every technology which could be really powerful, and AI is powerful already, and it could become very powerful in 5 or 10 years from now. Safety and trust is critical. And everything which can be weaponized will be weaponized. We know it very well, given our location, geographic, geopolitical location. And unfortunately, weaponization will probably come before commercialization. So that's the broad scene. So I think safety is crucial until we get to this point when AI is really powerful. Going down to the financial sector, and I, as a financial supervisor, looking to banks and financial institutions. So AI is being used. We have surveys, so majority of banks are using, and financial institutions are using AI quite on a large scale already, on fraud detection, AML, customer support, and different functions. And we have in Europe already regulation in place. So it's also AI Act, which lists different AI systems from low risk to high risk to prohibited, actually. So it will be interesting to see how that works in practice. It comes into force in 12 to 18 months from now, and institutions should be determining the systems, and then some of them should be illegal to be used. But definitely key risks are three, I suppose. Concentration, that's definitely very important, and concentration and dependency, that's very related. So banks will become dependent on key suppliers of AI, and that of course brings a lot of issues. Second thing is misinformation, which is very much related to trust. Financial sector should be the flagman of responsible AI. I think that's critical. It could and it should be a flagman because this trust issue is so core for financial sector and AI as well. And last thing is also fraud. We can see, instant payments developed in Lithuania very rapidly five years ago, and that of course brought a lot of benefits to e-commerce and consumers. But fraud levels skyrocketed as well, especially cross-border fraud levels on cross-border payments. So I suspect that very much the same will happen with the development and spread of AI. So we should be cautious and start building the safety net for that.
So on the fraud side, you've already seen an exponential increase. On the cybersecurity side, are you seeing similar sorts of increases?
Definitely. On the cyber side, again, going back to financial sector, the key threat is professional actors. And we constantly see attacks from the east side of our border on financial sector. DDoS attacks, that's a daily issue. And we had a Nordea case. The Finnish bank was not available for 5 hours, 4 or 5 hours, the major Scandinavian bank, and that was a critical incident. So definitely that's key. And of course, with use of AI coming into operations, that could exacerbate and become additional threat. So it's definitely very important for banks and financial institutions to invest quite a lot of in defense capabilities on their front. But also, the state level is also key here.
Chris, we were actually having a conversation just before that previous to your current position, you were more focused on supply chain issues,
yes,
and now looking at AI issues. And so even though you haven't worked at this sort of intersection, I wanted to get your perspective, having worked on both aspects.
So I think it's very similar to what Leonardo had said. I mean, he's the expert on that intersection, not me. But it's definitely the thought of there's a lot of concentration for where the components and the hardware that are needed are developed. There's even the concentration of vendors, the really advanced types of AI, even the locations of where the infrastructure is built up. You get a lot of these areas that people just love to put data centers in. So again, even the geographic concentration of the support functions tend to build up. And when you're kind of concentrating all of that into these localized areas or very limited in the diversity, you then run into the issues of a geopolitical conflict that maybe knocks out that region. Well, now how is that impacting the supply chain? How much are you actually going to lose? Are you going to be able to carry on with what you're doing? Or a natural disaster that hits a region and maybe knocks out a quarter of the data centers that are supporting the AI for a country. how are you going to recover from that? So really that supply chain piece, looking at it now from the AI perspective, based on where I used to be looking at supply chain, definitely has a heavy overarching impact that's possible.
Yeah, thanks for that. I think that gives a good picture from the standpoint of the threat landscape. And I think from my standpoint, the one that if I get paid, as many of you do, to come up with the worst case scenarios, and the combination of use of AI in the cyber threat context, where we're seeing increasingly independent development of threats, I think is something that I view as a very significant concern. I guess, given that background, the next question is kind of obvious. What can we do about this? Where is a good place to start from the standpoint of security or competitiveness? Carol.
Great. I know I mentioned the NSC is good at painting threat pictures, but we're good at identifying solutions too with many of the agencies that I see represented here and industry partners. So we don't just admire problems and threat landscapes. But I loved the point that you made. It's about, so much is about trust. So secure, safe, and trustworthy ecosystems have to be developed for any emerging technology, certainly something like AI, where its ability to scale, like really any capabilities and applications, positive and negative, is where we have to invest, and why the White House and the president supported through an executive order focused on artificial intelligence and driving that security and safety in the ecosystem, did things like establish our AI Safety Institute inside of the Department of Commerce, as well as promote a lot of investment and R&D that we need to be driving organically and doing in partnership with industry to really create the foundations for the frontier research that we need to create for the future of an AI workforce that will promote its safe and secure development, but then also to address some of the supply chain and also competitiveness issues for us. I'd say on competitiveness, some of what we think about is certainly competitiveness with either like adversarial or not like-minded nations, or even just criminal actors. Like the adversary sets the pace, so we need to keep up, and why we have certainly been looking at where we can be driving the right levers to ensure that we are using AI to support our cybersecurity, that we're identifying where there are unique AI security incidents and vulnerabilities and exploitations that are occurring. So I think there's a ton of opportunities there. Research on things like watermarking and stuff that will help us to address this content authenticity and trust problem. Investments in identity ecosystems that we have to figure out how to address, which was a problem already that we needed to address for fraud, but now with AI, it continues to present itself. So I think there's a lot of great work, including at NIST, our standards agency, that we can build off of, but we need to continue to look at what are the mechanisms, standards and best practices that we can put in place to identify and defeat those. And then other than that, on the US competitiveness front, continue to drive our investments to build that workforce. And also, I think 2 years ago, like the US we weren't home to any of the top chips, like microchips that are needed to be used in really sophisticated AI models. And right now, we have, I think, 5 of the top companies now in the US, and we are on track by 2032 to produce almost 30% of the top chips in the space that we need. So us recognizing the fact that AI is going to be one of those major game changers for positive economic development, as well as that could potentially be exploited and manipulated, that we need to work with like-minded nations to ensure the resiliency of our supply chains, to ensure that these technologies develop in a secure and trustworthy way.
I want to come back probably at the end to this question of speed. Are we going fast enough? But let me throw it to Leonardo from the standpoint of your research.
Well, Doug, coming from Basel, I work at the BIS. Of course, I have to speak about regulation. So regulation is very important in order to establish a good development of technology. I personally think that should be not too prescriptive, especially at the beginning, because it has not to choke off the innovation, the good innovation. So we have to start from a very good principle, that is sustainability, transparency, accountability of the model. And then we have already example in the various jurisdictions that have developed in Europe, the NIST in the US. Also in China, there are rules in terms of establishing the good properties of technology. So the literature has established that we have 3 models. That is the established by the work by Anu Bradford. It's the market-driven model in the US, the state-driven model in China, and the consumer protection model in the EU. But the good news is that these three models are converging somewhat, and we see that there are a lot of initiatives also in terms of privacy in China, for example, that are recently developed. So this means that we have good basis to produce something solid in the future. We have to consider also that data and technology, they have no borders, so we need to cooperate internationally. We have to cooperate on governance, on rules. In particular, I believe that we have to establish a good community of practices among for example, central banks, but also the private sector, in terms to establish what should be done in the future to have a very good technology that is for the good use for everyone.
I think this is in some ways an interesting point, because we are seeing different strategies from different major markets. And I think it's probably too early to say that one of those strategies is necessarily going to work better than the others. And I think that makes this a very interesting period where we're going to see competition from the standpoint of approaches. Shimonis, from the standpoint of really a small open economy, what do you see? I mean, what can you do from that position? It's sort of a harder position than, if you will, being one of the major economies.
Obviously, but we are part of Europe, and as a decent European, I should also start with regulation and supervisory framework, which we actually have in place already. We have an AI Act, we have a DORA regulation, which is a Digital Operational Resilience Act, and obviously we have data protection laws several years back. And all this combination brings the framework, which is quite robust. It will come into force in a year or so. Of course, it's concentrated on consumer protection mostly. So it's kind of the key thing is that the consumer will get services and financial services with AI in a safe manner, and he or she will be aware that AI is providing some services. And some services like social credit rating will be banned, outlined in Europe, and there will be a regulatory framework with different authorities in place, which is working on that. So that's one thing. But of course, when we talk about the more strategic level and geopolitical level, definitely we have banking standards in Basel. Why shouldn't we have a Vilnius AI standard or any other city standards? But I think it's key to have such agreement on a global phase, because this is a cross-border issue, and definitely we need standards. And last but not least, all financial institutions should prepare investment budgets, big ones, because I guess from the cyber point of view, if you're not building enough defense over the years, I think it could be very, very difficult, to in 5 or 10 years, when this thing is so powerful, to catch up quickly without any losses.
Yeah, I would throw in the other side of that from the standpoint of government R&D budgets. It's probably going to be central going forward. Chris, from your standpoint on that sort of governance side.
So from the Treasury side, looking at it from the governance, one of the big things is, and it touches on what everybody's already said, is really that cross-border cooperation, collaboration, kind of making sure that we're working with our partners to kind of develop even just frameworks, recommendations for best practices, not necessarily the same regulations or standards, because it is going to be different country to country, region to region, but making sure that there is some sort of a standard, best practice, some sort of a framework that we can kind of work together on. Treasury's done a lot of work with the G7, especially the Cyber Experts Group, looking at a lot of the emerging technologies, so AI, quantum computing, and really kind of seeing internationally what are some of the commonalities that we have, what are the common risks that we're seeing, what are the common threat pictures that we're seeing, and how can we kind of address those in a common way to make sure that we're discussing. And in international cooperation is something we do in every other field. Militarily we're doing it. even just regular cyber defense, law enforcement. So really AI security should be another thing that we're looking to do that way. Treasury had released a report earlier this year where we spoke to a lot of US financial institutions to see what they thought the biggest risks were and how they think we might address it. Listening to my colleagues up here on the panel, it sounds like across the globe, it's the same threats and the same risks everyone's seeing. So clearly there's a common picture and a common approach that we should be taking to really kind of get down to the nitty-gritty of this and make sure that we're focusing on it in a cooperative and collaborative way.
Yeah, I think from the sort of this side of governance, it's helpful to frame it. We often talk at different pieces, and you have sort of macro governance issues, which are issues around general intelligence, or as Leonardo was highlighting, around the sort of inequality issues that could possibly emerge. And that's one thing where you're seeing the emergence of these general frameworks like the EU in the context of, say, what I think of as micro issues. These are issues of fairness, bias, et cetera. And often in the context of regulated industries like finance or healthcare, we already have frameworks to address these sorts of things. The third piece, and I think it's been a real theme for the panel, has been this issue around infrastructure. The fact that this is something that we're thinking of differently. And I think the last two pieces, one is around the malicious actors. And this is something that I think we often focus too much on regular actors and how they may misuse, as opposed to active malicious actors and the threats that come. Final is really from the standpoint of culture. And where I wanted to go really for the last piece of this panel was this thing that I had flagged earlier from the standpoint of speed. Is what we're doing going fast enough? And if it's not, are there ways to increase the speed of what we're trying to do?
I'll start. So I feel that there's absolutely more work to be done. I've been in awe of the entire interagency coming together, as well as partnerships with industry and many companies reflected in this room that have made commitments to help drive some of the objectives that we've talked about. So there is a lot happening to help make this a whole of nation effort in the U.S. And obviously we work a ton with our friends in Europe, as well as all around the world. So I think that there is a lot that needs to be done on scale and speed. But I hear you on infrastructure, and that I think that more is needed. It reminds me a lot of conversations that we had even in the blockchain space. Since that's coming up, I feel like I had to mention that these technologies also potentially converge in interesting ways. This is just a personal view, but I was at a session in Japan in March before I returned to the White House, and we were talking about the convergence, and I asked ChatGPT during the panel, if I deployed you on a decentralized network and then you had a vulnerability in you, or some kind of vulnerability or malicious exploit in your code, could I take you down? And its answer was amazing. It was it depends on how decentralized I am and how good my security is and how good your authorities are. And I was like, that's a great answer, ChatGPT, goodness. So clearly, I had that discussion with some Treasury colleagues before about how interesting of an answer that was. But highlighted two technologies that, again, reinforce each other's best and worst traits in fascinating ways. Issues of responsibility and accountability, creating the infrastructure for trust and authenticity, and what accountability looks like in that future digital domain. I think that there's lots happening. We do need to continue to speed those partnerships. We also need to think more broadly about how lots of tech issues and other sorts of nexes, I think, interact. So I'm sorry if that was kind of an oblique answer to your question.
Yeah, no, it's good. Leonardo.
In Latin, there is a saying, festina lente. So this means that sometimes to go fast, you have to slow down, you have to think, We need to think about what kind of technology we want, what kind of automation we want to choose, and so on. So technology is just a mean. We have to reach a good compromise and good welfare achievement, trying to be savvy, not to overreact, not to be too prescriptive, to choose what is the best for society.
Yeah, good point. Shimonos.
Well, in finance, we have a long history that we run into trouble first, and then in the big one, some crisis or something, and then we start getting really fast on regulation and supervision and different issues. So I hope that is not happening with AI, but that could happen. And I think we should, we work so much on individual levels. EU has a regulation, but I think the global standards are key here, and it works really fine with banking. These Basel standards are not legally binding. It's an agreement, and then every country, imposes with some national specificities, but general building blocks are there. So I think that could be done for AI, and that will be really a good work for the whole safety of the whole ecosystem.
The opposite side from Leonardo's strategic approach. Chris, last word is yours.
Best part of going last is I could pull a little bit from everybody else's answers. It's definitely the approach of we could be doing more, but definitely taking the slower approach to do that. Everyone's got a piece of it. Everyone's got a role to play. Making sure that we're working together and we're connecting all of that up is really going to be the approach. You can go as fast as you want on your own. You're still not going to get there as good as if you slow down a little bit and work with somebody who maybe has different insights, different capabilities, and kind of support what you're doing.
All right. I'm not sure we're going fast enough on some of the threats, but maybe I just look at the dark side too often. If you would, join me in thanking Carol, Shimonis, Chris, and Leonardo for a very interesting panel.
Good afternoon, everyone. We've got a fun panel for you here for the afternoon. I've got here with me Toshiyuki Miyoshi, Vice Commissioner of International Affairs, Financial Services Agency, Japan. Yelena McWilliams, former FDIC Chair, Partner at Cravath, Swain, and more. Greg Rupert, Executive VP, Member Supervision, FINRA, and finally Kwame Opong, Director, FinTech and Innovation Bank of Ghana. So I think we have an interesting topic, right? As we're talking about ally or antagonist regulators, we have to acknowledge that if you're a fintech, if you're a company looking at the regulators across the board here, they probably have different views of what they would consider an ally or an antagonist, and that's partially why things like regulatory arbitrage exist. So maybe let's start off the conversation with some nuance. Maybe I'll start with you, Toshiyuki. Mm-hmm. We have a lot of different geographic economies here represented on this panel. I want to start with Japan and talk about the fact that you guys have just gone from zero interest rates into an environment, finally after 17 years, where there is some yield there. You're in an economy that actually has very few unicorns despite being very technologically advanced. And so can you talk about basically what's going on? Are you trying to get more unicorns into the mix?
Okay. Thank you very much. And first of all, I'm really pleased to join this panel. As you said, that Japan has kind of struggles to have kind of unicorns and other emerging fintech companies in the past few years. One of the most significant challenges facing Japan is demographic. So in order to raise productivities, the Japanese government sees that fintech has a great potential to address these structural challenges. So to this end, the FSA, in a nutshell, we do not want to be enemy of the next gen fintech, of course. So of course, we do need to address the risks associated with the use of technology, but at the same time, we try to be kind of to put in place a kind of optimal combination of principle-based and risk-based approaches in approaching the risk associated with technologies. And we try to be collaborative with the private sector companies, including financial firms and fintech companies, in an effort to put in place a kind of regulatory and supervisory framework that also promotes the responsible use of AI. So that is the FSA's main objectives in fintech regulation.
Maybe I'll follow up really quickly. I mean, do you have a preference for a lot of the fintechs in Japan? A lot of the fintech innovation in Japan, I should say, is not just from younger startups. It's from like Rakuten, right? For example, has been around for 20 years, and it's become a prominent digital bank. Does Japan have a certain preference for existing financial institutions and fintech financial innovation coming out of there versus newer fintechs, right? It's a known variable versus an unknown.
We are pretty neutral about that, and we also welcomed an entry of new generation fintech companies that would induce lots of kind of competitiveness in the market. So we are not really discriminating against these sort of companies. We will welcome it, and in the context of reviving Japan's capital market, we are now putting in place sort of measures to promote new entries into Japan's capital markets to provide financing to startups and venture capital. So, of course, existing financial institutions are welcome to use fintech as well. So we are pretty neutral on that.
Great. Kwame, I would love to get your POV on this. Right, Ghana is in a very interesting situation. You guys are usually ranked 4, 5, 6, depending on the year, in terms of the number of venture capital deals in total. Can you talk a little about what you guys are prioritizing in the fintech space?
Sure, no, thank you very much, and glad to be here. I think for us, it really boils down to being a developmental issue. So primarily focusing on things like inclusion and economic development, we recognize the fact that fintech plays a significant role. And I think the jury is out on that whole effort. From a policy standpoint, when you look at our financial inclusion numbers for the past 10 years, for instance, if you look at a fintech survey, consistently you're going to see some uplift whenever there's a significant policy input. But there are certain lessons that I think are driving what we're seeing and why we're emboldened to do what we're doing as it stands. The goal is really, as I mentioned, to drive broader economic growth and inclusion. But also we've noticed that, as Toshi mentioned, the approach of a collaborative regulatory process is quite useful. Secondly, I think when you look at the nature of the emerging technologies that are coming up, many of it are decentralized, right, which has a significant risk and implication for us. And if we are to avert a financial system integrity problem on our hands, then it's important that we lean in a bit more. So we don't get to sit on the sidelines anymore. We have to lean in a bit more. We have to engage a bit differently from what we did in years past. And perhaps the most profound is we ourselves have to be a bit more involved in co-creating to understand the risk of some of these emerging innovations that could have the potential of transforming our society, but in doing so also ensuring that we're preserving our mandates for ensuring sector stability and safety of the overall ecosystem, particularly for our vulnerable population. So this is the approach with which we are taking our fintech development and regulation and supervision within the Ghanaian context.
So I think this question is a little bit interesting for both Jelena and Greg, because you guys aren't technically part of a regulatory body at the moment, right? Greg, FINRA is more of a member supervision. Jelena, you were former FDIC, but now you're on the other side now. You're on the private sector. So maybe I'll start with Greg. Zoom out a little bit for me. Let's talk about just the overview of what's going on in the US, right? What is the state of, it's been, let's say, what, fintech wasn't a word 10, 15 years ago. It just became more of a context, of a concept that's more understandable now to the general population. And so what's different now today about fintech regulation versus, let's say, 15 years ago or even 10 years ago?
Yeah, I think that's a great question. And ourselves, FINRA, as a self-regulatory organization for the broker-dealer industry, we stand kind of in between the government agencies as well as the member firms. We have a team that is responsible for approving the applications for anybody that wants to be a member. So that's really where we have seen an uptick in either more complex business models or those that are coming into the fintech mode. But at the same time, we're also assessing what's happening with investors. Our mission is to protect investors and safeguard the markets. And as we're watching in a post kind of COVID pandemic environment, we've seen a lot more investors move from what we'd consider to be like the kind of the hallmark of a full-service broker dealer with your own personalized representative or registered rep, as we call it, broker, into self-directed. And a lot of that comes into the fintech space. So we're seeing kind of a perfect mashup of where innovation is coming in, where firms are coming in to be more self-directed. At the same time, investors are looking for that opportunity. So we're in the forefront of that, and we're calling that out in terms of the risks, as well as what we're seeing in our exam program. And we're speaking now like never before to both investors as well as the firms that we regulate, because we also see a criminal activity happening outside of the firms, outside of the U.S., coming in and seeing opportunities to target both investors and the firms at the same time. So it's a little bit of a different equation for us than we've had in the historic past pre-fintech.
Yeah. I'll ask the same question of you, Yelena.
I think it's actually interesting you ask a question, what's different now from 10, 15 years ago. 10, 15 years ago, all of these fintechs that would team up with the banks were basically part of the third-party relationship management with the bank. Now they have a very distinct category, which is fintech, and I'm not sure that's good for the fintechs, to be honest with you. If you take a look at sometimes it actually feels like the status quo is defending its domain against the new. And so I think you see that in the regulatory space as well, where the new entrants into the marketplace are not welcome necessarily with new bank charters. Like, we have not changed our chartering system to accommodate, like some other jurisdictions and some other countries have done, the inclusion of fintechs into the financial services landscape. So they have to apply to be either a payments company at a state level, or they would have to apply to be a bank. The ILC route, the Industrial Loan Corporation route, is mostly closed for everybody. And so I think that's the unspoken being spoken. But I do think it's important to know that for all of the talk, like we want to stimulate the economy, we want to have more rather than less, we want to have a diverse landscape in our financial ecosystem. If you really think about it, there are about 4,800 banks left in the United States. And out of the 4,800 banks, about less than 10%, about 400, have a fintech relationship, whether it's for IT services, whether it's for something more. Of the 400 something, about 120, 150, depends how you look at it, have more than one. And of those 120, 150, you have about 20 that are super hyper active in the banking as a service fintech space. And of those 20, 13 or 14 have enforcement actions against them. So to them, if you look at ally or antagonist, whatever is the title of this session, I don't see how they look at regulators as an ally. So certainly their perspective would be that the regulatory environment is very antagonistic.
Specifically in the US?
In the United States, yes. I can only speak to the United States. I mean, I can speak about anything, but you really... I joke with my neighbors, I have opinions on things I don't know nothing about. So I can, but I'm saying in the United States, I worked at the Fed, I was on the United States Senate Banking Committee as chief counsel. I was a GC at a large bank. So my perspective is United States-centric in this space.
What do you think's changed?
What has changed? A lot of things, and I think we have 12 minutes left, so not enough to explain really what has changed.
In 30 seconds.
In 30 seconds. So I think part of it is the regulatory space. I think there was a backlash after the global financial crisis in 2008, 2009, where we're just not open to risk. Absolutely. And if you're a regulator, the easiest thing for you to do, you get into your chair, you get a title. They call you the honorable for the rest of your life. I'm trying to tell my family this, they're not buying it. So they really, the easiest thing you can do is do nothing, right? Why would you accept any risk? The risk as a regulator can only drag you down, because the next regulatory regime will look at you and say, that was that guy's or that girl's fault, they did X. So really as a regulator, you're better off not being brave. This is not like a brave new world. This is let's go back to the not brave old world. So part of it is also political. I think a lot of these issues become political buttons, especially in the United States. I was just in London last week, and I talked to some senior folks in the regulatory agencies there, and I was like, you're so lucky. Men, they were like, why? Why are we lucky? And I said, you're so lucky. I said, where I come from, anything I do was political. and viewed through a political lens, whereas they get appointed for long terms, they're not political per se, and different regimes look at them differently. So I think a lot of things, and then really the innovation has become very cutting edge. And so things that were unfathomable technologically 10, 15 years ago, underwriting people based on their not credit usage, but just about everything else. Like that wasn't even a concept that was possible a decade plus ago. So as you look at that, you're running into the problem that the regulatory agencies, the examination staff is never going to be ahead of the technology. So they're always going to be behind, and the question is how far behind. So as you examine, as a regulator, you examine, the staff is coming to you, the examiners are saying, well, we don't know what this is. Right. And at the same time, then you're looking as a regulator, like, why would I allow this to happen and be connected to the banking system?
Right. Toshige, I see you nodding.
Oh, yeah. So in the case of Japan, because after the 1919 banking crisis, the FSA was established, and we needed to do a very heavy-handed way in supervising banks, and we had a kind of very notorious reputation of being very heavy-handed, regulating everything, avoiding everything risks whatsoever. So but we felt the need to change our approach to regulation and supervision, particularly since late 2000, and particularly after the global financial crisis. As I said, that demographics is coming in as a greatest challenge to Japan. We do need to make use of this kind of emerging technologies in order to improve efficiency and raise productivities, including in the financial sector. So in some sense, we felt the need to strike the right balance between mitigating risk involved in these sort of technologies, but also trying to promote the responsible use of these technologies in order to advance on structural reforms.
Yeah, maybe I'll broaden this out. In fintech right now, do any of you see, and this is like the big regulatory question, right? Within fintech right now, do you see a big systemic economic failure level issue within the ecosystem? This is the what keeps you up at night question.
Oh, why don't you go first?
I'll go first. I'm a current regulator. So we saw the kind of volatility spike in early August, particularly in the Japanese market. We are still, investigating how it happens in terms of, the surprise kind of move by the central banks in both across the Pacific and something. But one of the factors might be, we do not have any kind of concluding evidence, but one of the factors might be the increasing use of so-called algorithmic kind of trade or high-frequency trade, in which many companies use the same model for analyzing risks, meaning that if any kind of shock happens, many companies go in the same directions, creating a kind of herding behavior, something like this, that might create or amplify the kind of market volatilities. And if that happened to the extreme, that could make things very challenging for regulators.
Yeah, and I think that's something the U.S. Fed's kind of been concerned about too.
No, I think it's a very interesting question because as a regulator, your primary focus is to manage risks. And I think any day you wake up, depending on the news of the day, there's so many things that could keep you up for that week, that day, or that month. And so the question is...
Do you have a tally?
So it's always an interesting one. But I think for me, the fundamental concern that I have are on two levels. First is inertia, and the second one has to do with domain expertise. With all the things that are happening, do we have the domain expertise to understand and to properly guide the development of that kind of innovation so it doesn't mushroom on us and become a big problem? The second aspect having to do with inertia, traditionally as we recoil into the ease of the status quo, is that, of course, nothing breaks, hopefully, but then you also know what the counterfactual of that is. And so how do you take a step back and perhaps remind yourself that the regulatory work also is actually it requires a structuring of the ecosystem, right, of the sector. And it's a combination of the risk management as well as the promotion element as well. Now, how do you really juggle this in a way that ensures that there's progress, but at the same time as well, that you don't find yourself in a situation where you're up at night? So those are really the two things that I keep in mind, the inertia and the concern around the domain expertise.
I would say for me, what has me probably more concerned is the reliance on the third-party providers, and then the over-reliance, perhaps, by a number of firms that engage in financial activity on single providers. So you have situations where you've got, another third-party threat actor. We've seen a proliferation around ransomware and other cyber-related attacks. That taking down kind of critical vendors that then multiple firms rely on can have kind of a cascading effect or a snowball effect that could impact the larger market. So if we start to talk about systemic, I think that's where our area of focus has been over the last year, is really looking at what firms are using for those vendors and what's their cybersecurity platforms. Are they keeping up with the risks that are out there and the warnings that are coming out from the FBI, DHS, CISA? There's an additional amount of intelligence coming out to protect this sector, but is that being heeded? Is that being looked at? And is that being responded to? And then what are your resiliency plans if something does happen? And then you get to single source providers or single areas of services that's what kind of has me more concerned, of making sure we're tracking that and assessing that risk appropriately.
Right. This is the new stress test. Are we talking specifically about cybersecurity here when we're talking about vendors, or are there other third parties that you're also concerned about?
No, I think we saw it in like the banking crisis that we recently had on the mid-sized banks. So you have issues with does the FDIC insure the banks over a certain amount of that certain amount? Is that your operating capital? Or do you have additional plans to pay your staff? And so that could actually happen even in a non-cyber specific realm. So we're looking at multiple types of risk related to third-party services that firms use.
Yeah.
So I'll say that as the only non-current regulator on the stage, what keeps me up at night are my two dogs, which is a great thing. But if I were still in a regulatory seat, I think it would be the same thing that kept me up before, which is that we have an illusion of having minimized or reduced the risk in the financial system, in the banking system, at least as a banking regulator, I can say this. And I would certainly say there were laws and regulations put in place that allow us, as me as a former regulator, to believe that we have reduced risk. But really, the financial system, the products and services are like a balloon. You squeeze it here, and it comes out someplace. And the fact that you squeezing it here, you think you're regulating it appropriately, but it comes out someplace else, and you just don't know how or where that risk is being reallocated. So I would say that the illusion of we're regulating the right things the right way is something that I cannot overestimate enough how much regulators spend time on thinking about that. And inevitably, that gives rise to blind spots. And those blind spots are not necessarily in the immediate, subject matter in front of you. I call it like horse with blinders, right? You kind of stay within this. But it's actually above and beyond your space. And this is why in the United States, the Financial Stability Oversight Council was created so that the regulators can talk about this type of a risk. But it's still one of those things that no matter what safeguards you put in place, I think the illusion of we are regulating it the right way, and therefore we are not going to see some kind of a scandal come out of this or some kind of a systemic issue is something that I don't think that, speaking of technology, until we implement technology to the point of being able to truly see the universe of things, we're not going to be able to regulate appropriately.
Right. Maybe I'll follow up really quickly, because one thing that the two of you, Greg and Yelena, have kind of referenced to, I have to mention, and I think that this crowd probably is aware of, Yelena, you're a trustee currently of the Synapse bankruptcy, a banking as a service third-party provider.
The best job ever.
And Greg, you're with FINRA, which has also kind of been on the other side of that. So I'm kind of curious, do you see this as like a one-off issue? Do you see this as a broader? It kind of sounds like to you, it seems like there is a broader issue at play here. Like, what is the takeaway that you take from the Synapse bankruptcy?
I thought you were going to ask Greg if he's my ally or antagonist in the Synapse case.
Do you guys like each other?
Can we hold hands for a second? Just for the photo op.
Yes.
So I would say that I can only speak so much. There's another hearing tomorrow before the bankruptcy judge. I would say that Synapse, what happened with Synapse, and for those of you that don't know what happened to Synapse, I don't know, just Google it. It's one of those things that, frankly, could have happened to anybody. And really, when we talk about the third-party fintech relationships, unless the bank does the right type of due diligence, the right type of reconciliation, the right type of ledgering, the right type of information gathering, you're always going to be exposed to some level of vulnerability. In Synapse case, they were we call them end users, the depositors who put money in fintechs, who put money in Synapse, who put money in banks, multiple banks. And so when Synapse went bankrupt, I don't have enough hands. Can I use your hands too? Okay, all right. So depositor, fintech, Synapse, one more hand, banks. Thank you. Don't put it high up, just lower it down. So when Synapse went bankrupt, you can go down. Like what was left is these two had to work with the banks. We're good. And the banks had to figure out where, whose money they hold, but the money was held for the benefit of for the benefit of Synapse, not for the benefit of John and Jane Smith. So I will save you because I ran out of time.
Yeah.
This is when you work in the Senate, you know how to run out the clock. So I would say it's an issue that can happen to anybody. I do think there are going to be regulatory changes coming out of it that are going to hopefully make the system better. But in the interest of time, I'm saved by the bell. So,
darn. Well, thank you very much all for being here. I'm going to go ahead and also let Chris back up. Thanks for having us.
So we're about to take another quick break, but I did want to say we're going to try an experiment. We are trying to innovate ourselves in our next session where we're going to have a joint exercise with the Philadelphia Fed. Hopefully this will work, a little bit of a contest of sorts. We'll have FDIC Vice Chair Hill, who will be here, and then we will go into our final conversation on data-driven solutions for the American dream. And now we can go off stage. All right. As I said, we are innovating here. We are going to experiment and figure out a way to make this work. So we wanted to try something different here this year, and we are teaming up with the Philadelphia Fed, which is also having a conference on financial technology. And we wanted to try to do a kind of a joint session on blockchain. So you can sort of see some of the Philadelphia Fed participants there dressed better than we are. And we decided, to make this a little bit of a contest, between Team DC and Team Philadelphia to talk about sort of different aspects of blockchains to see which one is, sort of pushes the conversation a little bit further. And so I have with me here in Washington, DC, Patrick Merck, the founder and CEO of Surus, and Priscilla Koo-Wilkins from the Bank for International Settlements, sort of a very interdisciplinary team in DC. Go DC, go DC. All right, and I'll hand it off to Jalapa.
So on the Philly team, we have Jeff Barnard from Oracle, Hannah Halaberda from NYU Stern ComSci at the business school, and Bob Bench, who used to help us think about how to make CBDC work in the US. Used to be with the Fed and working with MIT. Now he has his own company. And he's building his own company he doesn't need a blockchain, right? So that's why you're here. Okay, we will start with the first question. So we heard so much this morning about how blockchain DeFi actually is the future of finance, infrastructure in finance. Do you believe that? Do you feel that blockchain is needed? And some believe that blockchain actually is a failed technology because we have seen some of the things that we have achieved without actually using blockchain. What do you think would be the main criteria, criticism of this blockchain so far? And would it work? Now you start.
So I can start. So a lot of blockchain projects promise groundbreaking changes in decentralization, transparency, and trust, but there's a lot of overpromising going on. It turns out that outside of the application of cryptocurrencies, when you want to go outside, decentralization is really difficult to achieve technologically, if not impossible. And where it is possible to achieve, it's very expensive to have decentralized systems. And also there are very strong re-centralization economic forces. So that lead back to creating intermediaries, strong intermediaries that now are anonymous because of the permissionless systems. So this is why I think that this is why we should be cautious about blockchain technology.
Is it cheaper? Is it more efficient?
It's
scalable?
It's difficult to scale. If we are thinking about permissionless blockchains, they are difficult to scale in a decentralized way. When we're thinking about scaling technologies like L2s, they turn out to be very centralized, but without accountability. And it's difficult to bring in regulation and accountability because we sometimes do not know who the people running those L2s are. And it's not cheaper if it's fully decentralized.
Who wants to go first? You? Yeah.
Okay, so you've got the real Oracle finally up in front of you. My experience with implementing CBDCs, or I should say my team for the Bank of Philippines, is we have a blockchain and it is Hyperledger from there. And I've seen a lot of problems. Hacking, wallets. So my group is mission critical, non-stop high availability, and we've never ever had a security breach. So you can imagine what our team said when we started getting into the blockchain space. So we kept quiet, we looked at the blockchain, we looked at all the risks, we looked at the problem with a bridge, the lack of getting over 3,000 TPS, and we said, we'll build this into the database kernel. So you can imagine the amount of engineering that Oracle Corporation has had to do in the database to solve the blockchain problems, to incorporate it. It's not about one or two blockchains, it's about thousands of blockchains. And you heard from Franklin Templeton, Sandy, where she said, and we have a database with all our KYC AML. So you know today that going off chains to get all your compliance documents, all this kind of stuff, but wallet draining, there's a lot of risks. So from Oracle's viewpoint, we have worked with central banks and the leading commercial banks. We're involved in pretty much all the top blockchain projects, and we're trying to take it to the mission critical layer, which is non-stop with all the privacy, all the security, all the reliability, and removing the barrier of 2/3 in this space, which is the RegTech, subtech for embedded supervision from there. So we do think we've got a way forward, but that's Oracle Corporations. And we think that the blockchain, the most thing that's affecting it the most is AI. AI is growing exponentially from my office in Silicon Valley. You just know about the Gen AI stuff with the human. You've not seen the stuff with no one in it. And that is just redefining. So the key area of subtech, regtech requires AI from there. So our industry is growing and evolved. So it's not, for mine, I've got no problem with blockchains, our fixed blockchain, which passes the test. But my issue is with really the embedded supervision.
Okay.
Yeah, Chris. Congrats getting Pat Merck in the suit. Well done.
I know.
So yeah, I think.
I've never seen this before.
So I think with blockchain, it's I've been in the space for a while, and then I try to put the rubber against the road at the Fed to understand, does this serve the purpose for the Federal Reserve in a research capacity, to be sure. And So crypto generally has done several great things. It's gotten millions of people around the world getting smarter in software. It's gotten millions of people around the world getting smarter in hardware. And it's gotten millions of people in the world to better understand, can you move value differently through disintermediated processes? These are all very good things. It is not a fit for purpose for every application, particularly when trust is involved. The key challenge here is when you have a Byzantine fault-tolerant network that orders transactions in blocks through a global ordering, which is how I define a blockchain, you have upper bounds on throughput and you have lower bounds on latency. It makes it very hard to move transactions quickly, it makes it very expensive to move transactions quickly, and latency is a problem. If you are dealing with trust, so if you are a commercial bank dealing with money multiplication or fractional reserve banking, if you will, or you are a central bank, you are dealing with trust at the nature and your core of your system. As a result, you are dealing in a trusted environment, and Byzantine fault tolerance is not necessary, nor is a global order of transactions. If you are building a hypothetical global currency that is sovereignless and censorship resistant like Bitcoin, it is spot on, perfect design, and why Bitcoin's been so successful. For everything else, you really need to ask the question, can this be done with an Oracle Postgres database? And that needs to be asked if you're an enterprise. Anytime someone comes to you with blockchain, is can this be done with Oracle Postgres? And you really need to prove otherwise, unless it's just a way to sell a token. And that needs to be the conversation every single time. If you need Byzantine fault tolerance because there is an absence of trust, it makes sense.
All
If
right,
you really need to prove otherwise, it doesn't need an Oracle Postgres database.
All right, well I'm going to then try to summarize what we've just heard for Team DC. I mean, blockchains suck, except for Bitcoin. And are not as effective as they need to be. Discuss. I guess we'll start off with the guy who's never in a suit, Patrick.
Well, I agree with everyone in Philadelphia that Bitcoin is amazing. So let me just put it out there, first and foremost. And secondly, I dressed in a suit because I can't disappoint Jalapa. That's like, and you too, Chris. So there's absolutely like a place for blockchain technology and decentralized technologies like blockchain. They are often more expensive. They often are less efficient. But you take that trade-off to secure other things, autonomy, privacy, those types of concepts. So whether that trade-off makes sense, I agree with Bob's last point. You have to just assess that on a case-by-case basis for whatever you're building. However, I would say that is the blockchain a failure? I mean, clearly no, right? We can just look at this room and ask how many people are involved in some way in blockchain technology and emerging technologies like that. I was just down the street at another conference with builders, and the room was full. So you look at the market cap, you look at the energy that's being put into it, and thankfully, unlike Hannah, I'm not an academic, so I don't have to take an academic sensibility to the promises that people are making in the space, which would be frustrating, right? Just because people sort of invent all sorts of claims around it. However, I would posit that that is not a exclusive to blockchain technology. It's basically any startup ecosystem that you find. I don't think AI has less hype and less inflated claims than the blockchain space. It's even, I dare say, seeped into our political conversations to some degree or another. So I understand the point, but I don't think that's the metric by which I would measure whether something's a success or failure. Rather, I'd say how many people are actually working on this industry, how much value has been created in it, and how much utility have people drawn out of it. And on those metrics, I think it's pretty clear that it's been a success thus far. Not every blockchain, most are not useful, but the few that have emerged or have really emerged, Bitcoin being the primary example.
Priscilla, what do you think?
I'll make 2 points.
Okay.
First one is, even though the name suggests it is about technologies, blockchains are not just about technologies, right? So the protocols underlying blockchains are about the creation of assets, the creation of value, and how assets change hands. That is inherently an activity that belongs in financial markets and a highly regulated market. And one of the reasons why you see a lot of the actors involved in this space coming together and coming closer to regulators even to ask for more clarity in terms of regulation. And blockchain technologies and the consensus protocols, for example, are about governance. And if you think about governance in financial markets, it's about who does what, right? And so this ethos that came originally as a decentralization, distribution, and trustlessness, which is at the heart of the original thinking, is again about maps very well into the traditional financial markets. And again, this is one of the reasons why it's also been brought much closer to regulators. Which brings me to the second point. What is a bug and what is a feature of these systems, right? With the technological, with the consensus protocols in this governance, the scalability issues are actually a feature. You do need a little bit of that friction that comes with trying to, Byzantine fault tolerance, get transactions to make it into the blockchain in a way that is trustless. So it is a feature of the system. It is not a problem. It is not a bug. But I'll push back on something that was mentioned already about this notion of trustlessness, which comes with this idea of the original thinking again of the notion that intermediaries are inherently a bug of the traditional system. And I will claim and I will argue that there are intermediaries that play an important economic function. And this is one of the reasons why some of these same functions and same intermediaries have been emerging even in crypto and DeFi. And again, intermediaries such as dealers and market makers, they are familiar for the traditional markets and also emerging now. And so because there is an economic function to these intermediaries and they're not just a bug in the system. Of course, we can come back to some of the intermediaries that rise from some of the inefficiencies that we have in the technologies that are not in the blockchain space. But maybe we can come back to that later, Chris.
Yeah, I'll then pass, with that, I'll pass it back to Jalapa. I mean, I guess what you're hearing from Team DC is, there are different kinds of things you may want to optimize on. And when you look at blockchains, that's a product of those kinds of design choices and features and use cases. And you have to sort of figure out, it sounds very familiar to what we heard from Dominic earlier about AI and choosing those use cases. And we're also making a critique about what the current TradFi system is in terms of the usefulness of intermediaries. So we'll just pass it back to you, Jalapa, for round two.
Philly team. So far, what do you think? Do you think there is some different technology that could deliver more effectively the goal of Web3? And if you compare blockchain with Bitcoin blockchain, which you are very familiar with Bitcoin, Bob, so do you think it is a failure or is it a success? So if it is a 10 for success and 1 for failure, how would you rate blockchain and Bitcoin blockchain? Many questions, but.
Sure. So, I mean, it'd be very hard to refer to a technology that was built in 2008 that has become an asset class at least recognized by BlackRock to be a failure. That would be very hard to do. You also have arguably the world's largest bug bounty that has yet to be broken, which is a testament to the cryptographic proofs and the Byzantine fault tolerant work in Bitcoin. What I question with Bitcoin is not where it is, but where it's going. And one challenge with Bitcoin is becoming increasingly centralized. So as a decentralized project that's aiming to have censorship-resistant sovereign form of value, it is becoming increasingly centralized, and right now you have a very large amount of the existing Bitcoin under 1 or 2 institutions. That leads to a lot of challenges. Bitcoin remains heavily full of bugs, and it needs to upgrade every version of C++, and it needs developers working on it. And there is a very small pool of developers that work on Bitcoin. And they are not terribly well funded. And so I think Bitcoin right now, I would put very high. Where it's going in the next 10 years, I don't know. But it is not gold, and I think several people have said that. Gold is an element. Bitcoin is an ongoing software project that could go in a lot of directions. 21 million Bitcoins is a choice of developers. It could be more than that where they choose to do so. And those developers are not terribly well funded these days, despite the size of the asset class. I think about that a lot for someone who deeply cares about that protocol. Blockchain itself, I think credibility is important for the industry, and understanding and saying what it can do, and whether, say, for example, blocks are necessary to, say, move central bank money or commercial bank money. Is Byzantine fault tolerant what's necessary for central bank or commercial bank money? Are good questions. But you mentioned Web3, which I think is different. Web3 is different. Web3 is the idea that persons can have agency over their own data in a censorship-resistant or sovereign way, and I think that's a very important question. Currently, the internet runs, and one thing we're working on in our company, currently the internet runs on a data bartering exchange. Meta gives you free services, Amazon gives you free services. In exchange, they get your data. There is no way to move value in a manner to exist on the open internet, or I think as Coinbase is termed, on-chain, in a manner that provides a value exchange. I think there is a very good possibility that some key tenets of blockchain might change that. So Web 2 is effectively you give your data to Meta and they sell your ads. This is something I think needs to be looked at and what this technology might be able to do. But you need to be able to move value at millions of transactions a second at around 100 to 200 milliseconds of latency. There is no blockchain in existence right now that comes close to that. And that's what we're working on at our company. That's something that came out of Project Hamilton and out of the work on our team did at Circle, is can you move smart contract executions at millions of transactions a second at sub 1 second latency so that you can actually have a value-based internet and not an ad-based internet. That's what blockchain hasn't achieved, and I've yet to see when I say blockchain, I mean a Byzantine fault-tolerant network that orders transactions in a global order of blocks to get to that number. And that's what we need to get to fix that bartering arrangement we've all kind of succumbed ourselves to with Meta and Amazon and Google, and that's what's needed. And I don't see blockchain solving that problem.
All right, Hannah. So I do agree that Bitcoin itself is pretty much a success. It did show that we can achieve a permissionless, decentralized digital money and a system that is resistant to double spending. Does not mean that it's foolproof, does not mean that every time we would just apply the same protocol, it would result in the same security, because it's not just protocol, there's a set of incentive in the whole ecosystem. However, it did achieve that. It created a new asset class. At the same time, it did not become the money that it was envisioned to be. So again, I'm going to go back to what was promised. It did not deliver. It became more or less the store of value. At the same time, it does have shortcomings. There is, Chris talked about centralization in holdings of Bitcoin. There's centralization in mining of Bitcoin and maintaining, and centralization in developing the protocol and maintaining the protocol. So there is centralization. There is a huge cost associated with mining Bitcoin. This is the cost of electricity. This is the pollution cost. There's a lot of externality that is needed to maintain and keep the system secure. This is difficulty. Now, when it comes to broader blockchain, I think this is less of a success story, in the sense that I mentioned before. Once we get outside of cryptocurrencies, it is no longer a self-sufficient, self-contained system the way Bitcoin is. Now, if we want to go out and do supply chain on blockchain, if we want to do contracts on blockchain, if we want to do DeFi on blockchain, we need to get information from outside. We need to interact in and out with the real world. It actually favors a lot of centralization that results in value capture as well. So it doesn't really deliver on the same decentralization that we expect from Web3. And I don't think that this is going to be delivered in, if anything, if we're thinking about permissionless blockchains, we're going to see the value recapture and re-centralization, but now without knowing who is capturing this value and where it's going. Now, at the same time, DeFi did, so blockchains and systems like DeFi, they did create new value classes, new markets. We are yet to see whether these markets will be viable and large, whether they will be large like video game market and industry, or whether they will be relatively smaller like baseball cards industry. Here I'm kind of thinking about NFTs as well. And we will see how secure and safe they are. We will see the test of it. Now, to speak to other technologies that could achieve the promise of Web3 and the kind of decentralization and thinking about where we want to bear the cost of decentralization, I think that we should look at advanced distributed database development, at federated systems, where we can achieve enough of the decentralization without bearing the full cost of full decentralization. And in fact, these systems have been so effective in achieving this almost decentralization that they are called permissioned blockchains. Right? So kind of goes back to, if it works, let's call it a blockchain, but it's not necessarily the same system as permissionless blockchain.
Yeah. Oh, sorry. Yeah. Because we're hearing. I'll let the Oracle speak.
Thank you.
Yeah.
So first of all, go to oracle.com/blockchain. You'll see all the reference stories. You'll see our official, all the answers there, because I want to spend it on the Web3. So I think Oracle's blockchain and what we've done in it is sheer innovation. I'm very proud of our teams and what they've done with the kernel. But you go and check it out. You go and see it yourself. From Web3, I love Web3. I think it's a fantastic notion. I think that we are 100% going to see your data comes with you and it's portable, and then you plug that into the applications. The problem with Web3 at the moment is the proliferation of standards. We need like a few big techs to step up and to agree. We can't have the startups pushing it. It won't work. The one problem with seeing blockchain is not with the technology. It's not. It's with the business and the lack of ability to last 18 months on venture capital. The amount of companies we deal with that come to us with their investment in blockchain and they need to scale it. I would say the business is the #1 threat. Not technologically. On Project Hamilton, we collaborated, right? If you look at the unified ledger, 5 million TPS for BAS, unified ledger. Any blockchain doing more than 3,000? How many? Okay, 4,000. Yep. All right. So there's a gap. There's a huge gap. Blockchain's not the problem. It's not the problem. It's one of 50 different types from there. The problem is, how do we keep all the security and the availability to scale this so the unified ledger becomes a reality from there?
All right. Well, I did notice, Team Philadelphia, that no one actually offered the rating. I think maybe Bob did. But to Bob and weave on Jalapa's question there about what number you would assign.
Blockchain.
Oh, Bitcoin. I love Bitcoin. I'm like 9 or 10 out of 10. I love Bitcoin. Blockchain itself as an industry, as technology, it's kind of a well-marketed two-phase commit technology. It's two-phase commit's great. It's 7 or 8, but
that's a 5 out of 10.
All right, but go ahead, Chris.
All right.
Hannah, I will give 8 to Bitcoin and about 4 to blockchain.
Okay. Interesting.
Oh, okay. I'm gonna compliment my other speakers because I genuinely believe it. You mentioned two-phase commit. The biggest problem I've seen is the attack on bridges, and I'm a cybersecurity guy. I'm your last resort. I'm seeing it over and over. I'm seeing spoofing on permissioned and permissionless. The ingenuity is amazing from that. Huge difference. We implemented two-phase commit rather than bridges.
Oracle, we
And
need a number.
Scale. Oracle. What kind of number? Go to oracle.com/blockchain.
Okay.
Get the official.
All right. So
Get official numbers.
with that clarity, we're going to jump here to Team DC for a second. All right, you've heard a lot from Team Philadelphia. Let's talk a little bit about alternative technologies, other available paths which they've identified, and then what it means from the perspective of both blockchain and Bitcoin. And also, I will, since they are talking about gold, and we have someone from the Bank for International Settlements, which is the central bank for central banks, and you guys know a little bit about gold. Maybe we'll just sort of start there, and in terms of your general impressions, alternative technologies, and obviously Bitcoin as store of value.
I'll piggyback a little bit on,
Sure.
on what was discussed in Philly. And on how we have seen some of the benefits of emerging from this discussion of blockchain technologies. Of course, this is the idea of a shared database amongst different types of actors, of different types of assets. And this is at the center and at the heart of this proposal of the unified ledger that was just mentioned, right? So it is about taking this advantage, the advantages of programmability, of composability, in a shared execution environment and shared data environment that contains the assets that I mentioned in the beginning. So there's the notion of the creation of value being tied to the safest settlement asset, which is central bank money. And so this is at the heart of this concept of the unified ledger that the BS has proposed. But it is also the acknowledgement that there is this opportunity for public and private partnership. And this is why we mentioned the central bank money being at the heart, but this understanding that commercial bank money plays together with central bank money, as it does today in the traditional financial system. But this notion of having a programmable platform, I think it's something really important and central to this vision, and something that we have been exploring. Again, in Project Agora, that I'm sure most of you are familiar, trying to explore take advantage of this shared and eliminate some of the inefficiencies that come with the siloed traditional systems that we have today. The two-phase commit, think about two-phase commit amongst various databases that are all spread over a cross-border payment chain. So it's like the initial, the bank initiating a payment, the central bank in the middle, the correspondent bank, the one. So it's a number of two-phase commits that have to happen, and all of that synchronized. And so I think there is this opportunity to bring all of that into a programmable platform. And maybe I'll stop there.
Yeah. I have, we were very fortunate even last year to have Yoon Sung-jin talk about the unified ledger, and we can get back to that a little bit later. But your score, yeah.
Are you going to put me in that position?
I'm absolutely going to put you in that position. Score for Bitcoin and blockchain.
Blockchain without the notion of governance and the aspects that I mentioned again, the blockchain as just the technological aspect of shared, I think that's, let's say, 8, because it does need improvement, right? Bitcoin and I'm going to use the two-handed economist, right? On the one hand, there are the technological.
Try being a lawyer.
Yeah, well, there are the technological advantages that came from that, but and I'll tie that to what Hannah mentioned is. It is, if you think about the electronic cash peer-to-peer system, which would be about just exchange of money in terms of means of payment, it has become more that, has become store of value. And the thing about store of value, and some of the colleagues here have worked on this, some of the BIS colleagues have shown that it's store of value, but whales have made profit at the expense of krill. So it's like the largest investors.
Score
and
is...
So on the one hand, it is one thing. On the other hand, it is the other thing. So I'll be in the middle. Can I
so
give it a 5?
They're wily, these BIS economists. They're wily. Okay, Patrick.
With both of my hands, I
Well,
will say that Bitcoin is a 10 out of 10.
Okay.
I mean, it's really hard to argue with something that has went from nothing to $1 trillion, right? Like, calling that a failure is, as Bob said, like, I mean, if anybody wants to have that debate, happy to have it with you. And on the technology side, it was a clear step forward in the innovation side. And you're right, it's not the blockchain technology, which is really just a component of what made Bitcoin successful. The innovation was Nakamoto consensus, which is the governance layer, right? That's clearly a 10 out of 10. It was a brand new, innovative thing that was a computer science breakthrough. So for blockchain, sure, I think it's a little lower. Maybe it's a 7 out of 10. But again, when you see how much activity is happening out there, and when we talk about things like, well, okay, how do we build a ledger to make it like there's a utility that allows people to move money around the world? Well, it's been built. It's called stablecoins, right? It exists right now, and everyone in this room can do it immediately. You can send value from point to point anywhere in the world on your own terms right now, right? And that's across multiple different blockchains. In fact, the only blockchain that doesn't have a stablecoin on it that I'm aware of, I mean, I'm sure there's a whole long tail of them, but the main one is Bitcoin, right? So you know, keep that in mind. When we're thinking about that, look at the numbers, like follow the actual business, right? Stablecoin use in remittance and things like that has done nothing but grow over time and stands to do nothing but continue to grow. And I think where this conversation comes down to is it's a matter of philosophy, right? If I believe in a system that is open, accessible to me as like an autonomous person, I autonomously can like access at the core layer all the functions of it privately, then you know the trade-off in terms of cost and speed and all that for the disintermediation you get with a blockchain is 100% worth it. If you don't want to live in that world and you're like, I really want people to go through a bank, right? I want people to go through a financial intermediary for every aspect of their financial lives. If that's the world you believe in, absolutely blockchain is not going to be for you. It's not something you're going to want to adopt or have anything to do with. So I mean, I think ultimately that's the conversation. It's about what's the world you want to live in, like in the future. If you want to live in one where there's like open access, privacy, and you have autonomy over your financial life, then Bitcoin, blockchain technologies, other decentralized technologies that are not blockchain technologies, that's sort of the path forward. If you don't believe in that vision, and there are people who don't, and that's fine, then like focus your energy on, I don't know, banking law, Chris?
Well, Jalapa, we have less than 5 minutes left before we have to switch to the FDIC vice chair. Maybe, if you don't mind, maybe we could have everyone on your side give us like their 30-second, is there anything that blockchains can do, sort of following off of Patrick's sort of observations there, is there anything that blockchains can do that Web 2 can't? And then we'll end up here, if that's okay with you?
Sounds good, yes. Can I also ask just one more question based on Bob's description of the rating of blockchain and Bitcoin? So Bitcoin definitely is much more successful than the regular blockchain, but is it really dependent on the limited supply of 21 million, and that can be changed? You said that could be changed, and the code actually has been being revised. Is it a problem?
It could be. If the core engineers are not well supported and well funded, if say there was an attack on Coinbase, which has a massive quantity of the world Bitcoin supply, there could be a demand to fork it, to reorder the Bitcoin blockchain. I think that's a very considerable threat to seeing Bitcoin as an asset class. So yeah, it's all about making sure that that ecosystem is well supported, and you avoid concentrations in that ecosystem.
Okay. Now, since the Chris's question about, is there anything else that?
Yeah, I mean, Pat Merck and I have known each other for a long time, so we're probably talking similar books. The alchemy that whoever Satoshi Nakamoto was a really incredible breakthrough in computer science, and it's shown. Since then, I think we've had some really interesting work in smart contracts, in composable smart contracts and smart contract execution To be sure, smart contracts are not required for a blockchain. You can run a smart contract on a Postgres database. But I think that the big thing in my mind, it has incentivized millions of people around the world to learn computer science. And incentivized millions of people in the world to think differently about money. And people being smarter is a good thing. People learning more is a good thing. And that's a good incentive model in my mind.
Yeah, quickly. So I think that with blockchain, well, if well implemented, it offers more censorship resistance than any other technology. At the same time, we need to think whether we really want censorship resistance and whether we want to bear the cost of censorship resistance, that is directly running the system and the consequence of somebody stealing our money and so on. At the same time, I would say that the big impact of Bitcoin and blockchain is and the hype around it is the catalyst for innovation, even if the result of innovation will not be permissionless blockchains, to the point that Chris brought.
Do we have time
We have,
some more time for the debate?
everyone has like 20 seconds at this point.
Okay. You have anything else you just
Okay,
say?
I've got no problem with Bitcoin at all. I'm a cryptologist, an SA cryptologist. I think we need to get to post-quantum, and I've used quantum technologies for a decade, cryptography as soon as possible based on the NIST guidelines. I think the cryptography is a serious risk from there. So no problem with Bitcoin. With blockchain, it's evolving into a data platform. You're going to hear data platform. Right? It's going to be merged with AI. It's the transaction model between the blockchain and the database based on our Project Hamilton work, sir, is excellent and passes all the DoD IL level 6 impact, which is the highest level accreditation in our environment.
Okay.
Okay, back to you.
Yeah, thanks so much.
Shared platform with the proper safeguards.
DC, Team DC efficiency. I love that. Okay, yes.
The Bitcoin Renaissance? No, that's one. Two, I'll say, I mean, I think that the highest and best use is to create open public financial markets and market infrastructure that everybody can use in a way that just doesn't exist currently.
All right. Okay, Team Philadelphia, thanks so much for your time. We're about to transition back, and Team DC as well. Let's give everybody a big... All right, I'm going to, it's for you guys, I'll say, we won. I'll say to the stage and invite the Vice Chair of the FDIC onto the stage to join me. So thank you so much again, Vice Chair Hill, for joining us. I think this is your second tour with DC Fintech Week, and just to have you take your time and your insight here is very special. So it's an exciting week. Lots of things are happening in general in the sort of larger policy conversation on fintech. Earlier in the day, we talked about bank-fintech partnerships. I'm sure you've heard a little bit about that. Maybe you can give us your thoughts as to, how exactly can you get those bank-fintech partnerships right, whatever right means, and how do you get to that right balance of innovation and consumer protection?
Sure. Well, thanks everyone for having me. It's great to be here. So I guess I'll start by saying, I think from our perspective as a bank regulator, I think these partnerships are not going away. There's clearly a significant consumer demand for these types of fintech products. A lot of the innovation that we've seen in financial services over the past decade plus has been outside the banking sector, and there's lots of reasons for that. And for a lot of these products, these types of fintechs and other companies need to partner with banks. So I think from our perspective, we have to recognize that, again, this is not going away. And I think what we need to do when we think about how to balance the various objectives that we need to think about is how do we create a viable path for responsible players to pursue this type of business. I think one piece of it is finding ways to be more transparent about what our expectations are. Over the past couple of years, there have been a series of enforcement actions against banks who have engaged in this type of business. And so what has happened as a result of that is a lot of banks, each time a new consent order comes out, is they go looking through the consent order to see all the different things that are in it to try to glean what the constantly changing supervisory expectations are. And I think that creates a number of challenges. I mean, part of it is a lot of times each individual consent order is unique to the particular bank that was subject to it. And I think there are also challenges with creating a consistent framework sort of across the board. In that vein, I think another piece of it, again, from the regulatory standpoint is how can we appropriately balance the need to be nimble and be able to respond to things quickly, but at the same time, as I said, be consistent in how we're applying things across the board. So on the one hand, we want examiners who are out in the field to be able to respond to things, but we don't want to have a situation which is what I think happens now from time to time, which is banks are talking to their examiners, they think their examiners are comfortable with something, so they think they're doing things the right way, and then DC kind of swoops in and, basically comes to a different conclusion. And again, part of this all comes down to finding ways to be more transparent about what our expectations are, more consistent across the board, and at the same time, more nimble in our ability to respond as new things are coming up.
That's super helpful. I mean, we had Representative French Hill on, my fellow Arkansan, to talk a little bit about sort of his views, and he was talking about clarity as well. And I think you're sort of filling in a couple of the gaps in the sense of you're saying it's literally, and there are actually a number of law professors walking around here. It's almost a really interesting research project, which is how do you, on the one hand, respond nimbly? So you could imagine, case-by-case decisions, if not via enforcement, but even through the regulatory agency as a way of giving some kind of indication, but they're grounded in very, very specific facts and circumstances. The question is how generalizable, are those instructions? And so it's almost like a little bit of a trade-off here between how can we be responsive, but also clear, and just that sounds that sounds pretty tricky. And I'll be curious to see how you get that right. That's certainly not easy. I mean, do you? So it sounds like though, to that step that you think that there may be some work to do in terms of getting, I assume, that balance and that process right. Not to throw sort of pop quizzes, but any kinds of ideas or thoughts or outcomes you would like to see when it comes to getting there?
Yeah, I mean, look, we issued a request for information this summer, which I think was a helpful thing to do, that asked a series of questions about how the regulators should look at these types of partnerships. I think it probably would have been helpful to do something like that a couple years ago at an earlier stage in this process. I think in a lot of cases, the ultimate objective is to be able to put out, again, some sort of, whether it's a policy statement, guidance, whatever it is. We have third-party risk management guidance that we put out recently, which addresses some of these issues, but that is at a much higher level and addresses a much more kind of diverse range of third-party relationships. I think when it comes to these sort of fintech arrangements and other similar partnerships, that's a much more specific type of arrangement. And if you've got this dynamic where you see institutions across the board not doing things the way that supervisors expect, I think generally a better approach, rather than just starting to go bank by bank by bank, issuing enforcement actions, where then every bank is again trying to figure out what the expectations are from the consent orders, instead to try to put out some sort of overarching policy statement that conveys to the public and the industry, here are what the expectations are, and then you kind of examine and, if necessary, take enforcement actions based on that.
So you hear that law professors lurking around, some of whom have said that they want to send me papers. So there's some interesting stuff there. That process, getting that right, is hard, and the tools in the toolbox. And exploring them, I think, is really, really interesting. Another big issue that many of people across the country have talked about, last year we had an individual, and tomorrow he'll be speaking again, Siki Ballard, whom some of you may remember, had talked about sort of the ability to create new banks and the formation of new banks in the country, and how that's slowed over time. What is your view on this, on the ability to create new banks? Is there a need or not? If so, is this a time to consider special charters? Qu'est-ce que c'est? What's your take?
Well, I think the lack of new bank creation is a big problem that we need to think creatively about how to address. If we look at the consolidation within the banking industry and the decrease over time in the number of banks in America, I think that is much more a story of lack of new bank formation rather than a story of mergers. If you look over the last few years at the number of mergers as a percentage of banks, the numbers are actually below the post-1980 average, whereas if you look at the number of de novos, it has basically fallen off a cliff since the financial crisis. And so again, I think to the extent that there are concerns about consolidation, about the decrease in community banks, I think the lack of new bank formation is the much bigger story than the merger story. In the years after the financial crisis, there were almost zero de novos for the first decade or so. When Chairman McWilliams took over at the FDIC, encouraging more de novo activity was one of her.
Can I just admit, do you know why there weren't very many banks being created after financial crisis? I mean, I'm assuming banking was probably not not the business everyone wanted to rush into, but.
Yeah, I mean, I think there were a combination of reasons. I mean, I think a big part of it was the perception that in the years leading up to the financial crisis, there were a large number of new banks, and the percentage of those that failed was much higher than non-de novos. And so that resulted in increased expectations around what organizers needed to be able to show in order to be able to qualify. I think in the initial years after the crisis, I think it's not abnormal for there to be less interest among organizers. There were a large number of banks that were failing to the extent that investors wanted to invest in the banking industry. There were lots of opportunities to do that at a pretty discounted valuations. But I think as the years went on, the heightened expectations continued even as the sort of the tail of the crisis kind of faded. So then once Chair McWilliams took over, she initiated several reforms to try to encourage more de novo activity, which to some extent was successful, and there was a noticeable uptick in de novo activity, but again, still a small fraction of what was typical historically. And so again, I think it's probably something that is going to require some more creative thinking and potentially a little bit more of a risk appetite in recognizing that it's possible if we're going to have more de novo activity, there may be a higher risk of failure, at least in the initial years associated with that.
Yeah, I love having this kind of perspective because it's interesting. This is a fintech conference, so we're talking about things that are happening outside of the non-bank system, and this is a little bit of a play for build new banks, kind of question, and what are then the trade-offs of taking that kind of approach? I mentioned different charters. ILCs are obviously always sort of popping up from now and again. I mean, what's your view on using that particular tool for for the de novo and other banks?
Yeah, so I mean, so I guess just sort of in terms of other types of charters in general, I mean, from the FDIC's perspective, you know, we're not the chartering authority. So so to the extent that there are different types of charters, whether it's ILC, whether it's a special fintech charter, or people talk about some sort of payments charter, you know, those all would be dealt with in, you know, either at the state level or through another federal agency. But from our perspective, to the extent that entities come to the FDIC, it's with an application for deposit insurance. And so the factors that we consider and the analysis that we undertake is the same regardless of what type of charter it is. I think there are fair questions around whether, if there are certain unique types of business models, whether, you know, that should be taken into account as we consider the different analytical factors. But again, I think from our perspective, at the end of the day, the factors that we consider are going to be the same regardless of the type of charter.
So, I mean, you're mentioning something that's really important, which is, you know, the FDIC. I mean, you guys are the ones who, I mean, you to use your term, swoop in when things kind of go wrong, and you use taxpayer money to stabilize the financial system.
The diff different from.
Okay, true.
Yeah.
I shouldn't. That. Thanks for the correction. We use the financial system's money to stabilize the financial system.
I guess we're all taxpayers.
Yeah, we're all taxpayers. Right. You know, but that role is as a backstop as opposed to sort of the chartering sort of authority. And so when you get to questions like risk, you know, and so trying to figure out like what's the proper risk appetite, and when you get to questions about, frankly, innovation and opportunity, it's a kind of an interesting place for, you know, the backstop to have such an important role. I mean, how do you think that through? I mean, like the innovation question when it comes to your role over at the FDIC.
Yeah, I mean, so look, obviously all the regulators have a variety of hats that they have to wear. I think as the FDIC, you know, we're the primary supervisor of more than half the banks in America. We're also the deposit insurer, also the resolution authority. But I think
pretty important stuff.
Yeah. But I think you know, I think innovation has to be a part of how we look at all of these things, because as the world is changing and as the industry is changing and what consumers demand change, banks have to change with it. And so as the regulator and the supervisor, you know, we have to foster an environment where banks are able to evolve with the times and with the demand for consumers. So, you know.
To deal with it. All right. I guess, you know, looking forward, you know, this is an interesting time, you know, both in Washington and the world, but the agenda of the FDIC is sort of remains in the sense of it's doing its work when it comes to deposit insurance, when it comes to the supervisory work. What do you view as sort of you know the immediate priorities? What kinds of things would you like to see done in the next 6 to 9 months? Are there any kind of must-dos, priorities, or highlights?
Well, you know, I don't know if there are necessarily must-dos, and I don't know what the right timeframes are. I do think that when we deal with community banks, small banks, one of the biggest challenges that they face is the cost of technology adoption. And I think that's true really across the spectrum, both for the banks that want to be on the cutting edge and are doing fintech partnerships or other types of, you know, again, sort of cutting edge, innovative type activities, all the way to the most plain vanilla banks that are just serving their local community. The technology challenges are omnipresent. And so I think from the FDIC's perspective, there's a lot of things that we could be doing to try to be proactive in trying to help address some of those challenges. I'll mention a couple of things, just I think that could be starting points that, again, Chairman McWilliams had initiated during her term that have been either discontinued or, you know, altered in material ways. One is FDI Tech, which was the innovation office that Chairman McWilliams had set up, which was designed to engage with the private sector to try to help develop solutions to some of the challenges around technology adoption. After she left, that office was reformatted to function on internal FDIC technology, which again is a very different mission. And so I think sort of reinvigorating the mission of that office, I think, would be a helpful tool. Another initiative she had started was a standard setting organization that would have been a public-private partnership to develop standards for due diligence of fintechs, technologies, and other potential bank partners. And part of the idea there was to have a certification process where third parties or technologies could get a stamp of approval. And the idea there is today, every bank has to individually do a due diligence process that can be costly and time-consuming. And this is a way to just set up a more efficient mechanism for resources to be used more effectively. Banks would still need to manage all the risks the same way they do today, but at least that due diligence and onboarding process could be streamlined. So I think those are a couple of things. Again, just as sort of a starting point.
I mean, this conference, I personally have really always advocated for our community banks and to sort of make sure that people understand that it's not just a question of how do you capitalize the community banks, the CDFIs, the MDIs. It's a question of how do you allow them to also scale, and technology is such an important part of that in their ability to be able to compete. So I'll co-sign that, and with that, I will co-sign the next panel and session. But let's give the Vice Chair a hand. All right.
So welcome, everyone. Welcome back. I'm really pleased to be able to moderate this next panel, which will be about data-driven solutions to advance the American dream. And it's the last panel of the day. Yay.
Yay.
So when Chris reached out about this panel, I knew it would be an excellent conversation. Of course, it's a topic that's close to all of our hearts up here on the stage. We have an all-star panel. I'll very briefly introduce. So we have Dante Desparta here from Circle. We have Melissa Koide from FinReg Lab. We have Saima Somalia from Remitly, who also flew in from my hometown of Seattle. And we have Peter Akwaboa from here from Fannie Mae, so on home turf. And very glad, all of you, that you're able to join us here. So I'll just briefly introduce the topic. We were talking about data-driven solutions, and we all agree that data are important. But the question is why and how? What are the specific data-driven insights that reshape economic landscapes and clear a path for people to pursue opportunities? The panel will discuss how data are leveraged across sectors to bridge gaps and ensure a more inclusive and equitable society. The discussion will also examine the role of data in the development of products and policy, which continues to expand access to the American dream. So one of the questions that may come up right away is how do we understand the American dream? And certainly on our call preparing this panel, we had a discussion on that. And there are different ways of understanding it. So you could have the Horatio Alger rags to riches stories. You could have maybe how comedian Eddie Izzard describes it. It's starting in the gutter, getting all the money in the world, sticking it in your ears and blowing a raspberry at everyone else. I'm not going to blow a raspberry. No, that's not what we mean here today. It's not how I understand the American dream. I think the American dream is really about getting access to opportunity. It's about coming from different backgrounds that anyone, regardless of their background, is able to build a livelihood, buy a house, create wealth, and ultimately give themselves and their children and the next generations opportunities that they may not have had themselves. And so that's what we're going to be talking about today. How is it that we can expand opportunity? How is it that we can allow people to achieve their dreams, to pass on wealth to the next generation? And how personal data can actually help in this, and in what ways, with which guardrails, with which frameworks. So let's dive right in and start with the different members of the panel. I'm going to start here, just directed to my left with Dante. Dante, you've written a lot about the potential of digital technology to lower barriers to entry to the financial system. Also, for instance, with know your customer checks and other standard processes. So what do you think is needed to grasp these types of opportunities?
Yeah, well, first of all, what an honor to be on the panel, and what an honor not to have to talk about stablecoins. This was my only requirement for speaking at DC Fintech Week this year was I need a break. You'll see. You'll see. I snuck on. So the reason I became interested in what blockchain technology could do was because so much of the world's infrastructure, particularly the data that unlocks your and my financial lives, sits in single point of failure honeypot databases. And so I spent the better part of my career in risk and resilience and national security. And remember the Equifax breach. It exposed for the rest of your and my natural life a lifetime of identity theft risk. And you think about the three services or the services these types of organizations provide, Equifax, Experian, TransUnion, they're single-sourced gatekeepers for every long-term financial decision an American can make. And so if you want to achieve the American dream and you want data to play a part of it, we need to figure out how to actually give it back to people. And so I think there's a very, very powerful storyboard to be told here about gatekeepers locking us either in and or out, and single alphanumeric numbers, either your social security number or the credit score that you get, is being dispositive of every choice that you will get for the rest of your natural life. I think we could do better in architecting an alternative system to that. That doesn't mean you have to throw away credit checks and reference checks and all these fun things, but I do think we should aspire to this notion of empowerment and agency and not presume that every one of us has to have a third party between us and the rest of our financial lives. To me, that's a very big part of the American dream, is people who come to this country have agency. You need agency, otherwise, guess what? You're not going to survive, because the ladder of economic mobility in the United States is slippery, it's barbed, and it's guarded. And we have an opportunity at least to have a conversation about how data can shift back to people, and with that, the people can then get back the power that they need to make better long-term decisions.
Thanks a lot, Dante. So let's move to Melissa next. Melissa, I mean, data is, I think, very much at the heart of what you guys do at FINRA Lab. The mission is to improve public policy and market practices by filling knowledge gaps. And of course, there are a lot of knowledge gaps on the optimal use of data. So can you share with us what your approach is to empirical research and market intelligence, and where do you see the greatest potential from data-driven solutions?
Absolutely, and again, I second the appreciation for being here. I think it's really fitting that this conversation, the first day, we're coming back to the topic of data. I said it last year at FinTech Week, it was repeated, it's the data dummy. We're not in banking, we're not in FinTech. Blockchain may offer real potential because of the data and where does it sit. We come at these questions very much from how are data enabling more people to be a part of an affordable, responsible financial ecosystem, no matter who's providing it. And so we do a lot of work around interrogating opportunities for leveraging data to bring more people into the financial system. You think about credit, we have up to 50 million people just in the US alone who can't be credit risk assessed sufficiently because of the data that are used for underwriting. But you think about how many people have not just a bank account, transaction activity, but a prepaid card. You think globally about where we see people leveraging mobile payments and generating transaction intelligence. That kind of information is instrumental to making sure that we are bringing the billions of people across the globe, the 50 million people in the US, into credit, into transaction activities, into our topic of today, what is the dream, right? The ability to build stability and ultimately wealth for yourselves and your offspring and your loved ones. And so that is what motivates the work that we do. To the very sort of specific question, we spend a lot of time working with industry stakeholders, many of you in this room, to build the kind of research, to build the empirical understanding of how do data work, where don't they work, when you're thinking about credit underwriting, we're now actually spending time, and I hope this is a good transition to you, around the importance of data for are you who you say you are? And then one more thing I just want to add on, we're also at a point where, and I think we all know this intimately, the data itself, if we don't get the governance right, if we don't get the access points right, and blockchain is interesting. You hear me giving you some space here on that one. We have this debate every time we get on a panel. The bad actors are after that data. And so we're not just at the need of like, let's fix the system and do it differently on a going forward basis. We're also at the point where if we don't get the data access and the data governance right, bad actors are going to be taking advantage of it and more people are going to be excluded. And so it's a really pinnacle moment for all of us in this conversation around data.
Thanks a lot. So we'll go to Simon next. And Simon, Remitly offers remittances services for immigrants from around the world. So can you talk about the role that data play in your business? And I'll pose the same question as to Melissa. How do you see the potential of data-driven solutions to enhance opportunity?
Yeah, so I'll start with like what is a remittance. It's a cross-border payment, typically person to person from an advanced economy typically into a developing economy. That's sort of not always, but generally the way it works. And for our system on Remitly, we are a digital application, and so our customers don't have to go and stand in line at a brick and mortar. They can come and do their transaction using their mobile phone or a website, typically a mobile phone. And so that has been an incredibly important industry for when we're talking about the American dream for many immigrants that come to the United States. The opportunity to create economic value and create prosperity for themselves and share it with their families, and maybe even think about, in many cases, thinking about that American dream as something that they're going to then take home with them to their home country, is what the American dream means for our customers. And so the ways that we've seen data be really powerful and impactful in our business and our ability to serve those customers has been in probably infinite ways, but I'll talk about maybe 3 here. The first one is finding those customers. So, I think we're all familiar with how powerful some of these marketing tools have become across the big tech players, but finding that data and using that data to figure out what is the most efficient way to find customers to market to and tell them about the products and services that are available to them in the marketplace. And Remitly actually started off as an aggregated price disclosure mechanism. And so starting with finding the people that are looking for what you can provide and giving them information efficiently is an incredibly important way that companies can leverage data. The second one that I think has been really important for us in inclusion has been finding ways to serve our customers better. And so recently, probably a good example is we were finding throughout our transaction systems, aggregating the data, that we were having quite a few customers at ports of call trying to access the system and accessing our system using satellite systems, which is weird and it trips your KYC system, right? So these transactions get sidelined, they look spooky, they look weird, and we don't process them. Taking a look at all of that data together, we were able to realize these are seafarers. So they're on boats, they work on cruise ships, they're naval officers, and they're a whole category of customers that's perfectly legitimate. They just don't have a permanent residence, and most United States systems require a permanent residence. And so we were able to go out and diligence cruise ships and naval ships and sort of verify in our system in a diligenceable way and in an inspectable way that these are perfectly legitimate addresses. And now there's a whole new category of customers that can use these remittance products and services. And so, multiply that by 1 million, right? You can go out and find these customer sets using these aggregated data sets in new and exciting ways that improve the penetration of products and services, especially financial services, to individuals. And then the final way I think that's worth touching on is what you were alluding to, which is fighting crime better. The best people and the worst people in the world want to use cross-border payments apps, right? And I'm the chief legal officer at Remitly. It's my job to never, ever forget that some of these people are money launderers, drug runners. I'm sure we've all read the TD bank consent order, so I'll stop there. And so the more data you have access to, and the broader that data set is, especially with AI, the better you can recognize those patterns. And like, make no mistake, even when you're at the top of your game, they're really hard to find. Like, these guys are really good. They have ways to hide their VPNs. They're using VPNs to hide their locations. They quickly switch from jurisdiction to jurisdiction. And so, that's also an incredibly challenging area, and one in which you can use data to really find the bad actors and exclude them more efficiently.
Thanks a lot. Yeah. So let's move to Peter. And here at Fannie Mae, of course, Fannie Mae aims to facilitate access to home ownership and to quality, affordable rental housing. So what types of data-driven insights are needed to ensure success in your area, and which types of data can play an important role?
So first of all, thank you and welcome to Fannie Mae, and thanks to Chris and the Fannie Mae team for putting such an amazing event together. I would say I'm also encouraged by the diversity of this group. I actually just looked around, I thought this is excellent from a diversity point of view. Let me take a step back, and I think just throughout the whole day, the way I think about it, I've been hearing four things. In fact, actually three. The fourth one I didn't really hear a lot about, A, B, C, D. What is A, B, C, D? AI, blockchain, cloud, and data. I've heard so much about A, B, and D, and cloud. It looks like cloud has become table stakes. It looks like the A and D is graduating to PhD. There's more to work to do, but blockchain is still yet to graduate. So just think in context, but just bringing it back to data itself and what Fannie Mae is doing. I want to share my own story with you. So 2017, I moved from Singapore to London. My life has always been moving around. And so you can think, who's Peter Akwaboah? How's Peter Akwaboah been underwritten? You just think about that. So I moved to United States. I rented first. In 2018, I decided to buy. There lies the problem. I moved April 2018, I decided to buy. Guess what happens in April? Your tax returns. I had no tax returns. So just think about it. No tax returns. And when I live in the UK, I grew up in Ghana, I grew up in the UK and a few others. My way of thinking about credit is when I have the money, I buy it. I buy cash. That's my value. So I come to the United States, everyone says, the way to think about credit is you need to borrow to have credit. And I'm thinking, well, how does that work? But this is what happened. So then I'm trying to buy a house, and nobody can understand who I am. They ask for tax returns. I don't have tax returns. So they asked me to quickly put a draft tax returns together and then start putting different data together. So fast forward, the ability to underwrite something like me was very difficult. And if you think about what is happening, it becomes two things. Now looking for a house, supply is an issue. And when you think supply more broadly, roughly if you think globally, there's probably about 300 million supply issues. In the US alone, you've seen all the data that's been talked about, which is roughly 3 to 4 million supply issues. This is a global challenge. The other side is the access to the financial itself, the credit itself, which was a challenge. So when I bring it back to Fannie Mae and some of the work we're doing, I like to think about it, which is definitely not just a US issue, but a global issue. Access to alternative data that allows us to really think about, Melissa, some of the things that you talked about, whether it's bill payment. These days, people are using social media to be able to access people's credit. But those are some of the things that we're doing in Fannie Mae, both on the multifamily side, where we've seen that some of the changes in positive rental and cash flow, we're seeing even some of those, our FICO scores are going up on average 36 points. We've seen the same on the single family side when we started using alternative data to start measuring and underwriting and so. So this is just the tip of the iceberg. The way I like to think about data is that it's not just data. Data has to give you some knowledge. It has to then translate to information. And ultimately, where we're trying to get to is wisdom. If we can get to wisdom, we make the right decisions to move things forward.
Thanks, Peters. So let's just follow up a little bit. So Dante, now I am going to ask you about stablecoins.
All right, good.
So Circle, I mean, you guys state you aim to make digital money available on the internet around the world. And by definition, digital money generates troves of data, in particular transaction data. So can you walk us through how the use of such data could help to advance opportunity?
Yeah, I mean, I think one thing, first of all, what an amazing panel and what amazing insights. I think one thing that we have to presume, there's a tension in the blockchain world, which is that a ledger that records everything that has ever happened on it indelibly forever is a treasure trove of data that in some respects not only creates a tension with GDPR and other privacy rules around the world, it eventually either becomes a good thing or a bad thing. In fighting illicit finance and illicit activity, it's a hard place to operate and expect to get away with illicit activity on blockchains for a very long time. Yes, it's fast money and it's internet scale money, but it's also trackable and traceable money, which is why the illicit finance community loves crypto assets for tracking and tracing, because we leave behind digital breadcrumbs. That's a feature, not a bug. But if at the same time, those digital breadcrumbs end up yielding people getting debanked, losing access to their financial services, or violating their expectation and their right of privacy in their financial lives, then we have a different problem, a very distinct societal problem. Which is why I'm not a fan of retail central bank digital currencies. I just had to say it. So for us at Circle, we are a wholesale company. We face institutions who then face the retail customer, and the retail customer ultimately has USDC and our other sort of currencies in their digital wallet. To me, that's a powerful feature, not a bug. That there should be an air gap between the banking system and how people spend their money in any of its forms, and that to the right of lawful, the use of money should be as free as possible. I think it's a feature we have to preserve and protect and not encroach upon that. But at the same time, exactly as the panel described, there's an opportunity here to exact the cost on illicit actors as opposed to penalizing entire continents or subregions of the world who are systematically blocked out of financial access because of fear of one person making one bad payment.
But this is a nice segue. So Melissa, I mean, you guys have been looking at how data can be used in different ways, including for credit and machine learning credit models with and without alternative data. So can you tell us about that work, and in particular the conditions that are needed for machine learning credit models to play a constructive role?
Yeah, and I'm going to end up giving a shout out to the OCC, given some of their motivation around understanding how to evolve policy, law, and regulation in light of machine learning as a form of AI. So you've heard earlier, machine learning has been used, for decades by at least 20 years by banks, the financial sector, supervised machine learning. But it is more complex. And so as we're thinking about using these models that can understand data and relationships that are nonlinear in fashion, but also yield more intelligence, whether you're fighting fraud or you're trying to credit assess somebody who may have a thin credit history, the combination of that more sophisticated analytical tool with more representative data that is more insightful, what is your transaction activity, may or may not correlate with something like income or wealth. So you're then sort of bringing those two approaches, the data and the more sophisticated analytics, to do a credit underwriting model. So our research originally started with interrogating the data, shorthand, quick answer. Cash flow data are predictive of credit risk of people who you would otherwise turn down with more traditional means. That's huge. Two, we recently looked at machine learning around core, frankly, just fair and human expectations, right? Do the models create disparities? Can you understand the models, use techniques to understand how a machine learning algorithm, supervised machine learning algorithm works? And there we find you actually can, but it takes a lot of human study, a lot of human oversight, a lot of understanding of the data that you're deploying and correlations in the data. But you can get better outcomes. And you could even find models that generate more fair outcomes than a more traditional credit model approach. And so that's enormously valuable as a scale opportunity for building short-term credit needs, long-term wealth opportunity. And what you're alluding to is now we're going to put this together, the peanut butter sandwich, and really interrogate all of those pieces together. So more to come on that, but that is research that we have underway right now. Excellent. Oh, I didn't give my shout out, but we're almost out of time. OCC is really trying to get their arms around these questions with a group of banks and others to interrogate some of the regulatory questions.
Very good. So I know we're coming up on time, but there's one question that I really wanted to pose. And so it's, here in the United States, when we say American, we tend to think from the United States. But I work in our BIS Americas office in Mexico City, and I work with central banks across the region. And, very interesting and sometimes funny thing comes up that, if you say American in other places, they think, yeah, we're American too. And so there are 1 billion people in this hemisphere. We're only about a third of the population of the Americas. And I think that, of those 1 billion people, I mean, yes, they say we're Americans too, and we also have dreams. And so I wanted to, widen this discussion a little bit and discuss, what particular opportunities can there be across the region, particularly in Latin America and the Caribbean? And let me pose this question particularly to Saima and to Dante, who I know have views on this.
Yeah, so I'll take a little bit of the maybe contrarian view to you, Dante, here, and say that at Remitly, we're huge fans of digital currencies as well as national payment system access for payments companies, which you may also agree with. What we find is, around the Americas, and let's take the Caribbean, for example, there are banking deserts, right? The penetration of banking systems, services, and infrastructure can be quite thin. But for payments companies like ours, we do have quite a bit of digital adoption, right? And so when we look at developing economies around the world, India, Brazil, and many others have had quite a bit of success with creating deeper financial inclusion by pushing and using the digital infrastructure that is already in everyone's hands, whether that's a telephone or a mobile system. And so payment systems can be that infrastructure for places that have banking deserts. There's more and more capabilities that don't really require a deposit account that companies like Remitly can provide more quickly and cheaply and affordably with national payments rails access. And so for the Caribbean, where a bank may not be viable locally for them in the short term, having that system on their phone will give them that liquidity access that otherwise just isn't available. So I think that's one that we're always working on.
Excellent. And Dante?
There is no greater export than the US dollar. And there's no greater need and no greater region of the world, a region where every decade Argentina has a currency crisis or a debt crisis of some kind, no offense to my Argentine friends, then the ability to extend the reach of the dollar to places and to devices, whether it's through Remitly or USDC and developers and entrepreneurs all over the world. This is the greatest export the country has. And so I agree with you entirely. The American dream is not a US fabrication, but it is an American export. And not just in Latin America, but frankly all over the world, the extensibility of the US dollar is the very best thing that we can do as a company.
Very good. So I think that we're at time, but I wanted to thank all of our panelists for your excellent remarks, and please join me in giving a round of applause to the panelists.
Just quick. Number one, I want to thank that guy, John Frost, BIS, nights, 2 o'clock in the morning, 3 o'clock in the morning. This guy has been helping to get the international community here, and he deserves a shout out. Secondly, we're going to have our happy hour. Thirdly, we tried to make today very cozy, right? You have your little TV screen, you can get your little popcorn, you can watch it. Tomorrow is radically different if you've ever seen it. It's a big format with lots of people. You will want to get in early. We'll have all of the international media, and that's just a clue for all of you who have joined in. You'll want to get in. But I did want to also offer again a huge thanks to Fannie Mae. They really pulled out all of the stops for all of you, and they do it every single year, and they do it because they just think that this conversation is important. I also want to thank our friends over at AWS. There are several people who, I'm talking about weekends, nights. The amount of energy that is taken to pull this off for you is insane. And they're always saying, oh, Chris, you did this. I'm like, I'm just on my porch with a White Castle t-shirt, right? And there's this huge, there's an army of people who help to make this possible every year. And so I want to thank Camilla. I want to thank Zainab. I want to thank AWS. I want to thank Olivia, Guy. It's crazy how many people are behind this. So let's give them all a big round of applause. All right. Our folks over at Show Call. Anyway, so there's a little bit of a happy hour, and we will see you tomorrow early because CNBC and Amazon and Bloomberg, it'll be crazy tomorrow. Okay, thanks.